Hello and good morning, everybody. Welcome to day 5 of the Traders Conference presented by MetaStock. We are so excited to have you here for another day. We are excited to have our speakers and are thankful for the whole gamut of speakers that we have had this week so far. If you've been attending the conference up till now, you have learned a lot. There has been a lot of great information that has come through over the last few days. Let me introduce myself. My name is Kelly Clement. I will be your YouTube host today. On the other side of the wall over here is Jeff Gibby. He will be your host through the presentations today. Good morning, Greg Lewis. Great to have you here. We will be getting started in about 8 minutes, but first let me introduce you to MetaStock, who we are, the presenters of this conference. We are providers of technical analysis and trading software, also real-time data, news, and analytics. So we're very excited to host this Traders Conference and have all these great speakers here. If you're not familiar with MetaStock, I am just going to show you a quick video, introduce you to MetaStock, who we are, what we do, and so you can learn a little bit more about us before we get started on the day. So I will be right back with you.
Stick around for about 3 minutes and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Okay, great. Well, there was an awesome introduction done by our own Greg Lewis. showing you what MetaStock is and how it works and some of the things that it can do. Today you'll learn a little bit more. We are going to start the day. Let's actually show you our schedule for the day. So here is our schedule for the day. We are going to be starting the day with Ed Downs. If you missed his presentation the other day, he talked about chart patterns and how to use chart patterns on charts. Today he's going to be talking about the power of artificial intelligence in trading and his amazing system that he's developed around artificial intelligence. Next, we're going to be having our own Jeff Gibby. I'm very excited for Jeff's presentation as always. He'll be talking about some of the hidden gems inside MetaStock. Some of the cool things that you can do that maybe you didn't know MetaStock was capable of. So stick around for that. Then we'll be moving the day on and going with Jerry Allison. This helps us focus a little bit on taxes and how to deal with the taxes that come along with trading. John Osborne, using value plus momentum to help in our trading. Tyler Wood. And then finally, Alex Cole. So that is our presentation schedule for the day. So we're very excited for that. As you're coming in today, tell us who you are, where you're coming from. We're here in beautiful Salt Lake City, Utah, where it's turning out, looks like it's going to be a nice sunny day today. I'll be spending it here in the conference with you, though. I'm very excited about that. Along with Jeff Gibby, our host on the GoToWebinar side and guiding us through the presentations. I am going to go check in with Jeff really quick, make sure everything is up and running, and I will be back with you in just a few minutes, but we'll be getting started in about 3 minutes. Okay. Again, it looks like we are about 1 minute out from getting started. Welcome everybody to the conference. As you come into the room, again, tell us who you are, where you're coming from. Also, one of the things that helps us a lot, bring you more awesome content like this, is if you will like the video and then also subscribe to the channel. That helps us alert you when we have more awesome content like today's presentation, so you can be alerted of all of our upcoming presentations, and it does help. So also from what Jeff tells me, it's very good karma, so we'll take that as well. So we are 30 seconds away. Let's go ahead and get this day started. Another day of great learning here at the MetaStock conference, and we will see you very soon.
All right. Good morning, everybody. I hope you are doing well. Good morning, Anton, Matt, Fortunate, Greg, Ed. Welcome to the show today. If you're coming in, make sure you say hi. We want to say hi to you back. Let us know where you're from. It's always really pretty interesting for us. And we like to kind of get you talking too because, well, we enjoy the interaction and it's good for the YouTubes. So if you're watching us on YouTube, thank you. Make sure to hit like and subscribe. You can even ring the bell and be notified when we do other fantastic events like this. Good morning, everybody. We're starting day 5 of the conference. And like we do every day, I'm going to start with this little handy-dandy legal disclaimer. So let's do that. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Okay, hope you enjoyed that. We're going to say thank you to Stocks and Commodities Magazine, very first off. Thank you for sponsoring the events. Stocks and Commodities have been sponsoring the events for 7-8 years now. We're absolutely great partners. If you do any subscription to MetaStock, we're going to give you a 5-month actually, Stocks and Commodities Magazine is going to give you a 5-month subscription to their magazine. And if you spend $300 or more, they're going to give you a 2-year subscription. I would say that with Stocks and Commodities, it's a great publication. I'm proud of the fact that you made it here today, this morning, as early as it is. Hello, Devin from Detroit, Jason from Vegas. I'm sure I nailed that. Neil from Toronto, Carlo. It's good to see all of you. I forgot what I was saying. Stocks and Commodities, great sponsor. They do a great job. We appreciate them. Our other sponsor we want to talk about is CMT Association. CMT Association has been a partner for a little bit. I think this is maybe the 3rd or 4th conference that they've sponsored with us. We love bringing them on. They are a really good, well-reputed, they just have a great reputation. They work with a lot of brokers. They do accreditation of brokers, and they work with some of the biggest. So cmtassociation.org. They also do a lot of courses involved in risk management and quantitative systems development, portfolio management, behavior finance, all that kind of stuff. Thank you, CMT, for helping us support the Online Trader Summit. And thank you, guys, everybody that came. Hello, Carl, in Thailand. What time is it in Thailand? Let me know. Thank you guys for all coming. I appreciate it. It's been an absolutely fantastic event. We couldn't literally do it without you coming every day and watching. And I hope you're learning something. I think my opinion is it's been going very well. I hope you agree. We are, of course, MetaStock. We're the people that put on the event today. If you haven't heard of MetaStock, you will today for sure. But just to kind of give you the high bullet points, 28 years in a row, it's been rated #1 by the readers of Stocks and Commodities Magazine. I love it personally, most of all, because you can scan any market you want, even Thailand or Vegas, I'm sure, or United Kingdom. Any market that you're interested in, you can get in MetaStock. You can test trading ideas. You can do forecasting. It's a great software program. Like I said, it's been rated #1 28 years in a row. We're doing a special today. If you subscribe for a month, we're going to give you the 2nd and 3rd month for free. We'll talk a little bit more about that when it's my turn to talk, but it's a great way to kind of get started with MetaStock and make sure it's the right tool that's going to help you. Our first guest today, though, we're going to kind of get to business now, are 10 p.m. in Thailand. Now we're going to get to business. Thanks, Kyle. Our first guest today is a good friend of mine, Ed Downs. Ed runs a software company called OmniTrader. He's been a partner of MetaStock for decades now. When we started, we had a kind of a bundle package that sold some of his software with MetaStock, and it was a very popular product. He spent the last couple of decades working on AI, which is what he's going to talk about today. And earlier this week, he talked about his chart pattern engine, which is absolutely phenomenal. Ed is such a good speaker that I actually invited him to do 2 talks this time. So with that being said, let's bring him on here. Ed, how are you doing?
Hey, Jeffrey. Great. Good to see you again this morning.
Yeah, welcome back. Did you miss us?
Oh, what a great event you've got going here. I've just really enjoyed it this week, and chart patterns was fun on Tuesday, so I'm ready to get into AI here this morning. It's all good.
All right. Well, let's see. I think I just sent the presentation over to you.
You did.
Yes, I did. Okay.
Yeah. Hold on.
And I'll just make sure you can see, and I'll get out of the way as fast as possible.
All right. Let's see if that comes up.
Perfect. Looks good.
All right.
You sound good. You
Thank
look
you.
good. A little bit more. What's the right word? Distinguished than the picture I was showing.
Thank
But
you.
you look great this morning.
Well, I appreciate you using my old picture there. It's gosh, I've been doing this for a really long time. I don't know how far that picture goes back, but started Nirvana, 34 years ago, Nirvana Systems. And of course, we created software products, but just to reiterate kind of a little bit what Jeffrey said, I have been involved with MetaStock for all this time. Really, it goes back to 92. And what I did when I started my company, I was a design automation engineer and was automating chip design, with software. And just something about, getting the computer to make things for me and automate things really just, got me going there. So did that for several years and started trading. And then I got the idea, well, you know what, I can apply a lot of this automation stuff to trading. So really everything that I've done in Nirvana Systems and now Fulgent AI is around automating the trading process in various ways, getting signals. But the big thing that we've worked on since 96 is artificial intelligence. And so that's what we're going to talk about today. But again, going back, I want to complete my thought about MetaStock because I actually went to Salt Lake City and met with Steve Akalis, the founder of MetaStock, and showed him some automation utilities that we had made at that time that ran that version of MetaStock, very early version, to do things like look for signals. And of course, MetaStock has those features now, but at the time, there's some utilities, and he really liked them. And we kind of got into partnership. And as Jeffrey said, we sold each other's products, and it's just been a great relationship. And I will tell you, when I came to Jeffrey, I guess 3 or 4 years ago, and said, hey, you know what? I've created this company called Fulgent Technologies. And the reason I created it was to take the artificial intelligence that we have developed going back to 1996 is when we started that, and deploy it in great software. And of course, MetaStock is like the best out there. So I called him up and said, what do you think? And he's like, oh yeah, that's great. Sure. I bet our customers would love that. So we did artificial intelligence for MetaStock, and also a chart pattern recognition module, which we talked about on Tuesday. And then more recently, a trading system called the X Suite. So we've been having a lot of fun with it, and just love coming on these webinars. These events are so great. I mean, you've learned so many things in the past 4 days, and it's going to continue today. So excited to be here. And again, thanks, Jeffrey, for having me on. Really, really awesome honor. Thank you. Okay, so I'm here to talk about artificial intelligence for traders. And of course, I'll be showing this software that plugs into MetaStock that does this job. But what I want to do also, whenever I do a webinar, I like to give people information that they may not have to kind of help them in other ways. So, whether you get our Fulgent package or not, I want you to come away from this with a better understanding of AI and, what it can do, some of the myths about it that are out there, and really what the state of the art is for artificial intelligence specifically applied to trading. So we're going to be getting into that, and let's dive in here. And I'll make sure I leave some time at the end for questions about this package that we have and what it does. So without any further ado, let's look at our summary of what we'll be looking at today. So this is a very straightforward agenda. We're going to talk about AI itself first. I want to kind of just take a few minutes to explain about that and sort of, the state of the art that's out there. If you go searching for it, what you'll find and what it means. Talk about that, and then look at how we can use artificial intelligence to improve trading results. Be very specific about it. No rocket science here, just exactly. It's really pretty straightforward, because AI is just a very powerful search approach to finding things, to finding patterns, and finding, identifying things in data. So very applicable to trading. We'll talk about that. And then at the sort of towards the end, this package I'll be showing you, Fulgent AI for MetaStock, can be configured to do whatever you want it to do, pretty much. And that's, I think, where the big power of it is. So I want to reserve that for the end and just show you how that's done in MetaStock. All very easy to use. So let's go ahead and dive in here and start with the question: can AI be used to trade more profitably? Okay. And, we were talking about this a while back in the office, and someone said, you ought to explain to people about this, because if you go on anywhere, YouTube or any place, and you search AI for trading, you're going to see all these videos about, I predicted the market today with Apple, with my neural network, whatever it is. What you won't find is, people saying, yeah, I'm using this every day and making money with it. It's like there's no real demonstration of that you get this proven, to work, and it's just very, very hard to find the applications. And it's curious because we all know that AI has advanced so much, especially in the past few years. So you kind of wonder, well, why is that? And so we're going to talk about that next year. But this is the sort of thing that you just don't see out there. This is MetaStock with our software that is using the artificial intelligence to identify these trading signals. And I ran a system test in MetaStock, and this is the performance of our system compared to, there's a bunch of experts in MetaStock that I ran against, and it was the most profitable. But this is the kind of evidence that you just can't find out there. And so, the question is why? Why is that the case? All right, let's talk about that. So, classic artificial intelligence. Now, this is what almost, I would say, every mainstream application of AI is based on this technology called neural networks. They've been around a really long time, and they're really good at certain kinds of problems. Really good. And now that they use like thousands and thousands of neural networks connected, for things like self-driving cars and that kind of stuff. But it's very, very good at pattern recognition. So I want to just show you, this is just a couple slides with the classic sort of a picture of how this works. We're not going to go into all the details of it, but just so you understand, I want you to understand why it's hard to use this technology for trading. That's really the point of this. So but here's a classic case. You have a cat or a dog, and you're trying to train this neural network, which is shown right here, to identify either one, right? And so the way a neural network works is you basically take this picture of the cat and you pixelize it. You take all the pixels and you line them up, right? Rows and rows and rows of pixels, whatever, it's like millions of them. And you feed them into this thing. And essentially what's happening is there are the values are coming in, whatever the pixel value is. That's called the input layer. Then they go into these internal layers. And it's like every one of these little circles is a place where a weighting factor is applied, and that is propagated forward to all the other circles in that layer. And then the same thing happens over here. You can see there's like a line from every one of these little nodes to every one of the other nodes in the next layer. And so what it does is it basically adjusts weights in here to identify, or to classify the image that it's looking at. So what you do is there's the cat. Okay. Yep. I forgot about that animation there. Okay. So essentially, okay. Yep. All right. Oh, I didn't explain this. That's why I had the circle on here, is that, so what's happening is, as you're feeding the pictures of the cats in here, a bunch of them, it's going to generate a score based on the weights that it's changing inside here. It's actually manipulating them, millions and millions of times. And until after you fed enough of them in there, essentially, so get another one there, you fed enough in, it will start to say that, okay, this path in this network is getting a score of a 0.98 for a cat. So the more that score approximates 1, which is a perfect score, the more it's seeing common things between all these pictures, and will basically keep getting bigger and bigger. So in order to use this kind of AI on the stock market, we have to use something about the market. Okay, we don't have a picture. If you think about it, looking at charts, I mean, my goodness, it's like there's an infinite variety of profitable trade setups. It's infinite. And so, you can't just take a picture of a bunch of trades and feed it, because the market is so complex. There's so many of them that, it's just impossible to do. So essentially, doing this job of predicting, like I see a trade here, the chart went up from this point. So what is that? And, can you score it? And like I say, because every chart looks different and every setup is very different at the pixel level, like a picture of a cat, it's just like an impossible problem for a neural network to solve. Now, people do use neural networks to to derive predictions from financial data, like econometric data or things like that. And there's some limited things you can do with charts, but I'm just saying it is just this enormous problem that is just very hard to solve with a neural network. Okay, so how do you do it? Well, we'll come back to that in just a minute. But before I do, let's look at the problem of classifying moves in charts. And what we do as technical analysts is we use indicators. And you know that there's over 100 in MetaStock. It's actually one of the most robust software out there in terms of the number of native indicators that it has. I don't think it's missing any. It's very, very robust. But you've got all these things, and what you want to do is figure out how I can combine this kind of information to make a prediction. Let's look at just one indicator. Okay, just one, just the relative strength index, which I think everybody's pretty familiar with. All right. If I look at that, we know that we have different periods for RSI. I've got the 8 period, the 9 period, the 10 period, and so on. So if I'm going to use the RSI indicator, I've got to select a period, and they all have different behaviors. All right. So if I'm going to use RSI, a value of RSI to predict a move in a chart, I've got to first pick that. Then I've got to pick the interpretations. And so, you can say, well, I'll use RSI 14. That's my first selection. And then it crosses through 0. It's above or below, above 30 or below 70. It's moving fast up and down. It's diverging. We use divergence a lot. There's moving average crossover and so on. So there's a very, very large number of interpretations of any of those 100 indicators. Okay. So if you have 100, right, infinite number of possible rules can be generated from these. You can see, it's just huge. The space is huge. So if you have just 100, 100 indicators, and like I say, because of the variation of each one, the actual space that you can look at, do you use RSI 10, 15, which MACD do you use, which stochastics do you use, which values, it's infinite, right? But if you just look at 100, not the infinite, all of them, but 100 there, and you look at, a situation where, let's say RSI 14 greater than 30. All right. That's a factor that I would feed into the AI that I'm going to use. That's either going to be true, it's going to be false, or it's going to be, well, I don't really care about RSI. Let's look at other indicators. Okay. Others of the 100. So that's 3 states, true, false, and I don't care what it is. So if you look at 3, to the 100th power, you get this huge number, 2 septillion possible combinations of just 100 indicators. And like I said, there are an infinite number that you can derive from the basic ones. So what we want to do is use artificial intelligence to search the space to find trading rules by combining these things together. And so, how do you do it? Well, the best thing that I know to use is artificial intelligence. And we're going to be talking about, specifically the kind of AI that we use for trading and explain why it's superior to the neural network approach. So to do that, let's look at a typical trading rule. So again, these are several indicators on this chart. And what I'm going to do, and this is how all of us make trading systems. We look at tons of charts. We say, we look at MACD, we look at stochastics, we look at momentum, moving averages, and we look for, well, when this one's true and this one's true and this one's true, you've got probably have a move. Okay, so let's look at an example here. So I can say, all right, we would buy when the Bollinger Band narrows and expands, right? Okay, so we observe that when that happens, the chart usually moves. That's a very classic signal on Bollinger Bands. We can also say, all right, but let's add something to that. Let's say, and the 20 period moving average is above the 30 period. We know that's an indication of trend, right? 2 moving averages. So we say, well, we want that, and we want this to happen. And again, this is from a human looking at tons of charts and just thinking, well, what about this indicator? So then there's momentum. So momentum is positive in the chart. That's a good thing. And finally, MACD is above its own moving average. This classic interpretation of MACD. So when all those things are true, we say there's probably going to be a profitable move. So that's called a trading rule. And that's what we want to find out there in the data is trading rules. And again, with just 100 indicators, we have many more than that, there's like 2 septillion combinations of those 100 indicators that you could try. You can't actually, it's too many. It would take you, I don't know, 100 years or something. You would never, even with a fast computer, you wouldn't be able to do it. So what we use, the AI that we use here for this, is something that can search through that space and efficiently find these rules and very quickly find them. And it's called a genetic algorithm. So if you look at a picture kind of what a GA, we call it for short, does, how it works, there's a population, then there's evaluating the population, and then these operations, mutation and crossover, which is why it's called genetic algorithm. So what are we talking about here? Well, these are 2 hypothetical rules, right? So the purple squares are the things that we're looking at in this particular one. Now there's like thousands of them. They're generated randomly. And so on this one, RSI greater than 14, MACD above its moving average, and momentum is positive. So 3, it's a guess. The algorithm just says, let's try this. And it does like 1,000 more of them. Then it evaluates every single one of these guesses as to which things will work. And eventually, it's going very, very fast. Eventually, it will find one that's profitable. Okay. So it does that and it saves it off. All right. So once it has said, okay, if you have that situation looking at millions of bars of data in the past, when you have exactly that, it looks like it's profitable, like 75% of the time, and it makes a couple percent. You go, oh, goody, I found one. So you save that off, and then you keep going. And so what's happening is it is taking pieces of one rule and connecting them to another rule that's called crossover, or just slightly changing values in here. Like instead of true, let's make this one false. And so over time, that process generates better and better and better rules. That's basically what it does. So we call it that the algorithm is evolving the population to get to the best possible outcome. And so it just runs. So all we have to do is put things in there. So here at the company, we put all kinds of indicators, hundreds of them, in each of these genetic algorithm problems that's running, and then it will find rules with those indicators and relationships. And they can be very complex, not just RSI greater than 30, but they can be this and this and this and with variations. So it's the nature of it is more complex than what I've described, but this is the basic idea, and it's why this technology works, because it's finding rules. We're not showing it a picture of the market or 1,000 pictures of the market or 1 million, because there's actually billions different like pictures out there, like a fingerprint. So we're looking for specific rules and testing them. Okay, so that's just an explanation of what it does and why genetic algorithms are better suited for this, because they can't find rules. So then what we do is we end up creating this thing called a knowledge base. And in the knowledge base, there's these rules that were found. And so what happens in MetaStock, which this is connected to, is it goes to every single bar, looks through the entire knowledge base of maybe 3,000 or 4,000 rules that it found, and says, do I have a match, for this particular idea, this particular concept? And so because each of these is seeded with an initial, like I'm looking for a pullback or something, and then the rules are generated on top of that. So it's looking at every single bar and asking that question, and when it finds a match, it will post a signal out on the chart. Okay, so Fulgent AI for MetaStock, just really quickly, and we're going to go and look at it here once I explain how it's set up and what it's doing. There is this engine that loads. You don't really see it. You see the interface to it, but the engine loads in the background, and it's just there, ready for MetaStock. So when you bring up a chart, MetaStock basically sends the entire data of the chart over. The engine looks through the knowledge base and all the rules it has, thousands and thousands of them, for every single bar in here, and says, do I have a match? And when it does, it comes back with, yes, on that bar, you have this particular expert is firing a signal. Okay. And so also then there is commentary showing you like what the rating of the signal is, because it's tracking the accuracy historically of that particular thing, that particular combination, that rule that fired. and how many times it occurred in the historical data. And then, what the profit per trade was, again, in the historical data, in the training data. So you have training, and then you have the real data. That's our out of sample. And we find that the correlation between the training data and the out of sample is very, very high. It's not perfect, but it's very, very good. It's much better than pretty much any trading system I've seen in terms of the accuracy that you see going forward coming from the training. Okay, so let's go ahead and go now to MetaStock here and look at it. And yeah, so I just ran exploration here to see what I would find there. Okay, all right, we'll go ahead and close that and go back to the chart. So this is what it looks like. And I can go to any one of these experts that's firing in here, and it will tell me, what the expert is. And again, these statistics on the rule that fired that volatility breakout signal. So when this is loaded in MetaStock, you basically can get to it by going to the tool menu. And this is, again, the guys at MetaStock really helped me make this work. I'm just happy it's in the interface. It's fantastic. So I can bring it up. And there are different Fulgent AI products in this thing. This is the engine. The one we're looking at is called FT Stocks, but we can create different versions. We can train it on different things. I'll be talking about that later, retraining for different applications. But FT Stocks is the one we're using right now. And there are 4 experts that come with it: major reversal, swing trade, volatility breakout, and quick move. And each of them works by getting a basic condition in the chart, like a basic reversal signal or a breakout signal from something very, very simple, like just volatility is increasing, the chart's moving up. Okay, great. So let's look at millions of those in the training and find rules around those points. So that's why there's 4 experts, because they're looking for different kinds of trades. So, and I can turn them on and off selectively. I can turn on longs and shorts. So it's really pretty simple. So you just activate those, they're on, and then they show up in the chart. So again, so I've got volatility breakout. I can click here on my swing trade. It says, swing trade. This is based on a Keltner channel crossover. So that is the initial condition that is used to train on. And it has moderate trailing stops that attempt to preserve profits. So this particular, the rule that is firing that signal right there, has a 76 rating. It occurred 214 times in the historical data. The more, the better. There's some of these that occur 500, 800, 1,000 times in the historical data, and that's really, really good. Average profit 6%. And we also track the stop in what's called a trade plan attached to this, so that you can see exactly every day where it's saying it wants to put the stop, and then it gets out up here. That's that red dot. So I can just go through some charts. We can look at them real quick. And it does take a few seconds for it to load the chart and display it, because again, it's going through thousands and thousands of rules for each expert. So the fact that it does it that fast is amazing to me, but there is a little delay as it's going through the knowledge base and finding them. But you can just see, so here's a volatility breakout signal that went to there, swing trade goes to there, major reversal. This is just, I'm just going through the Dow 30, right? From Apple to Amgen to so on. So volatility breakout, this one got stopped out. So it's not perfect. There are trades that don't work out. There's some things, and we have a very extensive manual with this that gives hints on using it. Like, for example, when you get a signal, see if you get some confirmation that the chart is turning in that direction. Just wait a couple bars rather than taking it immediately, because this rule is firing. It sees the right stuff for a swing trade right there, but the market's too weak and it just goes right past it. So there's just some tips and tricks in there about using it that help people be more more accurate, more profitable. Okay, let's go through several of these, look at them. All right. So again, volatility breakout here, swing trade, and so on. And really, there isn't much more to say about it. It just kind of does the job, and it's very simple. It gives you those stats, tells you where the stop is. Recent swing trade here was great. 75 rating, 200 occurrences, and we'll go through a couple more here. I've got some more things to show you about what's happening and what you can do with this. So, yeah, it's pretty cool. Especially want to show you about the retraining part of it, because that to me is the exciting thing about this system is, yes, we provide these, but the power that you have to do your own thing is really strong. So I want to get to that as quickly as possible. But then again, you can see these a little early on that one, came up a little early on this one, and there's that really nice trade there. Here, we'll go do one more. That's Boeing. See, so Apple engine, Boeing. What's next? Is it CAT? What is it? Yep. And there you go. So it's picky. It's looking, out there to find, the trades that meet those rules, and then it fires a signal. Okay, so let's look at here. Talked about all these aspects of it, clicking in there, getting the stats, very, very simple. And I talked about this earlier, is that we did do system tests in MetaStock against the default experts in MetaStock, and the score from Fulgent was very, very high compared to them. And again, you would expect that. I mean, it should be, it's AI, running to find these rules in the market, so you would expect that to happen. We also provide an Explorer where you can get an exploration. I just checked, I didn't see any out there right now. I just ran a quick one, but I didn't have any signals. But you'll see quite a few show up, both long, short, in long, in short. So if there's a signal that fired, let's say, 6-7 bars ago, you still probably want to look at it. And there's the number of bars is right here because it's in play. The AI was correct. It's moving. It's going in the right direction. And you can see other stats here, like the accuracy of the rule that fired in the historical data, the profit number for the rule that fired on that stock, and so on. So it's just very, very easy to click through these, look at the charts, and prospect for signals. Okay, so this is the part I was really wanting to get to because, again, I think this is the most powerful aspect of the whole thing for people who are working in the market and trying to get the most profit they can with techniques that they're using. So we do have the ability to select long or short. You can turn the short trades on, long trades. The market tends to be long biased. So by default, we have the longs turned on. I think one of the experts has shorts, the quick move, which is looking for a very short move, like about a 5-bar move. Those shorts are turned on by default, but you can change that. And also, as I said, activate specific experts as you learn to use them and decide which ones you like the best. All right, so that is that on configuration, and then there's this. Okay, as I say, I think this is the most powerful thing about it, the system, in that you can take any indicator you have, any signal, anything. Like this is just a simple example: RSI 3 less than 30 for a long condition, RSI 3 greater than 70 for a short condition. And so I've color coded where those are, all the short indications with the rule, long indications. And the reason people like RSI is because it does a pretty good job of finding these oversold situations, right? But it's not perfect. In fact, it's kind of far from perfect. You'll get false signals firing quite a lot, especially on the short side. It's saying, go short. I'm overbought. Well, yeah, you are, but you're still going up. So, but it's a good little indicator to plot. And this is very common. People put indicators out there on their charts that they look at, they go, well, it's not always right, but it's pretty right most of the time. And that chart looks really good right now for other reasons. So we use multiple things. So essentially what you can do is retrain those experts in combination with that factor that you like. And so it could be any signal, any system. You just go into, there's a file, you put that exact code in there. For my condition, RSI 3 less than 30, it could be close greater than the moving average. It can be volatility is suddenly increased or volume is increased. It doesn't matter what it is. The AI will then retrain the entire system on that condition. Okay. And you get this. So this is retraining the quick move expert, and signals were very, very good. So it is keying. You can see every one of these is happening at that initial condition that we're training to. And then, it finds a rule. It says, well, yeah, we got that. That's good. Now, what else is happening in the chart? Well, we came down really fast. I mean, like I said, there's hundreds of indicators being evaluated to find these rules, but that's the outcome. So you literally tell it what you want to train to, RSI 3 less than 30 for a long signal. Run it. It takes about I'm going to say maybe 20 minutes to retrain for a basic retraining. You can let it keep running overnight to find more rules, but that's about all you need. That's all this was done on, was about 15, 20 minutes. And that's it. And then you just activate that retrained version. It retains the original. You're making a copy internally. And so it will activate the retrained version. In fact, I can show you that again here. All right. So if I go to Fulgent AI here. All right. So in this, here you see FT stocks, SPX 30 minutes. So I retrained the system on that, specific index, and got some numbers out of it after retraining. So I can just activate that. Aside from this, these others are different ones that we've worked on. But as you retrain it to different things, it will create another copy. So you can have multiple different custom systems built around your indicator and the AI. Okay, so that is, like I say, to me, that's the sexy thing about it, that we provided that, or my programmers provided. They did a really good job. And this is just a system test on that very basic, RSI3 system that just takes all the signal all the times that it happens is not very profitable, which you would expect that. But with the AI finding rules around those conditions, it actually is. So imagine what you can do with this, with what you use every day. Okay. The other things about it, you can retrain on other markets. As I said, I retrained on SPX for that one that was you saw in the list there. But you can train on Forex futures, and it's the factors that are in the GA, the actual indicators we're using, were sort of oriented toward the stock market, but it will find really pretty good rules in other markets. So you can do that. You can also use it in real time, and especially real time stocks. Again, you just get the real time, you give it the real time data, you load it up and tell it, okay, train on this list. You give it a list, and you run the training exploration, and it does the training on the new thing that you're doing. Okay. All right. So that is that. Also, okay. So that brings me to just sort of a summary of what Fulgent AI is, and then I can take questions from anybody here. So it seamlessly is integrated into MetaStock. It's just there running in the system tray. You bring up the interface as I showed you to activate it. There's 4 experts included, and again, you can retrain it on your indicators, your symbols, your time frame. You just target that in the training exploration and get signals based on what you're doing. I mean, how you like to approach the market, assisted by the artificial intelligence finding rules around those conditions. And so the package has all this stuff. So this is about, Jeffrey, I need to turn over to you and let you take over here. You've got some great offers out there for folks, but it's pretty, like I said, easy to use, but very full featured in terms of what you get with it. System tester, trading exploration, a training exploration, which is just like exploring for signals, but instead of exploring, it actually tells the GA to retrain on the data that you're feeding it, the list you're feeding it. And we have updates and support. So that's pretty much it. All right. So Jeff, we're a little early here, about 20 minutes. I can go back to the software and we can go through some more charts. That's probably going to be interesting to people. So let me just close this and we'll just kind of keep going here and look and see what we got.
We have questions, so that's good.
Awesome.
Let's see. Let's see. I was going to talk about a sound issue, but I answered that by type, and probably wouldn't help if you can't hear to instruct you on how to fix not being able to hear, right? So the first real question, though, because some says is from Neil Harrington. Neil says, can you select an AI set for the type of trade you want? For example, I want to trade a future like NQ intraday for a profit target, or I may want to trade any and all ETFs for long-term growth.
Mm-hmm. So the different experts that are in here are designed for that kind of thing. And I'll go ahead and bring them up again. So you don't really have control. You can't set a target in the future, go out like 2 months and tell me what's the most profitable at that point. These things have trade plans built in them that have those kinds of exits. So it already has exits defined, and that's why we provide 4 different experts, because they're very different this way. So major reversal is literally looking for chart points that are really overbought or oversold, and it trains to those and has a very loose trailing stop so that it can let the trade breathe and run. If you're looking for a very short-term signal, like 5 bars out, 10 bars out, that's what the quick move is for. That's what it does. Volatility breakout looks for breakouts, and again, a fairly loose stop on it, but the exits are built into each of these. And so what you're doing is getting rules around those exits. So you would, if you want to trade on ETFs, I'll show you exactly how you do it. Okay, let's see. So you go over here to the Explorer, and you pick this one right here, Fulgent AI Stocks Training. Okay, training. And I can actually let this run so people can see it because we have some time. Let me, before I do that, let me go ahead and just turn on one of the experts so that it will just train one of them. All right. And when we get this going, Jeff, you can fire the next question. Let me just get it kind of started here. So I'm going to go into FT stocks and turn off the other ones. So don't train those. Let's do one on quick move. Okay. And all right. So I'll close it now. So I've just have one of the experts activated. And now I go into the Explorer and find the training exploration, which is right there. Okay. And you need to give it, enough bars to load to train on. So typically, a good number is depends on your list. Let's say we're going to train on the Dow 30, which is a good demonstration list. So let me. We could do any list, but this will just make it quicker for us to just show you what it does. So let's see, Dow 30 right there. Okay. And let me see, do I have any others activated? Yeah, I've got the SP 500, so we'll take that off. All right, so this is just 30 stocks. And I don't know, let's say, so Dow Jones Industrials 30, you can do any list you want. It could be Forex, futures, anything. And you can be real time. I've got daily here. So, but let's go ahead and load about, let's say, I don't know, 3,000 bars of data to train on. And that's it. So I start the exploration. All right. And so what it's doing right now is it's passing the data for the Dow 30 over to the engine. The engine's, again, running in the system tray in the background. So it's passing that data. Then it will start training. And we'll see it do it. It'll actually show you it training right here live. Here it comes. And you could, yeah, go ahead and ask. You got a question? We'll see it. We'll see it doing it. So.
Oh, okay. Let's see. Brad wants to know if there's an edge in using the program on an intraday or an intra-bar basis, like during the day.
Oh yeah, yeah. No, it's very good. We know that data and indicators are fractal. You can use the same indicators on weekly, monthly, daily, intraday charts. We do it all the time, right? MACD is great for any time frame. So with each one of these experts has a few hundred different indicator relationships in it, like volume relationships, basic indicators. It'll compare the chart to the index. There's an index that you provide in the little interface that comes with it. And so you can, any time frame is going to be the same. It's going to train to that time frame and look for rules based on those bars, what they look like and how they perform. So what's happening now is it is going through the data, and you'll see down there at the bottom it says MCD, saving samples. So MetaStock already passed all the data to it. That's what the exploration does. So that's how we do it. Just here's all the data. Now inside the engine, it is measuring hundreds and hundreds of indicators, all the ones that are in that expert, and saving off the measurements in the training data. So it's got 3,000 bars of the Dow 30, and it's literally going through all that data and calculating all these indicators so it can train, because it's got to have that information in order to train to it. So then it will create a very long guess, like you showed that long chiclet looking thing, and it'll turn on certain ones and say, okay, how profitable is this over all that data? So it's all in memory, and it goes through every single bar and says, evaluate this hypothetical rule. And when it finds one, then it will save it off. So it now has measured every single indicator in that expert, and it is creating rules right now. So far, it's created 180, 200 rules. Here is the accuracy of the rules. There are 70%, and this will continue to go up. So now it's got 240 rules, and it just keeps going. And it can go, like you let it run all night. At some point, it starts to slow down, but it's, it just keeps going. So, okay, next question.
I love watching that graph. It's so cool. And I'd love, and maybe you can speak to this a little bit. It's not a question that everybody have, but I read an article, and this was a long time ago, that talked about the benefits of AI testing as opposed to the other method, which you would consider a brute force testing. And just as some of the article is like, with AI testing, you could go through a whole lot better, broader of a universe of kind of things. And the interesting thing about AI is sometimes you end up in a place you didn't expect. I don't know if you have any comment around that, but
well, if you looked at the rules, it comes with the rules that you go, really? And so it finds relationships among these hundreds of indicators that you would never come up with yourself. And so, yeah.
Andrew wants to know, does this system provide crossovers on momentum and price indicators?
Good question. So I'm going to guess that you like that indicator, or that concept, and it is a good concept. So you would go, there's a text file, it's an indicator file in MetaStock, and remember when I talked about retraining? So you would train to that condition. Instead of RSI 3 less than 30, which was my example, you would say, what was it again, a momentum crossover? So MOM of whatever period, greater than the moving average of momentum, maybe, if that's the way you're doing it. So just that one little thing. And so this will train to that condition. It's wherever it happens. It'll say, I've got 50,000 cases where this happened in these charts. Now I got to find rules based on all the other stuff that's in there that you can't see. There's all these indicators that are being combined with that, but it has to have the thing that you want. It has to have that condition. So it's training to the other stuff. I hope that's clear.
That sounds good. It was clear for me. Carl wants to know, in what four market conditions are the four experts best and weakest?
Well, it figures that out. So it has market measurements built in. We use the index that's used in these is the SPX. You can change that. You can change. I say I want to use the NQ or the QQQ or whatever NDX. And so you can change that in that file, and I can bring it up and show you. It's very simple. It's just there's a place it's noted in the document around it, the comments. It's just an indicator file, and so you can say, no, I want to use this index or QQQ or anything. And so there's many factors, we call them, but they're just indicators inside there that refer to the market symbol. So it becomes part of the information. It's just it's just doing that. It's using the market information to come up with the rules. Some of them don't have it, some of them do. But what you can also do in your indicator that you're feeding it is have a market condition. Like, I only want to trade this thing when the Dow is above its 50-period moving average. So that's your little condition, and then you're training to that. But it will out. Yeah.
Oh, sorry.
That's okay.
Okay. Yeah. Powan says he can hear. So welcome to the conference, Powan. We're glad you can hear us. Hussein wants to know if you can look at Tesla with a quick move.
Well, let's see. Let's let this trade a little bit longer here. It's got 1,700 rules so far, above 70% accurate. And so, sure. Now, it is very picky. So there's some charts it just comes up with a few signals on it, because the objective is for it to find a profitable signal. So it really isn't going to say, okay, I think Tesla's going up right now. Its job is to find profitable signals. So it's not that, we'd all love a computer to tell us that and, accurately just say, well, I know what this chart's going to do, but that's pretty tough. So again, it's for finding signals, but we'll see. I'll go ahead and stop it. And here, all right, let's go ahead. We'll stop it there. Okay, it's probably going to retrain shorts as well. Okay. Now it's going through all the symbols to calculate. Let's see. Yeah. It generates a list of statistics on the rules that it's found it's doing that. It's only 30 symbols, though. It'll take a second. And then you'll see when it finishes, you'll see the copy that it made. Okay. See, it says FT stocks retrade, 78% accurate. It's pretty darn good. 2% profit per trade. And those are 5-bar moves. This is what the quick move is designed to do. So all I do is activate that. Okay. So it's active. If I go in here, I only see that one. That's the only one I trained was quick move. That's it. And of course, you can train all of them. It'll just do one after the other automatically. But so that's that. So now I've selected it. All right, I can do FT stocks or FT stocks retrain. That's how this works. You can rename this to, whatever you want to call it. Like I did up here, you just right-click rename. But I'll just leave it like it is, retrain. And okay, we'll close that stuff. And let's see. Now, how do you get the symbol in here, Jeffrey? I remember.
Just type in right now TSLA.
TSLA.
I think. Oh, did it pop up somewhere? There we go. TSLA. Yeah, and then I think it's .o. I look at Tesla every day, but maybe at TSLA. Let me look at my screen here. .o. Yeah, Tesla.o.
Okay. Awesome.
We'll get you the correct one.
All right. So now
I'm here to help.
Tesla and looking through all the rules that it has. So it found a nice 5-bar move here, and there's one here. It's pretty, data is pretty compressed, but when you look to the left. So again, its job is to find these trades out here. So it's not, and we didn't let it run very long, so it doesn't have that many rules yet. The longer you let it run, the more it's going to find rules inside this data. And but yeah, Tesla's been quite a stock for sure.
Yeah. It's one of those that you're like, are you still moving? What? Okay. Richard says, I'm a Fulgent user. Thank you, Richard. We appreciate that.
Awesome. Thank you.
He wants to know if there's a way to change the stop loss level from its default setting.
No, that's inside the engine. So and it's something we play with. Should we expose things like that, and it gets complicated? So it's set. Yeah. So that's the answer on that one.
Mohammed wants to know, does it recognize, now you do chart patterns really well. Does the AI engine do chart patterns? Does it recognize chart patterns in its sampling?
Well, so it doesn't have chart pattern code per se, but there are indicators that will come up with chart patterns, just the way they come together. So it will find them, but not the way you're asking about it. And again, if you have something in MetaStock that's doing that, like looking for, let's say, a range breakout or something, then you can enhance it with the AI to find signals around that. But the chart pattern engine that we have for MetaStock is it's all chart pattern code. That's all it is, and so it's specifically designed for that. But not this. It's more generic.
We're having some awesome questions today. I must say that I think we have an intelligent audience. No, I'm just kidding. I'm pandering. Let's see. Carl wants to know, is there some indications of cases where overfitting takes place?
We really guard against that. The engine, remember, we started this in 96, so we've been over 20 years working on it, 25 years. And so there are things in the engine, the way it works, that uses out of sample data. I mean, I'll just go into this a little bit because there's many different things because we have been working on it so long. With any optimization, as you know, you can overfit, you can overtrain. So the way you avoid that is by training on a lot of data, over a long period of time, as many symbols as you can do in one training run. And then internally in the genetic algorithm, it has, there's a process it uses where, let's say it takes a month of data and it trains on that month, and then it skips a month and trains on this month and skips a month and trains on this month. So it's actually then validating the rule it found on the other months, so that it's a walk forward inside the test data to make sure that it didn't just find something that happened a few times on this data, but it was bad over here. It's looking to look for consistency. So that's just one example of software that technology we have in here that is really trying to avoid that problem, and it does a really pretty good job. The rules tend to hold up for a very long time after they're identified. So, but yeah.
All right.
That's important.
I think we have time for one more.
Okay.
Yeah, they're really good questions. If we don't get to your question, give us a call. 800-882-3040. Does the engine use 64-bit or 32-bit, and does it use multi-core processing?
It does use all the cores in your computer for training. That's why it's so fast. You saw it making those rules. Think about it. It's doing like thousands of possible rules. Every time it ticked up in that little graph we saw, it was evaluating more than 1,000 of them, looking at all the data. And the way it does that is it parcels out that job to multiple processors. And that's how it's so fast. So absolutely. But it is a 32-bit application.
All right. Perfect. I think that's where we'll cut it for today. Ed, it's always so good to have you in the room. I appreciate you coming in and spending 2 hours with us this week. It's always great. I also want to say 1, 2, okay, 2 seconds. Good job, Kelly. I see how long it takes the lights to come on. Good job. I really appreciate the kind of pulling the technology into MetaStock and the work you've done. You're a pleasure to work with, and we appreciate kind of all the work you do with us. So
thank you, Jeffrey. A lot of fun.
All right.
I appreciate it too.
And I'm going to show people how they can get this. If, again, we didn't have all the time to get to all of the questions today. So if you have questions, please feel free to reach out to us. That's what we're here for. 800-882-3040, metastock.com/saleschat. If we don't know the answer, we'll go find out for you. So get in touch with us. I know there are a few that we missed. Unfortunately, though, we are kind of, we're always on time. Constraints here. So I'm going to go ahead and change the presenter to me real quick. And we'll go ahead and show my screen. I've actually been looking at MetaStock for a second. And let me see if I can find my slideshow real quick. And then while we're doing that, let's talk a little bit about the AI engine and how that works. So as Ed does, he does a great job. He showed how the commentary works with it, the system testing. He talked about the full market scanning. Well, this AI product is a product that we normally sell for $149 a month. And basically what we're doing as part of the conference, as part of the special that we're doing today, we're going to give you a $99 per month permanent price. So it's just a lease. If you decide you like it, if it helps you, you can just basically keep using it. If you don't like it, you can just cancel it anytime. So if you want to sign up for that, try it out, see how it works for you, go to metastock.com/conf-promo, or you can also visit us online at metastock.com/saleschat. So there you go. Thank you, Ed. Again, big, huge appreciation for all the work you do with us. You're great to work with, easy to work with, and a lot of fun. So, Kelly, are you ready to do something? I figured we should start giving away some prizes right away, Kelly. So let's go ahead and do that. I can't hear you though.
My microphone was having some issues there, so I apologize. Yeah, I'm here. I'm ready.
Should we give away some stuff?
Oh, some giveaways? Favorite part of the day.
Yeah. Now the list has grown a little bit. We have a lot of people more registering, if you can believe that. So I need you to pick a number between 1 and 11,848.
Let's roll with 9,800. 9,800. Boom, just 9,800.
Okay. All right, and that would be. Well, I'm going to give this guy's last name. Scott, because I'm sure it's his last name, right? It's Scott Z in USA. We're going to basically, should we tell him what he won?
Ooh, let's hear it. I'm excited.
Well, okay, so there's a little software program out there. It's called MetaStock. He won a copy of that.
Oh,
we're going to give
lucky.
him access to MetaStock. Which, if you haven't heard, it's won the Reader's Choice Awards 28 years in a row. Like, straight, in a row. It must be good, right? It helps scanning, test trading ideas, forecast prices. It can give you real-time alerts, commentary on signals. The pricing on it only starts at $59 a month, and we're going to give him the real-time version for 3 months. Guess what else we're going to give him?
Well, so first of all, he's getting $750 in value in software.
That is correct, because we're also going to give him Zenith. And with Zenith, you might have heard about Zenith. It's a product that they spent over $1 billion in designing. And it's supported by 3,000 or so reporters in like 300 different news bureaus. Really one of the best news providers in the world. And a competitor to really Bloomberg. It's really the same kind of data if you're a bank or an institution subscribing to go get data. We're going to give him that. Do you want to know what else we're going to give him?
Well, I have a question first.
Sure.
How is he going to learn how to use it?
Well, so then the other thing I'm going to give him is I'm going to give him 3 months of LearnMetaStock.com.
Oh.
LearnMetaStock.com. Wow. We had Kevin Nelson on here yesterday, and what he did was he spent and now we're talking about how to write a scan, and he does a really good job. But do you know that he has hundreds of videos on his website on how to use MetaStock?
I didn't know it went into the hundreds, and now I do.
Okay. Well, it goes into the hundreds, and we're going to give him 3 months access to that. We're also going to give him our white glove installation support, where with all new customers, what we do is we give them a phone call, make sure they understand all the tools, answer any questions, help them get installed if needed. We're going to give him that, and then in addition to that, we'll give him unlimited support help with our Utah-based support team. So it's a great package. We're going to give him all of that stuff.
He is a lucky guy. I'm excited for him.
Right.
I am. I'm excited for him. It's awesome. MetaStock is an amazing software.
We will need to call you Scott Z, though, and we will need to get a good last name, and we'll need to get a full address for you because of exchange requirements. We'll get in touch with you on how to get your prize. But congratulations. You should try this out. Actually, we are a little cheeky with the prize giveaways, but it's a great software. Try it out. There's a reason it's been rated #1 so long. So in any case, Kelly, I want to say thank you for your help.
You bet. And in just a moment, I would like to introduce the next presenter when you're ready.
Oh, here, I've got his picture right here. There you go.
All right. Well, I'm excited to introduce our next presenter. Let me talk a little bit about Jeff Gibby. Jeff Gibby, if you have not learned over the last 4 days, one is a MetaStock expert. He is going to show you some incredible things in MetaStock today, some things that you can do in MetaStock that you didn't know that you can do. But also, Jeff, over the last 25 years that he has worked here, puts his heart and soul into MetaStock and a lot of what MetaStock can do, and a lot of the systems and strategies that you're able to get for MetaStock are because of Jeff. He does an amazing job in working with our partners to help them develop their strategies in a way that will help you as a trader be better. So a lot of what you get and a lot of what comes from our partner relationships is thanks to Jeff. So not only is he an amazing presenter, but he does a lot of the background work to help you every day using MetaStock. So we're also thankful for Jeff for all of his hard work in putting together this conference. It is a lot of work. It takes a lot of time and effort to put it all together, to run it, and to make it run smoothly. So we are excited to introduce Jeff, let him be our next presenter, and learn from him and all the knowledge that he has. So let's go ahead and turn it over to you, Jeff.
All right, thanks, Kelly. Appreciate that. Before I get started, though, I do want to say thank you for Stocks and Commodities for sponsoring today's event. They have been supporting us for a decade or so now. We've been doing these conferences and these shows for over a decade. So thank you for that. We do appreciate it. It does help. And if you do a subscription to MetaStock, if you take advantage of any of the offers for MetaStock today, you're going to get at least 5 months of subscription to Stocks and Commodities magazine. If you do more than $300, they're going to actually give you 2-year subscription. That's Stocks and Commodities ways of saying thanks for coming. And again, they're great sponsors. It's a great magazine. Every month I get mine, and every month I'm able to learn at least a few more things I didn't know before. So there you go. Let's go ahead and start. as Kelly said, I'm Jeff Gibby. You probably are kind of getting familiar with me, let's say it that way. If you're watching on the phone, this question comes up all the time, and I usually try and kind of answer it a couple of times. If you're watching on the phone, you might just see my face. You can swipe left or right, and you can see kind of the graphics and that kind of stuff. So another question that comes up all the time is, for the conferences, is how can I get an access to all of the recordings? Some people want to come back and watch all of these great speeches, and we get a lot of people on our YouTube channel actually just watching the conferences, and you're welcome to do that. We make them available for free. All you have to do is go to youtube.com/metastock. You'll see all 4 or 5 days now, and you can just click on the video. We do, I do ask you to like and subscribe it, because it does help. It does help quite a bit, and we do appreciate it. So as Kelly said, I started here in March. It's going to be 25 years ago, if you can believe that. And you should be able to believe that, because like I'm losing my hair and stuff now. But I actually I started in inside sales. That was a lot of fun. I then did business development for probably about a decade, and that's where I met all of the people that are speaking today. Really set up relationships with people like Price Headley, Steve Bigelow, Peter DeLaw, Larry McMillan. All of these guys basically have learned a lot from a lot of people. It's been a really, really fun job. I really like the environment here. One of the things that we say all day long is that I'm really proud of the fact that it's been rated so highly for so long. And I also use it every day to trade. In fact, as soon as we're done with the demo here, I'm going to go look at my stocks and see how they're doing. So in terms of the heritage of MetaStock, when I started, it had been a Reuters company. That became a Thomson Reuters company. That became Refinitiv. About 8 years or so, we bought MetaStock, we bought MetaStock back from Thomson Reuters. They're now Refinitiv, but we've kept a really good relationship with them, which has been beneficial for us and for our customers. You know, we're able to provide data anywhere in the world. There's hundreds and hundreds of exchanges. There's literally 300,000 instruments or so in MetaStock. I'll show you the exact number in a minute, because I think that was a little high. But there's a ton of value that we get by being able to do that. And we do have customers all over the world. We have them in India, Australia. The things I'm going to show you today, I've shown to people in London. I've shown to all over the world. Of course, that was back in the days when everybody would travel. We just didn't sit in a room by ourselves and talk to a camera. But it's been a lot of fun. I enjoy working for MetaStock. It's a great culture. And I really also, the other thing that I like real quick, is I like the fact that they take care of their customers so well. Or that I should say, we take care of our customers so well. You know, we have all of our support team here in Utah. A lot of times we'll ask them how we did, and they usually get like perfect marks. There's whole weeks where they'll go where we get 100% on our surveys. So it's a good company. I like being here. It's a lot of fun for me. So that's enough about MetaStock. Today, you know, in terms of what Somewhere in the Rockies says, great presentation, thank you. Thank you for coming, yes. And Somewhere in the Rockies also asks, is this recorded? Yeah, actually you're on YouTube right now. So after you're done liking and subscribing, you can watch the rest of the video, and this will be where the video is for you. Just keep the URL, or go to youtube.com/metastock. Today, what I'm going to talk about, you know, yesterday we had, I think it was 2 days ago, we had Scott in here, and he talked about the forecaster. That's a really good tool. I've been talking about the scanner, and Kelly talked about the scanner and the system tester. One of the classes I like to do is kind of just to highlight some of the things there's a lot of things in MetaStock, and I think some of them don't get attention because they're just like, they've been in there for a little bit, or, you know, that people aren't aware of them. And so what I'm going to do is highlight some of the what I call the hidden gems in MetaStock, and show you exactly kind of a few things you should check out when you're new to your subscription. So the first one, wow, this slide got messed up. Let me see if I can fix this a little bit. That doesn't fit on the screen at all. Okay, well, it's not that important. We'll just go to the next page. The first thing I'm going to actually show, and we're going to play with your charts a little bit, is a trend following system. Actually, this is a system that was designed by Rahul Mohindar. We actually had him come and talk at our last conference we did in October. And the system I'm going to show you is called the Rahul Mohindar oscillator, and it's a trend following system. So it's actually the first one that I spent money on, or invested my own money with, is maybe a better way to say it. The genesis of this is Rahul Mohindar is one of our longest running dealers for MetaStock. He helps us sell programs in India. He does a lot of classes on CNBC in India and CNN in India, and he's been one of our most prolific dealers. He's our largest and our longest running dealer ever. And he's got about 5 offices in India, and the core thing that he actually does as part of his business is he teaches people how to trade. So what we did then this was a while ago now, I think this was MetaStock 10 if I remember right. But what he did was he was in the office. We basically said, hey, Rahul, show us what something that you're teaching customers. We were kind of interested to see what he was talking about. And what he ended up showing us was the Rahul Mohindar oscillator. And since then, not only have I traded with it, I've probably shown it 600 or 700 times, but I've shown it everywhere, like in all different countries. And typically what I'll do is I'll go in and I'll say, give me some stocks that you want to look at, because it's easy as a presenter for me to go in and find perfect examples. I could show you Tesla. It works really good on Tesla. I could show you Bitcoin, but I want you to get an idea of how well it works on kind of securities that you might be interested in. So if there's some securities you want to look in, I've got YouTube right here and I've got chat right here. Just type in a few of the tickers that you want to look at, and we'll look at your stocks. Because again, I could perfectly pick out some perfect stocks. You know what I mean? So as I said earlier, it's a trend following system, and like the trend is your friend and befriend the trend and all that kind of stuff. But what we're going to use it for, and I'm waiting for symbols. I'm stalling while you type in symbols for me. What you use it for, though, is, as a trend following system, what we want to be able to do is to be able to objectively identify the trend and what's going on in the trend. Okay, and that's really kind of the step that we want to do. The reason I like to show RMO so much is it's easy. So if I do my job well and I kind of explain the rules well, you'll understand how to use it. It's something that I think you can use out of the box with MetaStock, because MetaStock's a huge program. And I want you to give you something that you can look at. Neil, thanks for Pfizer. We'll definitely look at Pfizer. The other reason I like to talk about it is as objective. Okay, so at no point in the demo today am I going to be talking about, this. I guess right now we could talk about like what the stimulus bill is going to have on the economy, or what like the CCR bill that was going to have on the economy, or what the Corona crash was doing, or kind of what that stimulus bill was like, or name a crisis or anything like that. We're not looking at things like that because it's subjective. We're looking at objective. What is the trend doing? Everything we ask, we should be able to answer in a very, very easy way. And as long as I do my job properly, you'll be able to understand what I'm saying. It does employ solid money management, which I think is critical when you're trading. So I've seen it way too many times in the 25 or so years that I've worked here, where somebody doesn't have a stop and they buy a stock and they're really excited about it, and it goes the other way and they have no exit strategy. Don't fall in love with stocks. What we want to do is trade. And I would encourage you every time you trade, regardless of what you do, to have a stop in place, have an exit plan in place, and stick to that exit plan. I've noticed, that in my own personal trading, I take a lot of losses, but they're very little. And then those ones that really, really gain and make money are the ones that make those up. So have a plan and stick to it. Okay. Use solid money management, and RMO will do that for you. Okay. It's also pretty simple, and it works on a lot of disparate instruments. Again, I'll go into Australia in the before times, back when you could travel, and I'd be like, give me your stocks. What stocks do you want to follow? And we'd look at them, and it doesn't work on everything, but it works really well on stocks that have a tendency to trade, like Apple and Tesla, Bitcoin, and whatever you might want to call. It doesn't do as well on sideways stocks. And you can easily tell the difference when you start looking at the charts, because it's objective. Okay, the other reason I like to show it is it's a simple 3-step process. You These are the steps that you take, okay? All right. So if we want an objective way to trade with the trend, because it's our friend, we want to be able to identify the trend. Let's go back into MetaStock. I'm going to go ahead and close this chart here. File, close, click on no. And what I want to be able to, we got Pfizer, we got Apple. Gilbert, thanks for the, Greg wants to look at CVX. So let's just type in a couple symbols. We probably won't have a chance to look at all of these. I want to focus most of the time on making sure you understand the rules. And if we don't do your stock, but you want to see it with an RMO chart, metastock.com/sales chat will send you any chart you want to look at. You'll send you whatever time frame you want to look at. We'll send you whatever information you have. These guys are really good, and they'll take care of you. Apple.o, okay? KNX, BHI for Andrew, and then for Greg Lewis, CVX, Chevron. Okay, let's go ahead and open these up. I think I've got the symbols correct. What I'm going to do here, so this is just our chart our chart page. This in our Power Console. I've typed in, and you notice I just typed in a bunch of symbols separated by a space, which you can do. What I'm going to do now is I'm going to go down and I'm going to apply a template. And what I'm going to do, the template that I'm going to apply is called the RMO trade model. Okay, so right here, we're just going to scroll. It's going to be alphabetically. I shouldn't be having this hard of a time finding it. Okay, there it is. Okay, we're going to apply this template. We're going to look at daily charts. You can apply this to whatever time frame that you want. And let's go ahead and open them up. So again, objective, identify the trend, trade with the trend. Okay, so let's go ahead. Just going to take an eyeball look for these. And just choose one that I kind of want to spend a little bit of time on. We'll go ahead and go with Apple to start with. And although a lot of these actually do look good, we'll start with Apple. Okay. Okay. 3 steps. Number 1, we're going to identify the trend. Okay. The first trend that we're going to identify, we're going to be working with a long-term trend or a primary trend, a short-term trend, and a medium-term trend. Okay, the first thing that we want to do is we want to be able to identify the primary trend or the long-term trend. Okay, so what I'm going to do here is the indicator that Rahul put together to do that is what he calls the Rahul Mohinder oscillator. Okay, and it's this big green indicator that I made absolutely full screen. Now, one of the things that I want to say that Rahul does a better job of talking about this than I do, but one of the things that he talks about when he talks about it is he wants you to keep this simple. Okay, so if we're looking at this oscillator, it doesn't matter how far above zero it is or how below, the shape of it doesn't matter. There's really one thing that we want to look at when we're evaluating if this is in a bullish trend long-term or if it's in a bearish trend long-term. Bearish trend long-term. Okay, and that is it above zero or is it below zero? So like I can just put a bullish line right here or a zero line right here. If it's up in this area, we're going to say that it's bullish up here. So if it's down below, it's bearish. Okay, and again, this is the longer term trend, and we want to trade in conjunction with it. So step number 1, if we're looking at Apple on this hard right edge of the chart, which is really where we have to trade, right? We're going to say that for the most part, I'm going to zoom in just a little bit here. For the most part right here where we've been bullish, there's been a little bit of area or a little bit of region right here in October that was bearish. Okay, as long as it's bullish long term, that means a couple things very specifically for us. We're allowed to go long, we're not allowed to go short, and it's not a trigger. So in other words, just because it goes from zero from down here to above here doesn't mean we would buy there. What we're looking for is, okay, step 1, is it bullish long-term or bearish long-term? And it gives us permission to go long and gives us permission not to go short as long as it's above zero. Okay, if it's down here, it's just the opposite. You're allowed to go short, but you're not allowed to go long. Okay, so it's very easy. And again, it's very objective. Hopefully, I could ask any one of you, people that are listening, and you would understand. So I'm going to go ahead and answer this poll that Kelly just put up so that I can see the questions again. So, and if you do have questions as we go, please let me know. Okay, so right now, Apple, we're bullish. Okay, long term, that means we're allowed to go long. That's step number 1. Step number 2 is we want to identify what the short term is doing. So to do that, what I'm going to do here is I'm going to look at what Rahul has named swing trade number 2 and swing trade number 3. Now, there's one way I like to kind of change the default view here that I prefer a little bit, and I'm going to make that change real quick. One of the things I would say, especially if you're new to MetaStock, anytime you want to change something, just double click on it. The program's been designed to be click and pick, drag and drop. It's actually pretty easy to kind of, we've tried to engineer it on purpose so that it works like other Windows applications. So I'm gonna go ahead and basically make this into a line. I'm gonna go ahead and click on OK. And this is actually my preferred view. Okay, I'd like actually to see this blue line as a line. The line though that I'm gonna focus on right now is the pink or the purple or whatever color this is, fuchsia. And we're going to analyze it. We're going to use it the same way. I want to point out, though, that it's actually a lot more erratic than the other one we were looking at. It moves around. It's a lot more receptive. The reason it does that is we're looking at the short-term trend of Apple. Okay, so it's going to be more receptive to price. The nice thing about this indicator, though, is we read it the same way. So if I'm looking right here at the hard right edge of Apple, I can tell you that it's above 0, which means from a short-term basis, we're bullish, okay? This is also indicated on the chart. So right here, if you look at the color of the chart, as long as this is above 0, it's gonna start to highlight your bars blue, okay? The same thing, I forgot to mention this, when the RMO is above 0, it also gives you a ribbon down here that says it's in either a bullish or a bearish phase. So very, very easy to read. You could look at the indicator or the ribbon. You can look at this indicator or the color of the bar, whatever you're most comfortable with, but they're telling you the same thing. If this is green, long-term we're bullish, which means we're allowed to go long, okay? If the bar is blue, which it is, we're allowed to go long, okay? They have to match. We want our long-term and our short-term trends to match. Okay, so as long as this is bullish and this is bullish, we're allowed to go long. Okay, step number 2. If they don't match, well, then we're allowed to wait. You can use the scanner. I might have mentioned that I really like the Explorer in MetaStock, but you can use the scanner to find better opportunities or stocks that might have an opportunity today. If this doesn't match, if you're bullish up here and bearish down here, the market's indecisive. One of the biggest lessons I've learned was from Steve Bigelow. Don't trade indecision. You want to trade the decisions. So we want to wait until kind of long-term it's bullish and short-term it's bullish. Okay. The third thing and the final step that we're going to look at is also this blue line. Okay. And this is the only way where we kind of diverge from the rules. Before, we're just looking to see if it's bullish or bearish. With this one, what we want to look at is what Rahul calls a change of force, of a change of momentum, or a change of direction, okay? And you might have guessed, the red line, or the pink line, what we talked about earlier is the short-term trend. This blue line is the long-term, or the medium-term trend. So with the medium-term trend, we're not as concerned about whether it's above 0 or below 0. What we're looking at is to measure a change of momentum or a change of direction or a change of force, okay? And to explain that, basically, if you look right here on the chart, okay, we get a little bit more bullish. The price is starting to go up. When the short-term trend crosses up above the medium-term trend, or when the pink line goes above the blue line, you're going to have what Rahul calls that change of direction, or that change of momentum, or that change of force. Happens right here on the chart. Okay, actually no, it happens right here on the chart. Okay, if I look at that, when that happens on a chart, it gives you a buy signal. Okay, see that buy signal on the chart? That's because that cross happened. Okay, that's all it is. If I look to the next time when it crossed down below, that's a bearish shift of momentum, or change of direction, or change of force, and you get a sell signal. And here, likewise, you get a buy signal. Okay. When we're trading, we want all three of those to match up. So we want this bullish shift in direction. Okay. But if we were looking at this bar, I'm going to zoom in a little bit more, which is easy enough to do in MetaStock. If I'm looking at this bar right here, I'm not going to trade this because we do have that shift of momentum, but we're bullish long-term, but we're still bearish short-term. So we'd actually wait to this day to kind of structure that trade out, okay? Here, if you look at this sell signal, you're bullish long-term and you're bullish short-term. You've got no business trading short right there. So at that point, we're not going to trade. Okay. Here we have everything lined up. You've got a buy signal, which is that shift in force. You've got a long-term bullish line and a short-term bullish line. So you're allowed to go long here at this particular trade. Now I'm going to just check to see if we have questions. It's fairly clear, but if you do have questions, please ask. We're going to start to talk about how you trade when everything lines up. And so, but I do think it's fairly clear. I don't see any questions. If you do have questions, please ask. Please chime in. Okay. All right. So let's kind of talk a little bit about a bit of how you would actually go in and trade this on Apple. And I think to do that, I know I could come back here if I wanted to. No, I'm going to start from kind of as recent as we had. Here we had a bit of a shift, a little bit of some sideways action. You went bullish, bearish, bullish, bearish, bullish, and here it finally kind of settled into a trend. Okay, so here is where we started to go bullish. Let's say we were starting to look at Apple right in this period. Obviously, like what we're going to see here, you just kind of go day by day. Here we were bearish long term, we were bearish short term. There's no triggers or trades, so we would wait. Okay. Here the next day you're bullish long term, but you're bearish short term, so you're going to wait. Okay. Here, pretty interesting. We had that shift of momentum I was just talking about. So you get the blue bar. You're bullish long term, but you still don't have that trend. We want to wait. It would have been, in this example, really good to buy here instead of the next day when everything matched up. But that's not the rule, so we want everything to match up. Okay, and I think what I found over the years is by following the rules for RMO, you're never going to get in at the exact bottom or out at the exact top, but you're going to be able to maintain stops. We'll talk about that, and you'll be able to take really good chunks out of existing prevalent trends. Okay, so right here we finally get to a day. This is October 18th. We finally get to a day where we've had that shift of momentum yesterday. We're bullish long term. We're bullish short term. Everything's lined up. We can take a trade here. There's two things that we're going to do here. We're not going to trade just yet. Rahul wants us to wait for one more confirmation. And the way that we'll see when that happens, he wants it to start to go up above kind of where it's at right now. So what I'm going to do here is I'm going to actually look at the high of this bar where we're going to decide to go long, or where everything matches up. You look at the high of the bar before. I'm going to say, hey, out of these two bars, this is the higher one. Okay, I'm going to enter if the stock goes above this high. Okay, and I leave just a little bit of white space. I leave just that much white space on my chart when I'm kind of trading with this methodology. The next thing that we want to do is we want to put in a stop loss, because money management is important, right? Don't fall in love with your stocks. Get out of them. Cut your losses, let your profits run. Everybody is, the people have been saying that all week, right? So there's two ways that Rahul will tell you to put in a stop loss. I'm going to teach both of them to you, and then I'll tell you the one I prefer. Okay. The first way is if we look at the low. So again, this is the day where everything lines up. If I look at the low of this bar and the low of this bar, this one is slightly lower. I'd put using that first method, I'd put a stop loss here. Okay, so in that particular case, you'd have a stop loss of about 142. The way I prefer is what I'll look for is a recent pivot low. And if you're not familiar with pivot low, there's a very simple concept. What I'm going to look for is a low that's surrounded by two higher lows. Okay, so if I look right, let's see, going back, this is the first time that you have a low surrounded by two higher lows. Okay, so this I would use as my stop loss. Okay, you've got the low here, you've got a higher low on both sides of it. That's where I'm going to put the stop loss. Okay, I like to give, and this is something that's a little bit, it depends on how much you like. It's also something I would encourage you to play with and to try. Okay, I'm going to get in right here at 147.38 or 03. Okay, we'll put that price right here using the text tool, 147.03. Okay. You might prefer a tighter stop. I prefer a bit of a looser one. You play with it. See what works best for you. See what works best over time. Come up with a matter. For me, I really like giving it just a little bit more room. Okay. let's see, right here, our stop loss is going to be at 138.82. Okay. A couple things about stop losses. It's not negotiable to 82. You'll want to get out. It might pull back and go back in the direction. That happens all the time, right? But you want to get out, because what if it keeps going in the wrong direction? When are you going to make the decision? Also, I like to put them under this level because this is a support zone. So if that fails, it's likely to go further down. Okay. The other thing is if we did stop out, we didn't in this case, but if we did stop out, the market will let us buy this again if we feel like it's going in the direction, or we feel like we made the wrong decision. I'd always err on the side of caution. Get out when your stop's hit. You can always decide to get back in. And in a day where if you're trading stocks and you're not paying commissions on those stocks, you can always buy back in. The market will let you do that. You can't go back after a 50% loss and get your money back. So you can always buy back in. Okay. It's not a big deal. The other thing that I know right now is I know that if the stocks goes down or up above 147, I'm going to buy. As soon as that happens, I'm going to put in a 138 stop. I know what my risk is. I'm going to get in at 147. I'm going to get out at 138. It's very, very mechanical. I know that in this case, I'm going to risk about, 9 points? Just maybe a little bit over 9 points on a $150 stock. I know what percentage that is. I can calculate that out. Okay. In this particular case of Apple, we do kind of pop up above that. It does go. It's been going sideways. Apple's been going sideways up. A lot of stocks were in through October and November. You can kind of see that it just hasn't been doing anything too exciting. But we can kind of be patient because we know what our stop loss is going to be here. Okay. Here we come in and we get that, give me my line. We get that change of momentum and that change of direction and that change of force. Right here, you had kind of that happen. That's what's giving us a sell signal on the chart. When you're in a long position and you get a signal in the other direction, you don't really do anything right away. You do want to start to pay attention, because if we go bearish long term and we go bearish short term, you'll want to look at reversing, right? You'll want to get out immediately. But the market, most stocks are going to move up a bit and then down a bit, and then they'll move up a bit and then they'll move down a bit. They don't go in a straight line. It'd be easy if they went in a straight line, but we want what will happen is generally more of a store step or a wave pattern. You're not going to have that kind of straight line. Okay, so it comes back down. It's still in a bullish trend long term. It's still in a bullish term short term. It sets a new bit of a support area here. And you get this pretty dramatic shift of momentum right here. You can see where this signal came in just a few days later, okay? And then it started to shoot up. Now, when you're in a long position and you have kind of that stair step and it comes down and it sets a new floor and you get this new buy signal, there's two things that you can do. One of them, two things that Rahul teaches you to do. If you want to buy more, you can. Okay, I typically don't. I like to buy them all back down here, the positions that I'll get in. I usually buy in and then I'm in, and I usually don't stage in positions like that. But if you like to, you could buy another set of shares or another option contract here. That's optional. The thing that's not optional, and the thing that Rahul wants you to do, is think about it this way. We just set up a new support zone. We had a bit of a pullback. Some sellers came in and more buyers came in. We set up a support zone here. What we want to do is we want to move up our stop. Okay, and that's what we're going to do. That's not the optional part of this rule set. And the way I'm going to do that is the same way I did it before. Okay, here's the buy signal. I'm going to look back in time from that buy signal and establish where's my pivot low. Okay, and once I find that pivot low, I'm going to put in a stop. Okay, from it. So just looking back in time right here. This is a low. This is surrounded by two higher lows. I'm going to put my stop loss right here. Okay. Now, actually, it'd probably be a little bit lower. It might be even at the buy point. Okay. Actually, in this case, it would probably be the 147.03. So now Apple's starting to kind of shoot up. Okay. We're at 147.03 is our entry price and our stop price. Right now, it's at 159.70. That's 15 minutes ago. This is delayed data. On this particular trade, we're up about 12 points. Okay, on $150 stock, that would be roughly about maybe 9%. Tell me if my math's wrong, Kelly, because I'm just making it up. Ghana says, why is there no arrow at the previous buy? That's a good question, and there was an arrow, but I want to be. I love the question. Right here is where we bought. Right, there's no buy arrow there. Okay, here was the arrow. Okay, so the thing is, Ghana, and this is a really good question. We don't necessarily need all three of these conditions to happen at the same time. Okay, they can be several days apart. We do want them all to happen before we buy, but we got our buy arrow this day. Okay, but the reason we didn't buy on this day is because short term we were still in a bearish zone. Okay, so it wasn't until we went from the bearish to the bullish short term that we went in and bought that trade. So that's a good question. Appreciate that. Okay, I'm gonna go ahead and post that in so everybody can see it. Here's the arrow. We bought here because we're not going to buy into weakness. We're not going to buy into weakness. We're going to buy into strength. We're not going to buy into indecision. We want to buy into the decision. Okay. As far as it goes right now, 159 would be kind of the price that it sits at. Okay. Right now, my stop would literally be at 147. What's going to happen is it's either going to keep going up or it's going to go down or it's going to go sideways. One of those three things is going to happen. But if we start to see some weakness, what we'll probably see is another stair step up. It'll come back and we can move the stop. And it's really that simple. There isn't anything right now on this particular stock. We're up 12 points, 13 points almost, right? We're happy with that. It's not. There is a saying, it's called, there's old traders and there's bold traders, but there's not any old bold traders. This isn't that sexy, really. And you're not going to an amusement ride here. I like to go on amusement rides. They're pretty fun. I love the roller coasters here at the lagoon. But for this, when you're trading, it just shouldn't be. You should never have enough money invested that you're nervous or can't sleep at night. And you should just treat it like a business, and it should be relatively not sexy. Okay, so in any case, let me zoom out a little bit here, and we'll just kind of look at a bit of a bigger picture. Hopefully that explains kind of how the rules all work. Okay, and we'll just kind of take a look at this right here. And just to kind of give you an idea, here we had this bit of a sideways pattern. If we would have followed the rules though, let me just go ahead and kind of take this off of here. Okay, I do think I'm just kind of cleaning up my chart a little bit. Right here, we had a bit of a pullback in Apple. And there's probably a pretty good decision to go short here somewhere, right? But if we were following the rules for RMO, and again, it's a trend following system, this thing was bullish all the way until October, okay? If we would have gotten into a position, if we were looking at a position in October to go short, we never would have gotten into it. This is the first bar, everything matched up, okay? If we would have put it in entry level right here below that low, it never would have hit it. So that additional confirmation that Rahul's looking for works over time. It doesn't work every time. Sometimes you'll trigger into a trade and it'll go straight to your stop. I'm sure you've experienced that. It happens, right? But in this particular case, because we were patient, because we waited, we did not take a losing short trade here, okay? On the other hand, though, if we look at this particular move up that we had to the north on Apple, right here is where everything lined up, okay? You went from bearish to bullish. You went from long-term. You went from bearish to bullish short-term, okay? And you had your crossover signal. So the first time we'd ever take a trade here would be right here, okay? That's where I would have put my entry level, give or take, and looking for a pivot low before that, probably right about there, right? That's the first bar I see where you have a pivot low, a low surrounded by two lower lows, okay? If I wanted to be give it even more room, I could go down below this support area. But for me, typically, I always go with the most recent pivot low, okay? So in this particular case, I would have bought in at 131. I would have put a stop loss in at 125, would have bought here when it finally penetrated several days later, okay? Went up, I'm happy, okay? Comes back down a little bit, stair steps, okay? We get a sell signal, here we get a buy signal. What does that mean we're gonna do? going to move our stop, right? So we're going to go ahead and put our stop right here. Okay. It didn't hit that stop. Okay. Here we have another bit of a sideways action. It's starting to kind of lose momentum. And that's okay, because as that happens, we will continue to inch our stops up every time we see a new buy signal come in. So right here, probably looking here, maybe put a stop loss here, which we would have triggered out of. Okay. Or maybe we gave it a little bit more room and put it here. I would have put it here. Okay. I would have stopped out in a couple of days, considered probably bought right here, and had a losing trade. Okay. But that's two really good trades, one losing trade. It's not going to work all the time. The important thing is what we want to be able to do with RMO is trade with the trend. So one of my favorite speakers, and he was way better of a speaker about this kind of stuff than I am, but his name is Robert Deal. And he was, the reason I think he was so good at it is he was the son of a preacher man, and he would get up and using his son of a preacher man's skill, he would say, that bulls will make money, bears will make money, pigs will get slaughtered. And it's always kind of stayed with me, mostly because of the passion in which he would say it with. But in this particular case, what we're looking at is let's identify the trend and let's take really good, safe, secure trades against the trend. We're not going to you're never going to get in at the bottom with RMO. It's just not how it works. You're never going to get it out at the top. That's not how it works either. But what it's going to do is it's going to effectively allow you to hopefully take really good pieces out of the trend. And it works really well for doing that. It's worked I remember 20 years ago, I was showing Apple charts in Silicon Valley with an options group that we worked down there, trading options for profits. Great group. If you're in that area, you should look them up. They may even start doing some in-person events again in the future, hopefully the not too distant future. So anyway, with Apple, other thing I'll point out, and we're going to go, oh man, we're doing great on time. We're going to go a little bit faster with the other examples because we are 42 minutes into this. I want to point out that right here during this upward move, we went from a price of Apple from 124 to a high of right here. Apple, yeah, never mind. I'm not going to say that because Kelly will come on and read the disclaimer. Apple looks like it might be breaking, not a recommendation to buy. But to right here, okay, we went from what was the low here? 124 to a high of about 157. During the most of that rise, all we're doing is we're only taking long trades. And I'd say by itself, even just incorporating maybe the RMO into what you're already doing, I've had a lot of people that have done that over the years, will improve your trading. Because if we're only looking to go bullish while this market is rising, I would say that by default, that's going to help you improve your odds. Okay. And this does work really, really well. Let's look really quickly. Sorry we spent so much time on Apple, but that's usually the way it goes. Let's take a look at Pfizer here. Pfizer's been a real interesting stock, especially in a Corona day. But take a look here. Again, what we're looking at is kind of the major moves. We're never going to hit the bottoms or the tops, okay? But if we just look at where we go from bullish to bearish, okay, you're just going to be looking to go long here, okay? During this last little run that we've had, we've only been looking to go long from here, right? So generally, I'd say by using stops, putting the odds in your favor, and trading in the direction of the trend, those are kind of core to helping you be better and more successful. Okay, let's look at Night Swift. I haven't looked at Night Swift, I don't think ever, but let's take a look at it with Night Swift. It looks like it's a little bit more of a volatile stock. Okay. And it's been pretty sideways, which is hard to trade a trend following system when things are going sideways, which does happen. Okay, but this last move that we've had, okay, has been pretty good. It had a pretty good bullish. I would say just kind of looking at this, I wouldn't trade this with RMO. It's just too sideways. We've had a pretty good bullish trend, but it's a little choppy for it. And you kind of get an eye for these things when you've looked at stocks for a long time. But there's better stocks to put your money in. Not that it did poorly. Look at this good move up that we've had, right? We had a pretty good move here. Again, it's just, it doesn't work on everything, and that's okay. We only really need it to work on a few things, right? All right. Vagana says, we have a few comments. Anne says, I got PXLW from Armo set up a few days ago, still in price. Doesn't go straight up. You do need patience. Yeah, that's true. I'd agree with that completely. And sometimes you'll sit in a trade for a little bit, and as long as you don't stop out, it's okay. So, but yeah, it does require patience sometimes for it to kind of get momentum. Ghana says, so we don't really need the panels at the top, right? We can just look at the signals and the arrows. That's exactly right. You don't. Now, one of the things I didn't talk about, and if you want to be a little bit more aggressive in your exits, you can incorporate this. And I think we'll just talk about RMO today, just because looking at the time, I filled the whole hour with it. We did talk about dynamic trading tools after Osco talked. I love that tool too. That's a great for finding breakouts. If you want, we'll find the video for you. It was pretty good. That's actually a really one of my favorite tools is that dynamic trading tools in MetaStock. The other thing that you might want to incorporate with this is the exit swing signal. I didn't talk about it. If you want to kind of get let's say that you're really deep in a position that's made a lot of money and you want to get a little bit more aggressive about exiting, you can use this as a way to do that. The way you would do that, or the way that Rahul teaches it, is if you're in a long position and it comes down, I love it when I get hiccups, particularly in the middle of a presentation. If it comes down below the blue line and starts to go up, you can start to trail a stop. Okay, so typically, I don't use that at all. Just again, I look at the market when I can. But if we were up here and we didn't like the fact that our stop was all the way down here, or if it was even further, could wait for it to kind of go sideways a little bit, which will cause this to dip down below and go back above, and then we can start to trail a stop. Okay, I don't use it. If you do use it, I would recommend that you get in touch with our sales team and have us send you one of the videos, or just go to youtube.com/MetaStock. That's a great site. We've got hundreds of videos up there. We did a bunch with Rahul that talk about this. Have him teach you how to use the exit swing, and actually have him teach you how to use everything, because he developed the method. He's better at teaching it. It's just a method that I think is one that needs attention. One of the hidden gems of MetaStock, if you would. So there you go. Looks like our next speaker is here. Let's go ahead and I'm just kind of taking an assessment for time. I'm going to show you something real quick. This is also, there's a story behind this one, because I think we can squeeze it in. And I don't really need to go into too much detail for it. And yeah, it is something you can just apply to the chart and see if you like it. So a few years ago, in the before times, when people were still traveling around, I was down in Australia. I met a guy that I really like. His name is Gary Burton. And he was doing some work with the Australian Technical Analysis Association. And I was like, oh, that's cool. I met him at a trade show. That's how I met him. And I was like, that's really, really cool. What are you teaching people how to do? And he talked about this Haguro method. And it's designed for weekly charts. It was a class he was teaching. So Gary Burton was the person that gave me all the information. But the person that invented the methodology, his name was Siki Shimzu. And he went through, it's basically a method that can kind of help you get an overall forecast for what's happening in a weekly chart. I'm regretting actually going into this, but you should look at it. It's cool. I'm just not going to be able to do it too much justice. What we ended up doing was we actually went in and coded the Haguro method into MetaStock, and we gave it to all of his students and all the people that he worked with that like to use it. Siki Shimzu basically, it looks at candlesticks, but he had a way of classifying each individual candle line. And you'll see basically here, there's a 1 through 16. He classified each of these lines on a weekly basis and kind of wrote a forecast. And there's things that that are important, like the midpoint, like where it is in the middle of a bar and that kind of stuff that you want to really kind of look at the expert advisor and kind of study it a bit, because the commentary will point this file out. But all of these lines basically have significance when you're going forward into the week. So I'm just going to show you this real quick. You can play with it in MetaStock if you want to. Right now, we're still going to look at Apple. And what I'm going to do is I'm just going to switch to a template that's called the Haguro template. I like this so much that I convinced the programmers and the people here to include it with every version of MetaStock. I called Dennis Peterson, my friend that worked for Stocks and Commodities at the time, had him do a review on it. He liked it so much he did 2 reviews on it. And it's just something that it's a hidden gem of MetaStock, if you would, right? So I'm going to go ahead and apply this. We won't get too deep into it, but I'll just explain to you what's going on. Right here you have a bit of a range. Now it looks a little messy. I'm going to zoom in a bit so it doesn't look quite as messy. This we need to look at as a weekly basis, okay? Right now we have a 2 candle. See, all of these are being identified. The important one is 3. You see how we had a 3 on a weekly basis before Apple started to run up? The core candles are 15 and 3. See, we had a 15 followed by a 3 followed by a run up. These are the core. Look at that 3 right before the run down. Look at this 3, 15, 1. Now these are, in a nutshell, like hammers, right? But they have a bit of a different meaning the way Siki Shimizu wrote them. If it's above this level, it's more significant. If it's below this level, it's more significant. If it's between these 2 bands, this just measures how far we are in range. And the further we are extended, the more significant it is. Okay. This midpoint is support or resistance, depending on whether you're above it or below it. Okay, so if I wanted to go in and just kind of get an idea of what this 2 candle meant, this is a 2 candle, okay? It's going to tell us the range of this stock is more than 7%. This means that the candle lines are more significant. Candle 2, when this is a long, this is a long line at the midpoint, is set for any support for future candles. So you'll notice that we moved the midpoint here to this candle because it's long, okay? This is now, going forward, this is what we're going to call support, okay? Concerning line 2, there appears at the outside in the rise of a trend after a fall in prices. Wait for next week's price to open above the midpoint of the line. So what we want to see next week, this will be bullish if this happens next week. If it opens above this line, we're going to call that a bullish signal. And again, this is where we would close any positions because that's our support level. Okay, there's a whole bunch more on it. If you go to youtube.com/ I think we need to stop there. But if you go to youtube.com/metastock and search for Haguro, you can kind of get some full videos where we've done with me and Gary Burton, or just me. There's a lot of videos up there that'll walk you through this whole method. Right now, what we're seeing, just look at the 3s. You had 2 3s here, a run up in prices. You had a 15 and a 3 and a run up by prices. You had 3 3s and a run up in prices. It's not perfect, but it does do a pretty good job of helping you provide a support level going into the following week. And in addition, identifying some of those key turns or those key points in the market. And that's what it's designed to do. Okay, so go to YouTube if you want to see a full video on that. Play with it. People really like it. I met a guy up in Canada, again, in the before times, that he's like, all I use is Haguro and RMO. And it really works well for me. So give it. I'd recommend, this is a guy, I think we were up in Toronto at the Money Show up in Toronto. He absolutely loved it. Play with it. If you like it, you like it. If you don't like it, there's a lot of stuff in MetaStock. I like this class because I get to go show the stuff that I like. Ghana, I will find that dynamic trading tools demonstration. I'll find the timestamp for you. It'll be after I hand over to Jerry Allison to talk about taxes, but I will find the exact link because we did spend a good 30 minutes on it just a couple days ago. After Oscar, I'll find it for you. Andrew's like, great info. I'm glad you liked it, Andrew. So anyway, play with it if you like it. I liked it enough that I made Kelly and the programmers over here included in every version of MetaStock, which you can say that also about the dynamic trading tools. So this talks about how you want to determine significance. This talks about how the blue lines are more. Also, it's significant when you cross that midpoint. So if you go from support to resistance, that's significant. You definitely want to, if you're in a long position and go down through support, you want to get out of it. So, but watch the video. There are a lot of things in MetaStock, one of the things, there's things in MetaStock you'll never play with. That's why I like to do these hidden gems of MetaStock, because I can highlight some of the things that you may not have even known you had access to. But the reason I put this on here, I actually put this on the slideshow for the very first time, just to kind of give you the extent of MetaStock. We see so many software programs that come in and go, hey, we're giving you a free indicator. It's just free, and you're like, no, thanks. There's 8 mathematical functions. We've seen a lot of software companies come and go. One of the things I love about MetaStock, and I've said this for years, I don't think it's ever a product that you're going to outgrow. And that's okay. You're never going to use all of the stuff that's in MetaStock. You're not going to use 200 indicators or explorations or system tests or the expert advisors. There's tools, I probably never used some of the tools in my toolbox. The ones that I use every time, and they're very helpful when I'm like working in the shop or whatever, doing repairs around the house, right? The thing that I've always loved about MetaStock is because it's such a well-established, it's a product that we've been working on for decades, 30-something years now, 28 years in a row, it's not a product that you're going to outgrow anytime soon. As you get better, maybe you own MetaStock right now and you want to go learn about candlesticks, attach a candlestick expert. It'll teach you about them. I think what we do really well is helping you with system testing, identify what works well for you, what you want to do. With our expert advisor, we help you focus on what you want to do. With our scanners, we help you focus on what makes sense right now. I use the scanner every single day. Well, I haven't traded many days just because I've been busy here at the show this week, and I definitely am going to go spend some time after I'm done now to look at some of the stocks that I'm doing. But it's such a valuable tool. I wouldn't trade without it. And it's so inexpensive for what you get out of it. Let's talk a little bit about that. There are 2 versions of MetaStock. We have the real-time version. That's $250 per month. That includes real-time data. It includes delayed data. There are some exchange fees that you may have to pay depending on the exchange to get real-time data out of that. But that includes MetaStock. That includes the regional data. We'll also include with that a installation appointment. So somebody will call you. They'll walk you through the software. They'll spend up to a couple hours on the phone with you and just answer every question you have. They'll even help you install it if you want. It's really good. It also includes unlimited access to that support desk. I love the way we take care of customers. It's one of the things that makes me proud to represent MetaStock on these things. So $250 a month for real time. We do have an end-of-day version. It doesn't include that institutional quality news package that we were talking about earlier, but it does include everything we showed you today, the MetaStock program, all of those indicators, all of those tests, the systems, all that stuff is just included. We do also, in both versions, we'll include the white glove installation. We'll include unlimited access to our support team here in Utah. And we'll also include a home study course that you can go through called Unleash the Power of MetaStock. That's $69 per month for the end of day. The special that we're doing today, actually, my slides are out of order, is if you buy a month, we'll give you the second and the third month for free. So if you do $60 divided by 3, that's about $20 a month. You pay $20 a month. You're literally trying the software that's been rated #1 in its price category for 28 years straight by our lovely sponsor, Stocks and Commodities Magazine. If you like it, you're going to be able to play with it December, January, February. You might have some downtime to really focus on the trading that you're doing over the holidays. You might have some time off. Generally, I'd say seasonally, January, February, those are really good months historically to look at to trade. It's a good time to get involved. So you can sign up. You can go to metastock.com/conf-promo. You can give us a call at 800-882-3040, or you can visit us online at metastock.com/sales-chat. Give it a go. See if you like it. If you don't, well, thank you for trying it. But if you do like it, I hope you like it half as much as I do. You'll be a customer for life. Okay. I did want to mention one last time, or I'll probably mention it again before the end. We are doing the masterclass with Oscar Carboni tomorrow. I love Oscar. The reason I wanted to do a bit of a masterclass with him is we had a class with him last year, and he did such a good job. His reviews were so good, and I absolutely loved every minute. So this is tomorrow. is from 10 a.m. Eastern to 1 p.m. Eastern. We'll have a bit of a break in there, but we're just going to talk about technical trend lines, formations, all the flags that he likes to use, and how to properly set up a chart. For the conference, what we're going to do is a special for this. $4.99 is the normal price. $3.99 is the conference price. And you can call us at 800-882-3040 to sign up for it. You can also visit us online at metastock.com/saleschat. Andrew says, great info, sweet. Thank you for coming, Andrew. Thank you for the nice comment. I'm glad you liked it. If we opt for the RT edition, yes, Nitin. Nitin's question is, if I sign up for real time, can I also do end of day? Absolutely, yeah. The only difference between DC and RT, well, you get the news with real time too, but you can look at every the RT can do everything that the daily chart program can do. So that's a really good question. I appreciate you asking it. In terms of when the offers end, sign up now. We don't have like a real expiration date on these. We're not high pressure, but if you wait, you're probably going to forget, and you just should try this. 28 years in a row, it's been #1. Try it out. Don't delay. Don't hesitate. If you call us in February and say, "Hey, I want to do that 3-for-1," we'll let you do it. But the problem is you're probably going to wait, and that's and then you're going to forget, and then you're going to miss out on the opportunity. Do it now. 800-882-3040 or metastock.com/saleschat. All right, very cool. All right. Hope you're enjoying the event today. I've been really happy with how it's worked out. We will say thank you to Stocks and Commodities for sponsoring the event. We will say thank you to CMT Association. They've been great sponsors. We actually have Tyler Wood coming on in a little bit from CMT to talk about the CMT Association and do some classes. I'm interested to see that. But thank you, CMT, for the sponsorship of the event. We appreciate that. Our next guest is Jerry Allison. Jerry Allison is here for the first time, guys. But we've done other speakers with the Traders Tax Accounting. And one of the things that just blew my mind the first time that we sat down, I can't remember who gave the presentation. It's going to come to me, but it'd probably be like 2 a.m. where they sat down and they were really looking at the numbers. Like, if you're an active trader, it makes sense to incorporate it as a business. And Jerry's going to talk about that. And I think it will surprise you. Like, it makes a huge difference. So, Jerry, how are you doing today?
Doing fine. How about you, Jeffrey?
Good. I want to say welcome to the room for the first time. Let me go ahead and make you the presenter.
All right.
I'm trying. Oh man, that's going to bug me about who gave the talks before. Anyway, it's not important. I'm interested to see yours. I just turned the presentation over to you, so It should be asking. I can see your screen too. So
awesome.
Perfect.
I saw your presentation. That looks really neat. I like what the technical analysis you're giving.
Yeah, it's a lot of fun. I enjoy it. This will be different though. People probably find this a refreshing change.
Yeah,
because we've only been talking about technical analysis all week. So anyway, we can hear you well.
You're good.
Yeah, right, all week long. Yeah, it's been a great show though. We can hear you. We can see your screen, and I'll get out of the way.
Okay, fantastic. I appreciate you having us here today, and that I can present a picture of what taxes look like for a trader. Our presentation, of course, is titled Trader Tax Status versus Investor Status and What It Means to You. And I'm going to approach this from a little bit different standpoint than what you would think. But it comes from more of a business standpoint, and we will incorporate taxes into that. First of all, we're going to have the presentation here, and then at the end, we'll have a question and answer session. So feel free to type those questions in, and Jeffrey can ask those questions at the end, and we can have a little bit of Q&A there. The summary of what I'm going to be presenting today is we're going to talk about trader tax status and how that affects your tax return. We're also going to talk about business structures for trading, and some of the structures we recommend and how those play into taxes and what it means to you as an investor. And then also we're going to talk about the mark-to-market election. and how that affects you as well if you decide to make it. Now, of course, legal stuff out of the way. So the first thing I want to talk about is our disclaimer. To the best of our knowledge, the information given in the webinar is accurate as of this date. Tax changes do happen constantly if you're following what's going on in Congress. There's some being talked about already, as well as about $88 million being allocated to the IRS just for auditing. So some things to keep up with there. So things are changing constantly. This seminar does not establish a professional or confidential relationship between yourself, myself, and Traders Accounting. Then Traders Accounting is not a law firm, so our advice here should not be construed as legal advice. Now, just to start off with Traders Accounting, this is our contact information. The website address is www.tradersaccounting.com/MS. Of course, MS stands for MetaStock. So we've got a slight link there for the MetaStock folks out there, and we appreciate that. Our phone number is 800-938-9513. Our receptionist, Crystal, will be happy to help you need. And if you want to contact us by email, you can contact us at learn@tradersaccounting.com. Now, let's go ahead and get into this presentation. As I mentioned a little bit ago, I want to attack this from a slightly different aspect than what we normally think of as taxation. In a former life, I taught in a university environment, taught graduate students as well as undergraduate students. And I often ask them in an entrepreneur class or some other class similar to that, what is the most important thing for any business to have? And of course, I would get answers like, well, you got to have sales. Okay, well, there's businesses out there that don't have sales. Matter of fact, traders, you guys that are in business right now, technically don't have sales. You have income, but you don't have. And then somebody else would come up and say, well, no, the answer, the most important thing for a business to have is customers. I'd say, okay, that's a nice answer, but some businesses don't have customers. You as traders don't have customers. And there's other businesses that don't have customers, but they still provide a valuable service. And other people would say great employees or a good reputation, things like that. And I'd say, no, none of those. But every business has one thing in common. And if I can get you to think in terms of this, as far as not just taxes, but everything that happens in your trading business, it could probably revolutionize things in at least in your mindset for operating your business. And that one thing is cash flow. I'm going to bring it up here. There we go. Cash flow is extremely important in every business. If you don't have cash coming in to your business, or you preserve cash from going out, the business is going to die. It's going to die a slow death. Regardless of your business, whether it's a trading business, it could be a restaurant, it could be a bank, whatever. If cash is not coming in, the business will starve to death. I've seen businesses that make a lot of sales, and some of you who do research and analytics on financial reports, you'll know that you can't just look at the income statement of a business, because those sales might be inflated by the receivables. They may be making a lot of sales, but if they're not collecting the money from those sales, that business is toast. It's not going to last very long. And so what I've designed this webinar or this seminar to do is actually to look at taxes and how to generate cash flow or protect your cash flow. Because if you don't think in terms of cash flow, it's going and act, shall we say, emotionally or without forethought, then your trading business is going to have a problem eventually. So how are we going to do that? Well, there's several things we're going to look at as far as cash flow, and one of them was mentioned in the title there. We'll talk about trader tax status. Now, some of you have probably read about this online or in other publications, things like that. There is a lot of confusion about trader tax status, mark-to-market election, and all of this in the literature. Even on the IRS website, I have read conflicting details. Publication 550 that I'm going to mention here in a little bit has something different than what the actual IRS website has. And so we've got to navigate through this a little bit. But the idea behind trader tax status is this allows a trader to deduct their trade expenses from a tax return. So it allows you to take your trading expenses and really deduct those. Now you say, well, wait a minute, those expenses are net flow. That's money spent. It's spent to keep the business running. And I'll address that here in a second. But what you have in your power to come up with and really avoid are the tax consequences for that. And trader tax status is one of those things that will allow you to take and deduct the things you're actually spending for your business and reduce your tax burden as a result of it. So why is this important? Let me give you an example of that. Suppose we have a trader with a TTS and deducts $5,000 for a training course. Maybe it's a seminar like this one, or maybe it's some type of trading course where they learn how to trade options or something. But they're going to spend this $5,000 to take this trading course. If the trader is in the 32% tax bracket and they deduct this $5,000, they just reduced their taxes by $1,600, which means their cash flow is $1,600. And that's without the state income tax, but we're just figuring in federal income tax right now. So is $1,600 worth it to you? Well, trader tax status increases your cash by reducing your taxes and possibly getting you a tax refund, so you can take that extra money and put it back into your, so it allows you to put money into your investments more quickly. Now, this is a great thought that a lot of people have. Say, oh, I want to write off all my expenses, and then I can make some purchases and do some things like that in order to save some taxes. I want you to be cautious, though, because there's a trap that people fall into, and it's this one. It's unwise to spend money just to get a tax deduction. This always results in decreasing cash flow. Let me give you an example. I had a client that a few years ago that he wanted to spend $20,000 on a piece of equipment. He said, I want to get this piece of equipment and I want to save taxes on it. I said, okay, are you going to use the equipment? Well, we're not going to use it very often. We might use it once or twice a year. Okay, so you're going to spend $20,000 so that you can save $6,000 on your tax return. He said, yeah. And I got to talking with him about it. If you buy this piece of equipment, you're going to spend $20,000 to save $6,000. So your net loss there, if you will, is $14,000. If you don't buy it, you're going to pay $6,000 more in taxes. So which would you rather do? Pay $6,000 or pay $14,000? And I think I got him to wake up a little bit and realize that this purchase to do him any good was actually creating negative cash flow for him. And so as a result of that, I said, just go ahead and pay the taxes. You're then $14,000 up still. And then you can just go on and reinvest that in things that you actually need for your business. The general business rule with taxes is every expenditure that you make in your business should pay for itself many times over. So if he were going to buy that $20,000 piece of equipment, he would need to be able to pay for it within a couple of years 4 or 5 times. He should be able to generate $100,000 revenue off of that piece of equipment with no problem. Now for you guys, if you're going to go to a seminar or you're going to buy a computer or you're going to do something, be a member of a trading club However, that should pay for itself several times over. Do not make a purchase just to get a tax deduction, because you're going to end up losing the more money in the long run. So trader tax status is a way to write off the expenses that you have for your trading business. Well, okay, fine. The question then becomes, well, how do I qualify for it? Well, that's a good question, because then we go to the IRS publication 550. I mentioned this a little bit ago. And it has really three qualifications for trader tax status. Number one, you must seek to profit from daily movements in the prices of securities or commodities, and not from dividends, interest, or capital appreciation. The idea here is you are watching the daily movements and you're going to try to profit. So basically, this is talking about day trading, although I don't think it excludes swing trading at all. It basically talks about a trader who is looking at the market and keeping up with the market and constantly looking at things so that they can make the maximum amount of profit off of that, increasing your tax flow, or cash flow rather. So that's the first qualification. Second qualification, your activity must be substantial. In other words, there has to be of activity, and we'll talk about that here in a little bit, but you have to be aggressively in the market. You can't just make 2 trades at the beginning of the year and call it. You really have to be in that market for really be involved in the market and trading in the market. And then you have to carry on the activity, trading in this case, with continuity and regularity. The best way to illustrate this is if you trade almost every day, you're not going to have a problem with trader tax status, at least this. It's continuous. Now you say, well, can I take a vacation once in a while? And yes, you could do this. You could take a vacation, maybe a week vacation, a couple times. The idea behind these 3 things, and let me just kind of paint a picture, is the IRS wants you to treat this like a business, not like it's just a hobby. Imagine, if you will, like a restaurant. We open up a restaurant and we want people to come, obviously, and eat there. And we got to pay our cooks and pay our waitresses and things like that. And then we decide, oh, next week we're just going to take next week off. We're not going to serve any food. We're just going to close the restaurant down. And then we go for a couple more weeks and say, oh, we're going to close down for another week. And we do this a lot of times during the year. Our customers at the restaurant would not want to come back to us because they don't know when we're going to be open. Well, the IRS is kind of looking at the same way, that you need to treat this as a serious business, not just a hobby. And so you have to be embedded in this thing, treating it like a real business, taking a vacation maybe once or twice a year, but not taking extended vacations and at multiple periods through the year. Now, this language here comes straight from IRS publication 550, and I would encourage you to get that publication. That's a very valuable publication to get. You can just do an internet search for IRS publication 550 and download it to your computer or your phone, and you have it right there. It's got a lot of good stuff in it. It talks about interest and dividends, original issue discounts, things like that, all kinds of investing stuff. But it does talk stuff about you as far as trading as well. Now, these qualifications here are extremely vague, and that's one of the problems. When Congress starts writing laws for the tax code, when they don't know what's going on, they leave it very vague. And what happens then, IRS then tries to enforce those things, and of course it ends up in court. And so what the bigger specifics of what we're going to be dealing with as far as trader tax status actually comes from court cases. And so we're going to look at some of those court cases and how they have affected trader tax status and what you can write off and when you can write it off on your tax return. So we're going to look at 3 different court cases here. The first one, Endicott versus Commissioner, said that a trader who uses trader tax status, first of all, has to have a holding period that's short term. And that means 31 days or less. So again, swing trading definitely falls into that. If you're just holding for a couple weeks and then seeing what happens with the stock or whatever security it is you've got, day trading definitely fits in. But we have to have a very short holding period of less than 31 days. The second case, Poppy versus Commissioner, and this is actually the big case for day trading right here in trader tax status. Trading occurs 75 to 85% or 80% of the trading days per year. So it allows you to take some time off. You don't have to trade every single trading day of the year. The actual level that was established was about 700 trades per year. Now, for some people, that's an awful lot, but for most day trader, that's absolutely nothing. They might get that in a month even. And 500 hours of active trading. So the idea is to show activity and make sure you're making a lot of trades to show that this is something that you are generally concerned about and generally interested in. It's a genuine business for you. That's a big one right there. Now, if you take the math there, 700 trades per year, that breaks down to about 3 or 4 trades per day. And about the hours there, probably about 6 hours per day. Now you say, wait a minute, I don't trade 6 hours a day. Maybe I'll trade 1 to 2 hours, and that's not a whole lot. Well, remember, you got to do research too, and research qualifies here. So if you're doing your trading and you're doing your research, you're actually putting a lot of time into that, running your analysis like we saw on the MetaStock seminar right before this about running those analyses and using that software. That qualifies. And so the idea here is you are actually setting up and running a legitimate business. And finally, the third point or the third case here to bring up is K versus Commissioner. The intent here is to make a living at this, either solely or supplementary to other income, whether it's retirement or W-2 income. So your intent is actually to live off of this in some capacity. And K showed that in court that it was the intention income for a family. Now, how do you prove this stuff? Well, one of the best things that you can prove to the IRS is to show them your 1099-B and your monthly statements from your broker, because your monthly statements from your broker show how long you're keeping these stocks. You can meet that 31-day test. Now, if you keep something more than 31 days, it's not going to be a big deal. It's the majority of what you're doing has to be less than 31 days. Because I know some people hold long-term stocks. They do that as a cover for calls, or they use it for basis for margin to put margin on top of. So there are some long-term holdings there that are possible, but most of your trading is for 31 days or less. The trading statements for the broker also show how active you are. They show the times and dates of when you're trading. And of course, they've got the number of trades per year. Now, it doesn't show the third one, but the third one is something that you would have to show by what you do with the proceeds from your trading. Now, this allows an individual trader tax status allows an individual trader to deduct expense on their tax return. Trader tax status was really actually designed for individuals. It was not designed for businesses, because the idea behind the IRS here is to make sure there's qualification so everybody just doesn't deduct expenses on their Schedule C, which is where they would go on your tax return, because Schedule Cs have been abused for many, many years. So that is one way of improving cash flow in your business. So the question is, are there other additional ways to increase the cash flow for your business? Now, you guys are the experts. You bring in the capital gains. That's your revenue. And you guys are learning how to do that. And hopefully one day you're going to be experts at it and you're great. And that takes care of that side. But we've also got to be concerned with the expense and the tax side to make sure your cash flow stays up. Now, ways of increasing cash flow are basically, one, we can form an LLC, where the trading income and expenses can be reported. Now, I'll get to the reasoning for doing this, but let me talk about what LLCs are. LLCs are limited liability companies. They are state entities. They are not federal entities. So these exist at the state level. So you cannot take an LLC from, let's say, Florida and move it to Texas, because it won't work, because it belongs in the state. It's recognized by the state. So each state has different requirements for establishing and maintaining an LLC. There's a fee involved, and some states will have you pay a one-time fee, and you've got the LLC forever as long as you file the reports. Some states you have to file the reports every year, and you have to pay a yearly fee. And some states, unfortunately, you not only have to file the reports and pay the yearly fee, you also have to pay a tax on the earnings in the LLC. So every state's a little bit different. Now, you say, well, there's a fee for setting up the LLC. Isn't that negative cash flow? Well, it is. But remember, I mentioned a little bit ago that trader tax status was for individuals. As an individual trader, if you adopt trader tax status, you are reporting everything on your Schedule C of your tax return. The problem is the IRS scrutinizes Schedule Cs very heavily. And so what we do is we try to form an LLC, particularly a multi-member LLC, to get that off your tax return, your personal tax return, onto another tax return that is not scrutinized as well as, or as much, by the IRS. And trader tax status doesn't matter as much if you get that off of your personal tax return, because you have now formed, for lack of a better term, a legitimate business, or what looks like a legitimate business to the IRS. And of course, businesses have expenses. So you don't have to worry about trader tax status as much if you have an LLC. Now, the reason this is actually an increase of cash flow, you say, well, there's a fee. How's that an increase? The cost of IRS scrutiny can far exceed the cost of maintaining an LLC. Consider it insurance. When you go out and buy insurance for a business, or you go out and buy insurance for your house, or whatever it is, you are basically betting with that insurance that something's not going to happen. Now, the insurance doesn't keep it from happening, but you're betting on protection in case something does happen. This is insurance, if you will, getting an LLC to reduce the IRS scrutiny, or to try to reduce the IRS scrutiny. And so it's just a little bit of insurance. Even though you may pay a couple $100 a year, it's definitely worth the cost of being able to avoid an IRS audit. I've had clients tell me, say, well, no, I don't want to form a multi-member LLC or an S Corp or a C Corp. I'd rather just have it on my personal return, because if I'm audited, I can prove everything. And my comment to them is, sure, you can probably prove everything, and that's not, that's great that you can. But the issue with an IRS audit, it just doesn't take money. Even if you represent yourself, you don't have to pay anybody. It takes time. And so you as investors know time is money. Would you rather be trading or spending 4 hours in an IRS auditor's office justifying what you've got going on? Even if you still got time involved there. And so that's going to take away from your trading. It could take away from your research, things like that. It's time is money. And so we are paying for an LLC here really to save us some time in the long run. Okay. Well, then the question becomes, what type of LLC should I form? Well, there's actually a couple different types of LLC with any state. There's a single member LLC and a multiple member LLC. Single member, one owner. You form that yourself and you're good to go with the state. Multiple member, you have a partner. Generally, a husband and wife teams up to be a partner. Sometimes two people who like to trade together, they're friends, they pool their money and trade together. Sometimes a person just sets up a partnership with a family trust, and that person adopts a 99% ownership stake, and the family trust gets 1% of the profits. So they build up for their kids or some other family member that they want to save up for. There's a lot of ways to take care of multi-member partnerships. Now, let's talk about single member partnerships for a little bit. A single member LLC, which is a sole proprietorship for all intents and purposes, is generally taxed on a Schedule C of the personal return. I've mentioned Schedule C's before, but it can be elected to be taxed as an S corporation or a C corporation. So you still have an LLC, but you can file an election to be treated like an S corporation or a C corporation. However, if you don't file that election, by default, it goes on a Schedule C of your personal return. Now, that's how a single member LLC is handled. And we already talked about putting those expenses on a Schedule C of your return. Multiple member LLCs are generally taxed as a partnership. It files a partnership return once a year, but they can also elect to be taxed as an S corporation or a C corporation. So we've got two different ways you can pick either a single LLC or a multiple member LLC. Now, sometimes the state will ask for all the members right up front. And so you'll have to list all the members there. Sometimes they don't. Some states don't. And then file for the IRS EIN number, the employee number. Then you have to specify whether there's one member or multiple members. So the first choice that we really have to make is which type of LLC do you want? Do you want a single member or a multiple member? Knowing a single member reports on a Schedule C by default, a multiple member reports on a partnership return by default. Well, always keep this in mind. The number one most audited business is a single member LLC or Schedule C. We talked about that a little bit. The IRS focuses on those because those have been abused in the past. People saying they have a business and writing off all kinds of expenses on the Schedule C, and the IRS has caught them. So they very naturally look at Schedule Cs in order to audit those. And particularly with what's coming up, they're trying to fund $88 million for the IRS just for audit purposes. Where do you think they're going to go? They're going to go to those Schedule Cs first and foremost. So we don't really recommend a single member LLC because it just ends up on your personal return and can make a mess of things, unless or a C Corp. Now, S Corps and C Corps also have issues. One, they require the officers or the owners to be paid a salary. So if you're going to go this route, if you want to become an S Corp or a C Corp, then you need to pay yourself a salary. Well, what does that entail? Well, every month, at least one, you have to write yourself a paycheck. You're going to have to do payroll tax deductions. So that means FICA deductions, state withholding, federal withholding, and state and federal unemployment insurance has to be paid out. Every month that has to be done. Every quarter you have to file payroll tax reports with the federal government and the state. And then at the end of the year, you got to file year-end reports with all those, plus the W-2s. It is a lot more work to do. There are reasons people do it. One of those is to set up pension plans like 401ks, things like that. That can be done, but it does involve some more work. And I want to make sure you guys have full information. By paying that salary, we also increase our taxes because there's FICA taxes. 15.3% of the salary has to be paid in FICA. The unemployment taxes, the federal unemployment tax is 0.8%. States vary based upon counties even. It can change. So there's a lot of variability there, but you've got extra taxes there. And that's why I mentioned in this point that if you're paid a salary, you actually increase your tax load through the FICA and the unemployment taxes and decrease your cash flow as a result of it. So that's kind of unfortunate, but there are reasons that people do that. So what does Traders Accounting recommend? Well, first of all, it depends on the situation you're in. And this is why we want to sit down and talk to you, because there is no uniform plan for anybody. But we usually recommend a multi-member LLC to be taxed as a partnership. And the reasons for this is this creates a trading business where expenses can be deducted. Remember, we talked about deducting expenses that can increase your cash flow. So we want to make sure we do that. Trader tax status is not as big of a problem because you now have a legitimate business set up, so you can deduct expenses automatically. You don't have to go into proving that you are trading 3, 4, or 5 days out of the week, 700 trades, spending 500 hours a year. I mean, if you want to do that, that's fine. But by forming this LLC, or really an S Corp or a C Corp, we get around some of those requirements for proving trader tax status. The third reason for doing a multi-member LLC is the Schedule C is then eliminated from your tax return, reducing your audit risk. Now, let me talk about the taxation component here for a second. If we form a multi-member LLC that's taxed as a partnership, what happens is the partnership files a tax return by March 15th every year. And that tax return is an informational return. The partnership does not pay income taxes. The partnership only files an informational return, and then the income is broken up between the partners on what's called a K1, and then those K1s are attached to your personal tax return where the income tax is paid. But what it looks like is you have a legitimate business out here from which you're getting an income on the K1s. You don't have the mess of the Schedule C or the higher risk of being audited in that case. So we eliminate that Schedule C. We're reducing the audit risk, and thereby, although it's not really known, we are probably increasing our cash flow as a result of it by eliminating audits in that case. And as I mentioned, the partners still claim their share of income on their personal returns as a legitimate business. Now, other things that we can do with this is that the partners can still claim a home office deduction on your personal tax return, and therefore reducing your taxes and increasing the cash flow again even more. Home office deduction is extremely critical, where if you have an office in your house, and most of you are going to probably set up an office in your house, that dedicated square footage there, we will take and divide by the square footage of your entire house to come up with a percent, and then you can write off a percentage of your house expenses. If you own a house, you get a percentage of your mortgage interest and property taxes. If you rent, you'll get a percentage of your rent. And then you've got insurance, you've got repairs and maintenance. If you have HOA dues, anything that's done to maintain that house, you can write a percentage of it off as a home office deduction. So again, that increases your tax flow. So we want to make sure we capture all the deductions we can legitimately, but we also want to avoid IRS scrutiny as a result of it. So that is how we increase cash flow using taxes. There is one other way that we can do that, and this is with the mark-to-market election. Now, as I mentioned earlier, there's a lot of confusion between trader tax status and the mark-to-market election. A lot of people think they're the same thing. They are not the same thing. Trader tax status, as we already talked about, really goes to the heart of deducting expenses on your tax return. The mark-to-market election is actually a different way of accounting for gains and losses in your accounts. Technically, there's no difference between realized and unrealized gains. Now, there is an argument here already as to how this should be accounted for, and the argument exists on the IRS in the IRS own documentation. One way of accounting for gains and losses is to take the whole portfolio and value it at the beginning of the year, value it at the end of the year, and that's what you pay taxes on or realize a gain or a loss on. The other way is to just look at the 1099s and eliminate wash sales. And I've seen both of those in the IRS literature. So they're both valid ways of doing things. But the idea here is we are accounting for your gains and losses differently. Now, what happens here, and it doesn't become quite obvious, all the gains and losses become ordinary gains and losses on your tax return rather than capital gains or losses. Now, that makes a big difference for a couple different reasons. One, ordinary losses, which you would get under the mark-to-market election, can be used to offset your ordinary income. So if you've got pension income, if you've got W-2 income, ordinary losses under the mark-to-market election can be used to offset that. So if you've got losses, you can offset your W-2 income if you so choose. The other implication here is actually the only negative to the mark-to-market election is that it takes all capital gains and converts them to ordinary gains. Well, short-term capital gains converted to ordinary gains is really not that big of a deal because all of that is taxed at your tax rate, whatever your tax bracket is. The issue, though, is long-term capital gains. If you put long-term assets underneath the mark-to-market election, then you lose the beneficial tax rates of the long-term capital gain. So what we recommend to our clients is we do not put long-term assets under the mark-to-market election. There's a couple ways to handle that. We can keep either the long-term assets outside of the LLC where we're doing our short-term stuff, or we specifically designate it as being out of the mark-to-market election. Because I know there's cases where people have to have long-term stuff in there because they're using it as collateral or security or whatever. So there are cases. So we need to make sure that's done properly. Now, the other implication, one implication here from this is the $3,000 limit on capital gain losses per year goes away. Now, let me explain what happens. If I'm an ordinary investor and I'm trading during the year and I just lose $10,000 in my account, the IRS will only let me lose or take off or write off 3,000 of that in a given year. I have to take the remaining 7,000 and carry it forward to next year to offset any other capital gains or take another $3,000. With mark-to-market election, if I lose $10,000 in a year, I can write the whole $10,000 off in that year. Now, nobody likes to lose money, but we do need to plan for it. And so that by writing that $10,000 off in the year it occurs, that lowers my taxes, and I can take the reduced taxes and actually put them back into investing, increasing my tax flow. I can't do anything about the loss, but what I can do is change my tax structure a little bit. And I could take the savings from taxes and put it back into investing. Now, the big thing for mark-to-market election, the benefit, is the trading account is no longer subject to wash sale rules, thereby increasing your cash flow. Now, those of you who are trading stocks and options, you know when you rapidly get out of stuff, you may take a loss to get back in and get a better position, something like that. You encounter those losses all the time. Those are called wash sales. Unless you stop trading in that security and all its underlying derivatives, options, stocks, everything in that one security, unless you stop trading in that for 30 days, those wash sales are going to build up. And so I have seen clients at the end of the year with $50,000, $500,000, sometimes $1 million in wash sales sitting in there. Well, what does that mean? Well, that means when you start calculating the capital gains on there, you have to add the wash sales back in and pay the tax on that. Let me give you a real life example. I did a tax return for a gentleman here a few weeks ago, and in his account, he actually lost $20,000. I mean, he lost the $20,000, but he had $50,000 in wash sales. Well, you take $20,000 negative $20,000 and add $50,000 back into it, you're now looking at a $30,000 gain that he has to pay taxes on. That screwed up cash flow for him, or it took away extra money that he could have been using for trading because he had those wash sales. So what we recommend is that the mark-to-market election be taken for your LLC so that you can avoid the wash sales and have to pay taxes on those losses that you should be getting as a deduction but can't because you don't have the mark-to-market election. Now, one other point here on the mark-to-market election. This election is best for those trading stocks and options. It could have a benefit for those trading cryptocurrency. I know you guys are doing your seminar on stocks and options, and that's fine. And this would definitely be a benefit for you. But if you're also investing in futures, you do not want to elect the mark-to-market election for futures. Because futures already have a special way of taxation where any gain on futures or loss is broken up actually 60% long-term and 40% short-term. And so you get the beneficial tax rates for the futures automatically without having to do anything. So with futures, Forex is taxed a little bit differently if you decide you want to trade in that. There's no point in doing mark-to-market on that. So basically, stocks and options are the best things. I'd want to talk to you about cryptocurrency if you wanted to use it for that. So the paths that I mentioned here, these are general recommendations. And again, I'm interested in getting your cash flow higher, keeping cash from leaving your business or getting cash in. But these are general recommendations. They may not fit your particular situations and goals. And I talk to people every day, and we start with talking about what their goals are and what's your situation, what are you trading, what are you doing, where do you want to go with this. So there is no one size fits all plan. That we need to actually sit down and develop a personalized plan that works best for you. And incidentally, and I'm telling clients every day this, there is no perfect plan that lasts forever. We might find a perfect plan that works for you today, but next year things change. Tax laws change, your situation changes, the market changes, all kinds of things can change. Your plans, goals change. We need to sit down probably at least once a year and say, okay, is the strategy we're doing right now, does that make sense at this current time? And then we may alter it. We may change the LLC into an S Corp or a C Corp. We might add a different entity so we can do certain things. So you'd have two LLCs maybe. But there's a lot of things going on, and we can change partners. There's all kinds of things that happen in people's lives. And so don't think that, if I get this thing set up, I'm good forever. It's not going to happen because things change dramatically. Now, let me talk about Traders Accounting briefly before we go to questions. First of all, Traders Accounting provides entity creation and maintenance. We can help you create the LLCs. We can also create trusts. I talked about partnerships, where a lot of people like to have a 1% trust there and have 99% of the partnership for themselves. We can help you create those and maintain those. We also do bookkeeping for trading businesses, whether you elect mark-to-market or not. Our bookkeeper, Lisa, she's great at what she does, and she'll produce a monthly financial statement for you to look at when she gets the information. And then at the end of the year, she produces a year-end financial statement, and we can usually just translate that right into the tax return. So we've got bookkeeping if you want to do that. Of course, we've got income tax preparation for all types of returns. Whether it's individual returns, partnership returns, S Corp, C Corps, trusts, even have done nonprofit returns, and I think I did a pension plan return this year as well. So we can do just about anything that you've got in your arsenal. And finally, we also do tax and entity consulting. You can book some time with us, and I will sit down with you, or another one of our people will sit down with you, and we'll spend some time talking to you about what to do, how to do it, the best plan to go forward. Now, if you want to get a hold of us, Raven Johnson is our entity formation specialist, and she'll give you a free 30-minute consultation to find your best options. As I've already mentioned, there is no one solution for every single person. So Raven will guide you through that, ask you questions, and then we can get a plan together to help you and set up your best options. Our phone number is, again, as I mentioned at the earlier part of the presentation, 800-938-9513. And our website address is www.tradersaccounting.com/MS. And if you go to that website, you can actually book the appointment with Raven online. So that is something, please check it out. It's free. You have no liability involved at all. So we'd love to hear from you and talk to you. So now I'm going to turn this back over, and I'm going to ask Jeffrey to come in.
Hello.
Hey, how about some questions? We got some questions building up.
Charles had a really interesting question. I'm interested to see what you just have to say about it.
Okay.
He wants to know, if you have no earned income retirement and have a loss for the year, can you pull funds away from an IRA to offset the loss and pay no tax on the withdrawal?
No, you can't. Now, and the reason I'm kind of hem-hawing on that is because during the coronavirus pandemic, IRS allowed everybody to withdraw money from their IRA. And so that's how a lot of people got started. They pulled money out of their pension plans to get going with their trading business. That is no longer applicable. So if you pull money out of your IRA or your other pension plan, you will probably get hit with a penalty on that.
Yeah, I saw a huge amount of people dipped into their 401k because of that law. I can't remember the exact number, but it was one that made me look twice.
It was a tremendous amount. I saw a lot of movement this year in IRAs and other pension plans.
Let's see. Marcia asked a little bit earlier, doesn't LL trigger SSE tax obligation? I hope you know what that means. I don't.
Self-employment tax, probably. Actually, no, that's a great question, and I should have mentioned it. Self-employment tax, let me describe that first. If you have a business, it's like a consulting business or a like a restaurant we talked about or something like that, an ordinary business where you're earning money, that is subject to self-employment tax. So if we went into a partnership and we had this restaurant or we had consulting or whatever, the income would be subject to self-employment tax. However, capital gains or ordinary gains, depending on whether you have the mark-to-market election, are not subject to self-employment tax. So what happens is you've got the income as capital gains or ordinary gains. That's considered investment income. But you also get the expenses off as ordinary income. So if you've got self-employment tax, you could actually take these expenses, which provide a negative self-employment tax situation, if you will, and you could apply them to your other businesses to reduce some of your self-employment tax there.
All right, a couple more. Timothy wants to know if brokerages charge higher commissions or other fees if you're trading as a business.
Good question. Some of them do. And so I would pay to shop around, but a lot of people I work with are willing to pay those fees because if you can set up with the same broker you're currently using, then a lot of nice things can happen. They can just move some stuff over. Plus, they are less likely to question you, or not question you, but be real hard on you about the new business because you've already established a relationship with them. So they may charge a higher fee. That is something you'd probably want to research a little bit before getting involved.
Stephen has an interesting scenario. He earns money in U.S. as well as Canada, and he wants to know if you guys can help him with Canadian taxes as well as U.S. taxes.
Unfortunately, the U.S. tax code is complicated enough. I'm not sure I want to get involved with Canadian taxes. So no, we're not going to be able to help you with that. I'm sorry.
Okay, fair enough. But the U.S. side, Stephen, they're really good at.
Yes.
Bert asked a question that I think you can know the answer to. Bert wants to know, is it possible to set up a trading business as an individual?
Yes, it is. You can set up a trade. Go ahead.
I was going to be a little bit cheeky and say, do you know somebody that could help him with that? But I'll let you finish.
Yeah, I could do that. We have clients that do that. The issue with setting up a trading business, whether it's an LLC or not, with a trading business that's an individual, is everything shows up on your personal return. Now, the problem with that is the expense side of it shows up on your Schedule C. We talked about Schedule C's being the #1 audited entity. The income does not show up on your Schedule C. It shows up on Schedule D, where capital gains go. So you've got this Schedule C with a whole bunch of expenses on it, but it doesn't look like any income. Now, 1 year, that's not a big deal. But when the IRS starts seeing year after year that you're deducting a bunch of expenses and there's no corresponding income coming in, that starts to raise up a bunch of flags, even though that income's sitting over on Schedule D. And so it goes back to what we were talking about, was we try to minimize the amount of risk you have of audit. Now, we do have people that do Schedule Cs, and we can certainly help you with that. But we really want to keep you out of an audit situation as much as we can.
Ann asked a really good question. Is charity donations allowed and deductible in an LLC?
Trading deductions, yes, they are. Matter of fact,
I'm sorry. Charity donations.
Charity. Okay, I'm sorry. I think I misheard part of that too. Charity donations, yes. Now, here's what happens if you have like a partnership or an S corp or whatever. Forget C corp for a second. But either of those who are pass-through entities, that donation will be recorded as a charitable donation at the value of the stock that you're giving. And then what will happen, it goes on the K1 that ends up on your personal return anyway. So it would just go on. It becomes actually less questioned because on your personal return, because you're getting that donation from a K1. So yes, it can happen. It just takes a little circuitous route to get there.
Stephen chimed in and said, you should learn about Canadian. They're way easier than US.
I would believe any
I don't believe it. Let's see. But the nice thing is they keep making them easier, right? No, I'm just kidding.
Oh, yeah, absolutely.
Donald wants to know, does electing trader status allow a trader to contribute gains from trading to an IRA? Good question.
I'm assuming, are we talking, if we're talking about an IRA where you're self-controlling that, you're actually doing the trading in the IRA, then everything stays locked up in the IRA, and there's no, the expenses come off of the funds that are inside the IRA. And so the IRA is like a self-contained vehicle, and there's no point, you can't deduct expenses out of it because they're going to become deducted off the IRA money anyway. And so that doesn't become taxable until you start pulling the money out anyway.
BJ, I think we have time for 2 more questions. This one is, BJ says, if one's not a resident in the U.S., how does this impact their tax? I think that depends on where you're from. You need to consult your local tax laws in that case, Mr. Zhao.
Absolutely.
Timothy asked a good question, though. If you're registered as a part-time state in 2 states, like Florida and Minnesota, which one would you file an LLC in?
You could file the LLC in either state. Florida, of course, does not have an income tax. And what was the other state? Pennsylvania?
And Minnesota.
Minnesota does. The key there, though, is the taxation. If you're filing, if you're a full-time resident, if you're claiming full-time resident of Minnesota, what happens is Minnesota is going to tax everything and then give you a credit for the portion that of taxes you paid out of state. Well, Florida doesn't have an income tax, so there's not going to be any credit. So Minnesota is going to tax it fully. However, if you're full-time in Florida, you claim Florida resident status, then all you have to do is pay taxes on the Minnesota income that you've got. So I guess it would probably be beneficial if you're full-time resident of Florida to go ahead and set up your business in Florida then. So they can't touch, Minnesota can't touch those taxes or that entity.
We're still getting more questions, and we're running out of time. We're going to do one more, and then we're going to give the phone number for you guys to call. I'm impressed, Jerry. It seems like if I wanted to know something about trader taxes, it might be a really good idea to give you a call.
Absolutely.
At 800-938-9513. The last question, though, that we have time for is from Bert. So Bert's making a lot of money trading right now. He's probably, I'm going to just hypothesize, using our software called MetaStock.
Okay.
And what he wants to do is take some of his trading gains and move those over to an IRA or Roth IRA account that he has already open. Can he do that?
That's a great question, Bert. I get that question at least 5 times a week. Here's the issue with retirement accounts. Retirement accounts cannot be based off of unearned income, which capital gains are, unfortunately. So you could be making $1 billion a year in capital gains, not one dime of it can go into your retirement plan based on that, other than your personal IRA that you would have like on your tax return. Now, to get away from that, what we end up, a lot of our clients will set up a S corporation so that they have to pay themselves a salary. And so on that W-2, then the income that you pay yourself, you can then base a retirement plan off of that. But you see this starting to get more complex. And there's also a couple things that we could set up a C corporation and things like that, charge a management fee. This is where you get into multiple entities. So it can get quite complex, but that's something that we need to sit down and plan for to find out what would suit you best. And given we're running into the end of the year right now, there's not a great deal of time left to get stuff done. Because what happens is you've traded all this stuff on your personal side. It's going to have to stay there, unfortunately, because any entity you start right now is going to be starting right now. And so anything you've done. So the only really thing you've got is that IRA on your 1040 side. Just fully invest that.
Okay. And next year's a new year, though. It might be a good time to get going.
Yeah, exactly.
Let's thank you, Jerry. I appreciate
Sure.
it. Great job too. I've actually learned a few things, especially from these questions.
Good. Yes.
Awesome. I'm gonna go ahead and say thank you very much. 1-800-938-9513. Thanks for coming today, Jerry. We'll see you again soon.
All right. Thanks, Jeffrey. I appreciate it.
All right. I hope you guys enjoyed that. Let's go ahead and kind of get switched over a little bit. I'm going to warn the control room that we're going to do. These prizes are just not going to give away themselves. They're just not going to. So cancel. Wait. Okay. All right, good. Hold on just a moment. Let's make me the presenter again. I almost ended the room. So glad I didn't make that mistake. We still have a little bit of speakers to go. All right, are you ready, control room?
I am ready.
All right. So what I need from you, should we start with the prize or the winner?
Let's start with the winner.
Okay, we can do that. So I need a number from you. As you know, you've played this game before. I need a number between 1 and 11,848. Woo! Okay, this is Kelly is giving away a prize to somebody that was only the 382nd person to register. He is rewarding you for registering early. Stan C from the USA. Stan C, congratulations. I'm just copying your information here so I don't lose track of it later. But you are the new winner. And let's see, I'm sure there's a lot of Stan C's in there. So if you have an AOL address, that might be you. So let's go ahead and tell you what you won. This prize that we're going to give away from you is a course put together by John Seville. John Seville spoke yesterday. He did the Acorn Wealth course. This is going to be a 5-part course called Smart Money Trading and Indicators. It includes one-on-one trading along with 3 months access to all the smart money trade alerts. It's actually worth $5,185. So there you go.
Wow, that's a pretty good price.
I would say that as you use those indicators, if you're using them in MetaStock, I helped them write them. So there you go there too. But anyway, if your name is Stancy and you're at AOL, look for an email from me and I will kind of just confirm your details and confirm you're the winner and send you the information on the prize. So I'm going to go ahead and write that down real quick. Thank you, control room. I hope you're enjoying today. Again, MetaStock 28 years winner of Stocks and Commodities Award. We're doing an extended trial. You can take advantage of said extended trial where you buy 1 month and get a second and a third month for free at metastock.com/compfromo. You can give us a call at 800-882-3040, and you can visit us online at metastock.com/saleschat. So I'm also going to say thank you to Stocks and Commodities for sponsoring today's event. It's a great magazine. If you do a subscription for MetaStock and you get 3 months, you'll get 5 months of Stocks and Commodities to go with it. So that's pretty cool. I just realized I was holding up my props, but my camera wasn't on. So there you go. And now we'll see how long it takes for Kelly to turn on the lights. Not very long. We're getting pros. We're learning what we're doing after 5 days of solid broadcasting. So in any case, our next presenter is also another presenter that we like so much. We invited him twice. John Osborne is going to come in and going to talk about their patented value charts methodology. He does a really good job. Like I said, we only invited 2 speakers twice. John was one of them. So John, how are you doing today?
I'm doing great. I feel so honored.
Yeah, it's a high honor. Actually, we love you. I think you did such a good job. I tell you this, but you did such a good job programming, and you're really good at presenting, and you have a lot of different skill sets. It's very good. So, in any case, I just sent the presentation over to you.
All right. Let's see if I have that skill set. Let me see. Be able to turn on the screen. And it just disappeared. So let me see where that went. I'm assuming you guys can't see my screen just yet.
We can see the presenter view. So
presenter view. Oh, well, that could be a problem. Let's see. Let's see.
There's 2 ways to fix it. You can change the screen, or you can just under display settings right there, you can swap them. So whichever is easier for you.
Let's see.
Click that.
Let me see. I didn't do this by accident before. Let me see. Display settings.
Yep, right there. Click on swap presenter view and slideshow. Boom.
Oh, right, look at that.
That's it.
All right. That worked out well. Of course, I'm going to be a little cross-eyed now trying to switch those back. I'm so used to doing it the other way. But let's see if we can do it. Maybe add a little spice, right?
Yeah, absolutely. Shake it up a bit. Anyway, okay. I'll get out of the way. It's all your turn. And thanks for coming. Thanks for coming twice.
Oh, you're very welcome. And welcome, everybody. Thanks for being here. I know this is day 5. I also know it's 1 o'clock my time in the afternoon, and that means I have some extra challenges here. One is that we have different time zones. So some of you just ate lunch, and I have to find a way to keep you awake. Some of you are in the middle of eating lunch right now, and I have to find a way to get you to not look at that sandwich, but watch what I'm doing. And some of you have lunch still in front of you, and I might be between you and lunch. So I might be the enemy, and I got to make you my friend as best I can in the next hour. So let's see if we can do that. I have something really exciting to share with you guys, and I'm really proud of all this that we have, and it can make a real difference in your trading. And I'm looking forward to helping you understand that, because some of you are going to have a chance to really transform your trading today. Now, we're going to be talking about trading, so I want to make sure I always show the risk disclaimer, and that is trading or investing carries a high level of risk and isn't suitable for everybody. Trading is risky. Don't trade with real money, or don't trade with money that you can't afford to lose. We've done our best to ensure the accuracy of the information I'm going to share with you is correct, and this webinar is going to provide you with information you can use to make your own independent trading decisions. And remember, past performance is not indicative of future results. The markets are unpredictable, and you want to be prepared. And CFTC Rule 4.41 basically says that the government wants you to know that trading has both rewards and risks. So again, don't trade with food or rent money or the college fund or anything like that. You'll perform better if you're using money set aside as risk capital. Now, I'm not soliciting you to buy stocks, options, futures, or any other securities. And again, be careful. The market can take your money, which is why I want to show you some tools so we can take money from the markets, right? That's what we want to do here. Now, today, we're going to talk about how to completely transform the way you are trading and start to seriously grow your account by using a very powerful, patented hedge fund technique. Now, imagine being able to approach the markets every single day and getting into your trade mode. You're sitting down at the desk, and now you're armed with some sophisticated patented software that a hedge fund developed. Do you think you'd possibly improve your trading? I mean, just imagine being able to identify trades with the same pinpoint accuracy that a hedge fund uses. Do you think that would be able to drastically grow your trading account? Well, if you've never thought that this was possible until now, I have some really good news. It's totally possible for you to do this with what I'm doing, what I'm going to show you today. So make sure if you're eating that sandwich, pay attention here, because I got some good stuff if you want to learn how to get more money out of the markets. Now, maybe you're thinking to yourself, yeah, John, that's great. I'd love to be able to take, trade like a hedge fund, but those hedge funds are so sophisticated. They have the smartest people working for them, the best software, and they have all the cool tools. Well, here's the good news. What I'm going to show you is how to see exactly what the hedge funds see in real time in real world markets, so you can stay ahead of the masses. So today I'm going to share a tool that's essential to my trading. And after you see it, I'm quite confident that you're going to want to start using it immediately when you can see how powerful and useful this is. This is called value charts, and I'm going to call it the hedge fund fixer as well. I'm going to explain why this powerful tool can make a huge difference in your trading. Differences like this $41 rise in Microsoft. It's a 14% gain in a month. Here's a signal buy with an 8% gain. This is on Apple. And we got a buy entry, made more than 8%. And this is just in 2 days, less than 2 days worth of time there. And this is an example from earlier this year. We were watching Solo. They're an electric car maker. Of course, lots of the electric cars are going up here. This one signaled a buy entry on the 30-minute chart. We made more than 7% in just a couple of days. And if anyone wants to know, that Solo is actually called, I believe it's called the Electromechanica Vehicles Corporation. It's a Canadian corporation out of Vancouver, and they got some pretty cool cars. Well, let me tell you a little bit more about myself. I spent most of my professional career as a software engineer, and I still consider myself a software engineer, but also a trader. And I've been investing in trading throughout my lifetime. And I sometimes get asked, why do I teach others how to trade in the markets? And the reason is my dad. You see, he was the one who got me interested in stocks many, many, many years ago. And he explained to me that the only way to stay ahead financially, even for an engineer, is by using the stock markets. Now, he struggled to make money in the markets, and he always thought he could do better. And so I wanted to do better than him, and I wanted to figure this out so I could then go back to him and teach him and pay him back for all the wonderful things that he did for me. Many of us have lots of, things that our parents have done, and we'd love to pay them back. So I spent all kinds of money and time learning the markets, but I struggled myself for years until I started following the teachings of Basecamp trading. And that's when I finally learned how to trade. And eventually, I was a student of Basecamp trading. They asked me to come on and help them write some indicators, and I became full-time. Now I run trading rooms at times, and it's evolved. So I did finally learn how to trade and make that work, but unfortunately it was too late to teach my dad. And because unfortunately he had passed away, and it was too late to get to him and to teach him that, even though I did tell him and I showed him I was getting successful near the end in his life, and he was really happy about that, but he wasn't anywhere interested at all at that point, and then he did pass away. So anyways, instead of teaching my dad, I have vowed to teach others who are interested in learning how to trade, and who can then teach other people, and on and on and on. So I hope you'll learn how to make money in the market so you can teach your dad or your son or your daughter, your husband, your wife. I know that we can help others learn to trade so they can reach their financial goals in big numbers. And I know that would make my dad happy. So let's learn how to make some money in the markets here. Now, I would like each of you to achieve your goals. And what you're going to learn about today is something that has the capacity to get you well on your way. And some of you will even have the opportunity to transform your trading starting today. So let's get started. I'm going to introduce you to an essential tool to help you get an edge that a hedge fund trader has in your trading. In fact, I refer to this tool as the hedge fund fixer. And you're going to learn why I call it that today. This tool is called MQ Value Charts. So let me start out by showing you what value is and why it's important. We're going to start with the three components of trading. So we need three things in order to trade and trade well. That's price, momentum, and value. Now, price is something that's provided to us as traders by our charts. It's the current and historic price of the stock or the commodity or whatever you're trading. And price shows you the movement or the past movement in the markets. Momentum, that many of you use, shows us the power and the potential follow-through of a market. Momentum can be identified through a number of indicators. Now, we at Basecamp Trading prefer to use our own custom MQ momentum that we sell separately, and others may use something like MACD, etc. And that MQ momentum gives us an edge beyond MACD and other momentum indicators, and that's why we have it on all our charts. Now, the third component, and this is the part that's missing for most traders, is value. And value lets us know whether something is overpriced, or maybe it's underpriced, or is it the right price, the fairly valued price. And there are times when something is cheap, but it's still not a good value. And there are times when something is priced high, but it's still a great value. And in a way, value indicates the potential of price moving in the direction you want it to go. And it's something that many traders don't have access to when they trade, yet it's critically important. So if I told you that I had a car that was, let's say the car was valued at $30,000, and I told you I'm selling it for $10,000, that's a great price. But maybe what I'm not telling you is that it was in a flood in Houston a few years ago, and it's going to have some other problems. That's an example of price being good, but value not being good. So we want to make sure that we don't just look at price alone or even momentum. We want to include value in. Okay, but again, most traders don't have a tool that helps them identify what value is, because it's just not as readily available. There's things that come close to help you do this, but there's only one place you can get the patented tool that's proven to show value. But I'm getting ahead of myself here. Let me explain a little bit more about why value is critical to your trading and why you're at a disadvantage if you're not using it in your trading. So what is value, and why is value so important? Why is it part of these three things that are so important in trading? So one of the best ways to think about value is when we're out shopping, when we're going to buy something. Maybe it's a TV or a shirt or even a gallon of milk. And let's say we're buying a gallon of milk, and the price for a gallon of milk comes up as $3.99. You say, fair price, you think, but then what happens? Well, the very next day it goes on sale, and that $3.99 gallon of milk is now just $1.99. It's the same gallon of milk that was available yesterday, but now it's only half the price that you paid for it. If only we had a way of knowing that the milk was overvalued yesterday and it was going down in price the next day. It's too bad that there wasn't something telling us that milk was overvalued yesterday when we bought it. And how about now at $1.99? Is that a good price? Is $1.99 a good price? Well, we really don't know, because we still don't have a sure way to know if it's going to drop even further from here. Even at this lower price, we really don't know if it's fairly valued or not. Milk doesn't come with an indicator that tells us its value. The same thing with the stock market. When we look at our charts, whether it's stocks or futures, options, Forex, cryptos, whatever, when we look at a chart, we see a collection of prices. But whether the current stock price is overpriced or underpriced is tough to know. Price alone doesn't tell us that. Now, we may think that we have an edge when we look at a chart that shows the history of prices. Unlike the milk, we can at least plot out past prices and look where price is now relative to where it's been. But let me ask you this, if price is rising, how do we know if it's reached the point where it's likely to move back down again? Because that's what's important. We want to know whether it's got room to move higher or if it's ready to reverse. And that may have very little to do with price alone. We need more information to help us determine what the current value is. Let's look at another example where buying and selling is involved. Let's say we're buying a used car. The seller's asking $30,000 for the car. Now, that'd be a pretty good price on this car from what it looks like. But I'm just saying that, I'm just guessing that. I would need to check and see what this is worth, right? Because we're going to walk around, kick the tires, look under the hood, start it up, drive it around a bit, and then we're going to think about it and say, wow, is that $30K a fairly valued price? Because it sounds like a good deal, but we may not know for sure. Now, just like the milk or the market chart, it can be difficult to know if the price is fairly valued. At $30,000, are they asking too much? Or is that way underpriced and should we buy it right now? Who here, go ahead and type it in, who here knows what we can use to identify whether that is a fair price? Right? Who knows? Does anybody have the answer to know what we can use to determine if this car is, if it's asking $30,000, is that highly valued or overvalued or undervalued, or is that fairly valued? I see Ali back loaded up on solar. That's great. All right, everybody know? Well, I'm going to give you the answer here. It's something called the Blue Book. Now, sometimes it's not a blue book. It's actually a yellow book if it's the NAD guide. There you go. Chuck knows. Chuck got it there. The Blue Book is a guide that can tell us what the value of a car is. And we can use the Blue Book to look up that exact car, and the book will tell us what the value of the car is. So the Blue Book provides the value. It tells us whether the asking price is fairly valued or if it's overvalued or undervalued. And that's great for cars, but what about the stock market? There isn't a Blue Book for stocks that we can look up and find out what the fair value for Apple is right now. And if there was a book, it'd be outdated as soon as the next day. So what can we do? Well, the answer is value charts, of course. Value charts is the indicator that we can use to identify the current value of any market on any time frame. It works on stocks, options, futures, Forex, cryptos, any symbol. And since it's patented, you can only get it from Basecamp Trading, and we're offering it on MetaStock. And not only is it patented, but it's been analyzed and vetted by leading doctorates at key business schools, including the Wharton School of Business, University of Michigan, and the UCLA. And it's been hedge fund proven, where we've incorporated value charts approach into a hedge fund and changed it from losing to generating income. This hedge fund was losing $62,000 a month. And by applying the principles of value charts, we got it from going 62,000 loss a month into generating $27,000 a month. That's an $89,000 improvement per month just by adding value charts as a filter to the trading. Now, I know if it can turn around a hedge fund in such a dramatic way, it can improve anyone's trading. And that's why I call value charts the hedge fund fixer. So you're in the right spot. Be glad you're here because no one else can offer this tool but Basecamp Trading. So let me tell you more about this and how it's unique and how it's a valuable hedge fund fixing tool. And by the way, go ahead if you have any questions. I'm going to try to keep an eye on the questions here. So value charts does all the calculations to determine value in the background, but value charts makes that complexity of value very manageable. And it uses the concept of value and boils it down to just 3 colors on our chart. As you can see, there's some red and yellow and green. Now, here's the mapping. Look how the colors on value chart on the left here correspond to the color bands on the right. So you can see above this red bar here, or red band here, you can see that it's red, and then we have red to between red and green, we have yellow, and then green all through here. Then we have yellow down here again, and red, and that's the mapping. All right, so the colors on value charts on the left map to the color bands on the right. In the middle, we have green bars, and the green band means that the market price is fairly valued. So when we have a price that's showing up as being green, that means that the value is fair. Above that, we get into the yellow, meaning we're moderately overvalued. And if we get into the red, we're significantly overvalued. Similarly, if we go in the yellow lower section, that's moderately undervalued. And when we're in the red section, we're significantly undervalued. Now, why these colors? Well, these colors are similar to what you'd see in a traffic light, where green means go, yellow or amber means caution, and red means stop. And like a stoplight, we can drive right through the green lights, but we need to watch out for when they turn yellow or even red, because those mean caution or stop. And sometimes it means stop and go the other way in the case of value charts. Now, the value chart signal helps us know when it's time to move ahead and when it's time to be cautious and perhaps stop and go the other way. So most traders are trading without these signals. They don't know when it's okay to proceed based on value or when it's time to stop. And just like in driving, it's dangerous to trade without heeding these signals. Now, how do we use it? Well, let's boil it down to really simple form. We want to buy in the markets when they're undervalued and sell the markets. Hold on a second here. I want to make sure I close some things out here. I know we're getting these interruptions here. I want to buy the markets when they're undervalued. So when we see these red tips coming out down at the bottom here, that's better for buying. And when we look up here, it's better for selling. That is, we buy when they're on sale and we sell them when they're overpriced. And just like when we're shopping, we don't want to buy something if it's overpriced. So we don't want to go long if we have red at the top, because it's not as likely to go higher. Nor do we want to sell something that's already at a low value, as it's not likely to go lower. So we use value to help us determine if the market has more room to run in that direction. If we're in a long position and we start to see red bars at the top, then we're likely to see it stop rising. We're going to keep getting these interruptions here, I think. Similarly, if we're in a short in the market and we see red bars appearing below, we're likely to see it stop falling. Let me swap those. I'd like to swap those out, but I guess I'll just keep going here. I wish I could stop those. So what does value charts look like on our charts? This is Tesla on the daily chart. Okay, we only have price available to us on our chart. Right? So how do we know whether the current price over here on the right is fairly priced or too high or too low? It's difficult to tell. Hold on a second here. Bear with me for just a moment here, because I want to. There, that'll help. Okay, so let me back this up. Bear with me for just a moment. All right, so when we only have price available to us on our chart, how do we know whether the current price over here on the right is fairly priced or too high or too low? It's difficult to tell, especially when we're at the right side of the chart like this here. Now, it appears, if you know how to look at price, it looks like price is starting to trend lower here, and that the price action is telling us that the market's likely to continue falling from here. And in fact, looking at price alone, many traders see this as an entry point and expecting it to fall further. But now let's add back in value charts here, and now we can see the whole new dimension of value. Now look at the high and the low peaks on the price chart, and then look at the corresponding value levels down below. So we correlate the prices on the price chart with the indicator showing up below here. Notice that value isn't necessarily perfectly aligned with the high or low price pivots, and that's why value must be considered separate from price. Most retail traders aren't trading with the knowledge of value. It's hidden from them, and they aren't even considering it in their trading decisions. They're using price alone. And hedge fund traders, they have access to this type of information, and they're using it in their decision to make a much more informed value-based decision on when to get in and out of trades. Now let's look at that last bar again now that we have value charts down here. Okay, if you've been paying attention or happen to, and hopefully you understand what the lower yellow means, right? Value charts is indicating moderately undervalued. That's what yellow means, which means the market's less likely to keep moving lower. So without value charts, just looking at price alone, we might have gotten into a trade expecting it to move lower. But with value charts, we can see the market is already undervalued at that point. And taking a trade to the downside is probably not a good idea. In fact, it's actually telling us that it's likely a good time to buy Tesla. So let's see what happened. Let me show what follows up here. It turns out the value charts would have saved us from a potential loss if we were going short here. In fact, we got a reversal at this point and price went up, and it turned out to be an optimum entry for a long trade. So instead of taking a loss here with value charts, if you had value charts, we could have had a nice gain if you had it. Now, if you're new to using hidden value like this, it might be surprising when this happens, but it's something you can get easily used to when you start including value in your trading decisions, especially when they generate income like this. Because once you're trading with value, it's hard to imagine trading without it. And this is the kind of information that hedge funds have access to and they use, which gives them an edge. And it's this kind of inside information that could give you an edge in your own trading if you start using it. Without it, you're at a serious disadvantage. See, I see a question here. Michael says, personally, I would have varying shades of green, like pale green for fair value to dark green for significantly undervalued, and pink for overvalued, and red for significantly overvalued, more transition colors versus duplicating colors above and below fair value. You know, we've looked at that, Michael, and we feel that simpler is better, and it works great just with those, just with the 5 levels that we have. And if we had more levels, it might add more complexity and make it more of an analysis, which leads to paralysis, as you know, and then it's hard to make the decision. This way, we can identify exactly what's going on, what we have to do. So it's working out well with just these, but it is something I would consider doing. And then you can change the colors if you want, but not the number of levels there. So I would say keep it simple and don't change what's working well. But that is something. Maybe we can look into that if it is something that you think would make a difference. Now, I want to talk a little bit more about how value charts can help anticipate price movement. So in other words, how can we use it to make better trades? So what I want to explain here is how likely it is for price to stop moving in the current direction when we see these colors. That is, if we're moving higher and we get significantly overvalued, that, you know, the red light, then there's a more than 90% chance that we're not going to move higher. Now, we're likely to consolidate or even reverse on red when we see red at the top. And similarly, we're equally likely to consider or to consolidate or reverse when we're significantly undervalued. This means that there's a 9 out of 10 chance that when we get red on value charts, price is not going to continue in that direction. It's as if a stoplight just lit up and it's time for us to put the brakes on and stop. Now, for the yellow, moderately over and undervalued colors, we have a greater than 66% chance that price will consolidate or reverse when we turn yellow. That's roughly 2 out of 3 times. This means that if we see red or even yellow value on value charts, it's likely we're going to pause and we may even reverse. And this is how we can use the hidden value to our advantage, just like we could have in that Tesla example I just showed. Now, here's an example of how value charts can help us with anticipating those value extremes. Now that we know that when we hit a red bar, there's a 9 out of 10 chance that it's not going to keep going up at that point. Well, let's take a look and see where we had all the red, the lower red sections. And yes, if you look really closely down here, there's a tiny little bit of red, and that does matter. Okay, so at each of these points, I put a green line indicating that we expect a reversal to the upside. Did we get that in every case? Well, pretty much. If you look here, we got a move up here, a move up here, a move up here, a move up here, here, and here. Now, I said 9 out of 10 times. In this case here, every time on this chart, we reversed higher when we had a red significantly undervalued. Let's see how it looks from the other direction. Let's put a line in every time that we have a red overvalue, significantly overvalued value, and let's see what happens. So we went down, down. Sometimes we just kind of go sideways, but we stop rising. See the aggressive move up here, and then we just kind of stop rising for a moment. Here we reversed and moved lower. Here we reversed and moved lower. Lower here. This is a little bit sideways here, and then it continued up, and then this one's lower. Do you see how if we get these signals, it's probably not a good idea to be jumping in to go higher every time we get these signals? Okay? Value makes it clear how important, or this chart here makes it clear that how value is so important in identifying the better places to get into our trades, and also when it's time to get out, because you could get in down here and get out up here and maximize it on both ends. Now, at Basecamp Trading, we're all about price action trading. In fact, we give all of our platinum members our Naked Trading Mastery course as part of their membership, because price action is core to everything we do. We call that course, it's kind of a funny name, we call it Naked Trading, or Naked Trading Mastery actually, because it refers to reading what the charts are telling us behind all the indicators, like underneath the close. But this doesn't mean we trade without any indicators by any means. Naked trading doesn't mean we take all the indicators off the chart. It means we make sure that we can still see through our indicators so we can utilize fundamental price action in coordination with a select group of really useful critical indicators. And value charts is one of those critical indicators, because it's impossible to see value without an indicator. So we often use value when we're analyzing our price action in our trading. And these kinds of price action setups that we're looking at in naked trading is when we're looking for price levels, we draw trend lines, which include pauses in trends as micro trend lines, and we include patterns like pennants, triangles, and head and shoulders. Well, right here, we have the setup for what we call a micro downtrend line. And that happens when we're trending higher with higher highs and higher lows, and then we suddenly get a lower high and then a lower low. It's a downtrend. Now, what we're anticipating when we're teaching naked trading is that when we have a move up and then we have a micro downtrend here, we're anticipating either we're going to continue moving lower, in which case this was the top in the market, or more likely we're going to break through and continue this original move. So we're looking to continue this after a short pause. That's what we're looking for. So the question is, how can we use value to help us anticipate what's going to happen as we break out here? So again, here's the micro downtrend line. And this is because we trended up, had a temporary pullback. We got our micro trend in the opposite direction. So we're thinking it's going to break through. Okay. Now, if we don't have value, how do we know if it's going to break through at this point? No, we really don't. We can see prices approaching our line, but what we can't tell is whether that bar is ready to break through from a value perspective. Like, it might just continue lower, and we might just reverse and not continue high, not break through this line. So let's go ahead and add in value. Okay, so now we've added in value. Okay, who remembers what will we call this one? Anybody want to type it in? What will we call this value that we see here? And what do you think it means? What is the time frame? Can you use in a day trade? Yes, you can use it on a 5-minute chart. It can be used on weekly, monthly, daily, whatever time frame you want. So what we see right here, this is a fairly valued bar that we see right here, which means that it's not really impacted by value at this point, meaning we're not seeing a yellow top. That means this has freedom to run through this line. In other words, we can break through this micro trend line now on this. Right? We're not overly in yellow, we're not in red, so we can break through this line. Well, let's see what happens. Sure enough, we broke through the line on the next bar, and we ran pretty good. We went through this pivot, we went through this pivot, raced up. Now, if we look at price alone, what is it telling us? It ran up really fast, right? And it came back and actually tested this pivot right here is what it did. okay, and came close to testing this pivot. But how do we know what's going to happen here? Well, if we look down at value, value's telling us that we went right through the yellow and into the red, and then did it again, right through the yellow and into the red. In other words, we hit our head on the ceiling. And this is telling us that in spite of what it looks like here, that it looks like it's going to keep running, it's telling us that it's not going to necessarily follow through here. In fact, when we teach naked trading, we have something called a last kiss, and that's when you break through a support level and you might come back and retest that support level. Well, that's what this is telling us right here. Right? We take we take some partial profits here, maybe close out the position because we just got significantly overvalued. And then what does the market do? We came right back and retested the line. Okay, see how because we had value charts telling us, put the brakes on, red light, we knew it was probably not going to keep going higher. 9 out of 10 chance. And what does it do? It comes back to the line. Now, where are we going from here? Right? Do we bounce off of this? Do we move through it and go lower? What we want is continuation, right? That's what we were looking for, is continue this move from here. Okay. Now, what's happening with value charts being fairly valued here, it's not telling us that it is unable to go higher here. So right now, because we don't have any yellow or any red on this, we can go higher. So what happens? We race higher. Up we go. And that's what we anticipated. That's why we wanted to get into this trade, because we wanted to have a continuation of that initial move. But look what happened. We got up to here. And because we have what we call a red hat right there, the red stop sign, the red stop light, it said, hold it. We're not going to go any further. Right here, when we get this red hat, it means lock in your profits. Start trailing your stop right up underneath these bars, because if it reverses, you want to have profits in here, because this is saying, remember, 9 out of 10 chance that we're not going to keep going higher. And that's exactly what happened. It pulled right back. So this is how we can use value charts in coordination with price action to help us anticipate what's going on in real time as the bars build. So we can get an idea right now, take partial profits up here because we got into the red. We know it's going to come back to retest the line because we didn't have any color on this bar. It was fair valued. Now we can run higher, and up we went, got overly valued here, and we take more profits here as the market then pulls back. See, value charts let us squeeze extra money out of the markets. And if we didn't have value charts, we wouldn't know that that was all part of the natural flow of the markets there. This is why you want to have value in your analysis of your trades. And if you're not using it, you're at a disadvantage. Now that you've seen how value charts can help us identify critical value-based turning points like that, and see how it can help us trade, let's look at some of the special enhancements that are only available in the MetaStock version of value charts. And these can make it easier to use, because value charts can help you pinpoint, as you saw, your trade entries, your exits, and maximize your gains. So while we can use value charts colors alone to indicate when to enter and exit, and that's how we use them on most other trading platforms, because MetaStock has those extra capabilities, we're taking advantage of the extra tools that MetaStock offers. Okay, so here we can see some of the value charts highlights on the charts. These highlights, what we call value signals, will actually tell you buy here, sell here. But those are the VC buy and VC sell signals. We also have a couple of other indicator arrows that are on the charts here. You can see right here, this is called bullish pressure. So as we're pulling back, there's not necessarily a buy signal, but a likelihood that we're going to pull back and push forward. Now, these are in addition to the colors that you'll see down below on value charts. So value charts just being red down here is an indication we're probably going to go the other way. But there's other technology being taken into account to tell us that it's likely to go up at this point. Not enough to jump in with a full buy signal, but enough to give us some, as I say, pressure to push us in that direction. Up here, when we got the VC buy signal, up we went, and then we started getting some pressure to go sideways. And look what happened as we got that pressure. So it's helping us interpret the value chart signals, adding some extra analysis in, almost like a like a team of experts helping you analyze what value charts is telling us. Now, you also get value trend dots, and these make it easy to see value chart extremes right on the chart. You can add these optionally to your chart, and it gives you a reminder of the value conditions right on your price chart. So we can take action and anticipate the value-induced movement. And I like this too, because one of the reasons it's good is because since we like to look at price action, we almost prefer to minimize the number of indicators we have down below so we can see what's going on the chart. And by bringing the dots up onto the chart, then we will get the signals right here that we can see. We can come right up here and say, oh, the brakes are getting put on, and realize that it's likely to not go higher. And sure enough, we pull back. Then we get the brakes down here. We say, okay, we're not going to go lower. We come back up here. There's a pause, a little bit of pause here. And then it took a while before it fell. And then we get a bounce here. Remember, 2 out of 3 times on the yellow will reverse. So we do get the signals. We can also get the dots, and they can be reminders about value. Okay. The other thing we get here is the trend ribbon. And the trend ribbon that's included as part of the complete suite that we include for value charts. It's tuned to be highly responsive in indicating bullish and bearish bias. This thing changes pretty quickly here. Notice the alignment between the trend statuses to the chart movement. So notice that it managed to get red right here, and it stayed red right until here. So I haven't tested this out, but when I was setting up this presentation, I was like, I need to go back and look at just entering on trend indications here from the ribbon. But usually I like to have multiple things making a case for any trade. I always feel like I'm a trade attorney looking to make a case and give a preponderance of evidence to get into a trade. And the more things that line up, the better. So having this extra piece of information is great in telling me that we are either in a bullish mode or a bearish mode. Now, all of these things work together to find optimal trades. And this is the SPX weekly chart giving us an optimal sell signal back here in early September, and right before the market experienced that 5% pullback. So that's an official sell, and this is on the SPX. And then as it pulled back, we got our indication here that we got significantly undervalued. That let the market slow down, and up it went. And then right here, just a couple of weeks ago, and this is the current bar here, a couple of weeks ago, we got a signal saying that's as far as we're going to go for the moment. There's a 9 out of 10 chance that it's not going to keep going higher, and we've gone sideways. Remember, it doesn't necessarily mean reverse. It means we stop going up, and that's what happened here. We're just kind of putting in a couple of dojis so far. Okay, so we can use value charts on even a higher time frame like this. I think it's, like I said, this is the weekly chart, and it can set our direction across the entire market based on what's going on here. So we'd stay primarily bullish throughout here with the buy signal, and then change that here, take our profits here, and then see a signal and say, all right, we'll go back up again. And all this being value that can direct us this way. And something, if you don't have it, it's something sorely missing in your trading. I also wanted to point out very quickly here, we include MQ momentum, and that's because momentum is that third leg that we have: price, momentum, and value. So we do include MQ momentum. And for those of you who are familiar with MACD, it's similar in the way it looks. But if you know about how the MACD works, the MACD really only generates this white line, and then the dashed line's an average of it, and then the difference between those two generate the histograms. So what's important in an indicator is that white line generation, and that's how MQ momentum is different than MACD. MACD is not as responsive as MQ momentum. So MQ momentum is like the Ferrari compared to not a Yugo, but say just a Ford, or an average sedan. We want to trade with the Ferrari. We want that extra edge. We want to know before everybody else. And that's what MQ momentum gives us. So how do we use this? Well, we look at MQ momentum down below. And again, this is included with value charts because of that. Those 3 things are needed to trade. This is your momentum component. So when we have a trade right here at point A, you can see that price and momentum are both moving higher, and therefore they're in alignment. So we'd expect price to continue moving higher. Over here, you can see price pulled back, was starting to rise up, but momentum was dropping and telling us very strongly that it wasn't going to go up. So no surprise that it gapped down and moved lower. Now here's an interesting one. If you look over here, you might feel that price is going to continue dropping, right? We're moving lower. We got a little bit of a micro uptrend here, like I showed you earlier, and then we fell through there and we're dropping. In fact, it looks strongly like it wants to go the other way. But what I want to point out here is that at point 2, we have what's called a bullish divergence. So here is the pivot from here and the pivot from here. You can see price had dropped over those 2 points, but look what happened with momentum. So we call this a bullish divergence, and it's an indication that this is a false move lower. Therefore, we can anticipate that the market's going to rise. And this is what happened. So what we want to look for are this type of divergences. And this is just one of the things we use MQ momentum for, alignment of our trades along with what price is doing and value. Now, we also use multi-time frame analysis, and that means we look at value charts on a weekly chart at the same time we're looking at the daily chart. So if we see that we're bullish here, like we are in the SPX, rising in this example, and this was back in October, then you would anticipate that you'll see rising on the daily chart. And we combine those two and try to swim with the current. So let's pull all this together. And this is with the price action, momentum, and value. And we'll start out here. We get a VC buy signal. And because momentum's pulled back here close to the 0 line, we know we have room to run. And when we get this little bit of reversal here, when we get a value chart signal, we're going to maybe take a little bit of profits just to offset our risk, but we want to stay in for the longer run here. Okay, so we know, and because this by the way is the same chart that we saw in the previous chart, so we know we're bullish on the weekly. Therefore, we want to stay in this trade for a longer term run, and we're not going to get scared out by this. So we hold on. Momentum's still rising. Okay, this is where momentum is rising. And at this point, you can see price moved up here. It runs nicely higher. We're getting a bit of bearish pressure right here. See the bearish pressure? And remember, bearish pressure doesn't mean that we're going to get a reversal. It just means we want to anticipate a pause. And I already said we're looking for a longer term gain here. We want to stay in for a longer period. Momentum's still growing through here. Up to this point right here, momentum's rising strongly. So we can even add to the position on this pullback. Okay, now at 0.5 here, we saw this nice rise here, and you can see momentum did kind of go sideways on that bearish pressure, but it raced higher. And you can see we started to get bearish pressure indication. So sure enough, eventually we just kind of went sideways. And then we said, let's just hold on because everything looks good. Momentum on the higher time frames is good. Price on the higher time was good. And then suddenly we pop up here. Now, if you're paying attention to that divergence thing, you might notice something. And that is that we had a pivot here, which corresponds to this point in our momentum indicator. And then here we have value at an extreme, a really strong extreme here. At the same time, we have a lower pivot. Okay, so at this point, we just take our profits. Okay, because this is the first time that when we have a high, this right here was a pullback. This is a convergent when they both pull back. But this high is higher than this pivot. This pivot high is lower than this one. And even though we've got value pegged out, like we had back here, this is the time we take our profits. Sure enough, the market didn't rise anymore from there. And that was the opportune time to take our profits. That's 133 points and a really nice gain. There's even more included in value charts. You get the expert commentary, you get the explorations, you get a user's guide that tells you how to do all these things. There's a bunch of stuff included in here, but ultimately it comes down to all these different things that you can do, and there's more you can do with value charts. One of the interesting things is range trading, and that's when you're in a sideways channel, you can just start buying on the undervalued and selling on the overvalued, but you got to be ranging. But ultimately it comes down to anticipating market turns, making sure we're buying stocks when they're on sale rather than when they're overpriced. And we can avoid jumping in when they're red at the top. That's when they're overpriced. And we take our profits when they are overpriced at the opportune time. But ultimately, you can make it as simple as finding that VC buy signal and taking the sell signal. This is on Microsoft, by the way. So as you can see, trading with value can transform your trading. And I hope you can also see that if you're trying to trade without it, you're at a serious disadvantage. And if it ever feels like the market's chewing you up and eating you for lunch, perhaps it's time you got tools that the hedge fund traders are using. And they have the tools so they can see these types of moves before they happen. They can help them get in at the optimal times and get out at the optimal times. And that gives them that edge. So why would you want to trade without having this type of information? Because you have the opportunity to get that here and get these kind of trades with a 12% gain in just an hour and a half, or $21 gain over the weekend. This is in formerly Facebook, now Meta. Yeah, that was just over this past Halloween. So I said I would tell you how to unlock a hidden hedge fund technique for better trades, and being able to trade like a hedge fund for massive profits is how we can expose that hidden information that's behind the chart so we can get those massive profits. And you now have the opportunity to completely transform your trading using these tools, using MQ value charts, and trade like a hedge fund. And you can add it right now. Remember, it's patented. You can only get it from us. It's got vetting by all these business schools. It was used in a hedge fund to turn it around and change from hemorrhaging cash to generating lots of income. And you can get it today. And here is the price. Okay? And don't forget, you have a special price today because of the Traders Conference special, and you get a 30-day money-back guarantee. Now, just a reminder here of all the stuff you get. You get the charts, the signals, dots, the trend ribbon, the alerts, which I didn't mention until here. You get also the MQ momentum indicator, which we sell in our store every day for $300, $297 just for MQ momentum. That's included. You're getting your explorations, the expert commentary, and the user's guide. And it all comes with that 30-day money-back guarantee. That lets you try it out. And if you don't see your trading improve, send it back under the 30-day money-back guarantee. And remember, this is only available here because it's patented. If it feels like something has been missing from your trading, you're right. It's bringing value into the equation. And you can add it in to your toolbox right now. Jeff, that's what I have here. I guess we can look at some more questions. I know we're running a little short on time.
All right. Good job, John.
Well, thank you.
We did have a question that I thought was interesting that I was going to ask to you from the YouTube audience. Actually,
Okay.
have two. Neil wanted to know, is this using the value charts algorithm that was created by Mark Elwood and David Stendhal?
Yes.
Okay. I thought so.
Yep.
So
yes, it is.
I thought so. Okay.
Yeah, we were
also,
known as value charts, and our website was called valuecharts.com back then. And what we did is we wanted to pivot away from everything being about value charts, which is what it was, to expanding beyond that. So value charts is still core, and we are the former value charts company. We're still under Microquant, which is the parent of both of those.
Okay. And then let's see. Nellie wanted to know, she said, this is very interesting and valuable, and then she gave you like the little clappy hands emoji, but she wanted to know, can this be used in the markets in the Philippines?
Oh, absolutely. You know, because this thing is, it doesn't care what market it is. I mean, the only place that I wouldn't use this would be something where you have synthetic charts, because synthetic charts don't really show you the real low and high of a bar. You know, if you look at like a Renko chart will draw the bar where price hasn't yet gone. So it's not really truthful about where price has been. And when we feed things into an indicator where we're using highs and lows and extremes of a bar, which value charts does, then that false information makes it so it doesn't work as well. So what we do when we're trading those synthetic charts is we'll use them on time charts and tick charts, and it works across all time frames on those kinds of charts. And then we make our decisions based on value off the time charts, and then drill down like we would a tick chart into the Renko chart. So it's going to work on wherever you have data for on time and tick charts, and that includes the Philippines.
Okay, last question I think we have time for. Did you mention the range percentage around your estimate of fair value, as well as the other percentages above and below? Are they significant?
The range percentages? I'm not
That's what I
sure.
said. Okay. In that case, Michael, what I'd have you do, just reach out to us. If you have any questions at all, there was a person that wanted to look at a Tesla chart, and we just don't have time. But we'd be happy to send you any chart. Just give us a call. We can pull it up for you. 800-882-3040 for those of you in the US and Canada. If you would prefer to listen to our upcoming speaker, Tyler Wood, and maybe just want to start a sales chat, go to metastock.com/sales chat. Totally understandable. You can also email us, but sales chat is probably the best way to go about it. Gene asks, and thank you for the question, Gene, is this a one-time charge? It is. You pay for it one time. We do back it with a 30-day money-back guarantee so you can evaluate it, make sure it works well for you, and you own it for life. Thank you for that question. And thank you for all the questions, actually. So, John, I want to say thank you for spending some time with this. That was a really good demonstration. I really like the integration that you did with MetaStock. It's really nice to see the commentaries and the scanning and all that kind of great stuff incorporated on there as well. So if you guys do have questions, give us a call. Sean, thank you very much for coming in today.
You are very welcome.
All right. Prepared
And
to
Vic,
be a...
I see a question from Vic, and Vic's asking, since I already own, or I'm not sure who it was here. Somebody asked if I already own it under Thinkorswim, can I get the MetaStock version? That's Bradley, I guess. Contact support at Basecamp Trading, Bradley, and I'll help answer that question for you then. But I believe we can make something work there for you.
All right, very cool. Super cool. All right, thank you very much, John.
All right, you're welcome. Have a good day.
You bet. No, you too. All right. I can see you, Tyler. How you doing?
Oh, I'm doing great, Jeff. How are you doing today?
We're doing great. It's been a great week. We've done, now we're at, I think, hour 35, just broadcasting.
35 hours so far this week?
Yeah, It's crazy, right?
You're like Casey Kasem, counting them down from the top.
We're almost, after 35 hours of practice, I'd say we're almost good at it.
That's right. That's right. I think it's actually 10,000 hours, isn't it, to be proficient?
Right. Yeah, something like that. Anyway, let's go ahead. So just let me read the phone number again: 800-882-3040, metastock.com/sales chat. People really like that add-on. Give it a go. It's a good one. I don't have a slide for it right here, but for probably 34 times over the last couple of days, I've been talking about the CMT Association, Tyler.
I've been noticing.
And I've been struggling in terms of finding the right words. I think I settled on accreditation. You guys work with a lot of brokerages.
Yeah.
It's one of the things that kind of, I think, comes with a lot of respect is that CMT Association and that CMT label. What I would like you to do, I'm going to actually kind of get out of the way real quick here. Let's make you the presenter. But I'd like you to talk a little bit about the CMT and kind of like what it is you do. And I'll use that actually as we talk about you in the future as well. So let me make you the presenter here.
Perfect. See if I can do a little screen sharing. We want the other one. There we go. Is that coming through all right?
Yep, we can see the right screen, and it came through perfect. And I'm just going to get out of the way.
That sounds great. You know, you asked kind of the perfect question, Jeff, which is, what does the CMT Association do? Why would anybody be interested? And I'm definitely going to address a little bit of the background, a little bit of sort of where the organization started from. But the way I like to think about it is that you've got MetaStock, which is sort of like a Stradivarius for violin players. You know, that's the top of the line. That's the most incredible instrument. But you could put a Stradivarius in my hands, and I'd definitely break the instrument, hurt it somehow, maybe even hurt myself. And so professional violinists would go to a school like Juilliard. They would learn the basics, music theory, composition. They're going to take a bunch of methods classes. They're going to learn techniques so they know how to play the instrument. The instrument itself can produce really beautiful sounds, but the player has to know what it is they're trying to get out of the instrument. So if that analogy is helpful, perhaps it's a little self-aggrandizing, MetaStock being the Stradivarius, the top of the line instrument, CMT Association being the music school that you would go to learn how to use all of these tools. So thank you very much, Jeff, for inviting us to be a part of this conference. What an incredible week. Just an all-star lineup of speakers, presenters, innovators in the field of technical analysis, which is really, that's our wheelhouse. We exist to advance the discipline of technical analysis. We do that through a number of ways, but first and foremost, we try to help investors improve their decision-making process, right? So a lot of tools, a lot of strategies, process, not a how to trade, not a trade like the CMT Association trades, but rather what is it that analysts would be looking for in all of that market data. And then the second thing is to open career opportunities. Since the very foundation of the organization in the late 1960s, it's been an advocacy group for professionals in the space. So CMT Association is a New York-based nonprofit. I describe us as an international credentialing body, so the CMT charter, that mark, which we'll talk about the exam process in just a minute, but also a professional association that gets together, here's the expertise of our members and charter holders, the folks who are innovating and really cutting edge techniques in technical analysis. So for all of those on the line right now who are thinking about a career in finance, the CMT credential can offer an incredible path to a profession in financial services, but also join the CMT Association and learn from some of the best experts out there. You never know where you're going to meet your next best friend or a new client or new associate. So I describe us as a 50-year-old startup. I know there are thousands of people who have attended this conference, many of them very well-known technicians, authors, creators, fund managers, and professional traders. Not all of them have the CMT designation after their name, and that is because we are still growing. So 50 years in, what started with a very small group of sell-side equity analysts in New York has expanded across the globe. We're in 137 countries. With more than 55,000 people who participate in our educational conferences, events, local chapters. And Jeff, I know you've made a couple of on-the-nose jokes this whole week about just how long we have been staring at screens and not talking to each other and sharing ideas in a physical space. So hopefully in the years to come, we can invite you and all of the MetaStock users to a CMT Association conference, whether here in the United States or in Mumbai, India, or in Hong Kong, or in Europe, you name it, we're all over the place. So the way that we execute on that mission, when I talked about improving investment decision-making and opening career opportunities, we do that through a number of different mechanisms and channels. For those of you who are just new to the discipline of technical analysis, who are here to learn, I commend you. Late on a Friday afternoon, the week before Thanksgiving, thanks for sticking with us. Hopefully I can share a few concepts and tools with you. But as soon as this presentation is over, why don't you head over to cmtassociation.org. You'll find a ton of learning resources, recordings from past events, publications that go back to the 1970s, our Journal of Technical Analysis, and it goes on and on. So it's really a treasure trove of information for those who are looking to learn. I also wanted to point out a new channel that we launched this year. We've had podcasts in the past, but we've relaunched Fill the Gap, which is there to shine a light on the practitioners of technical analysis, whether that be client advisors, institutional money managers, research analysts, innovators, you name it. But we dig into the process and tools of those men and women on Wall Street who've really helped create this discipline, who've pushed it forward. So you can listen for free wherever you listen to your podcast, wherever you download that. Be sure to check out Fill the Gap. We're just finishing up season 1, episode 12 coming out in December with none other than John Bollinger. Really looking forward to that. All right, so here's what we're going to do in the next 45 minutes or so that I've got left. We're going to talk about how we define technical analysis, what that means to us at the CMT Association. We're going to talk about the tools that help improve your investment decision making. And then we're going to talk a little bit about why people would consider going through the CMT program, sitting for those exams, and what the value of that trademarked charter, that designation, does for you. All right, so let's dive right in. I had the great pleasure of talking with Bob Farrell. Robert J. Farrell is an illustrious Wall Street veteran, 60 years in the business. And he talked about how limiting that term technician is. He said that we're market strategists, we're money managers, we're financial advisors, we're systems developers. He was when Ralph Acampora and John Brooks founded our organization, they had to seek Bob Farrell and Alan Shaw's approval. And he said in an interview with Bob Farrell this January, he said, "I have never liked the term technician because it's too limiting. I'm very much in favor of finding other ways to describe what we do as technical analysts. We study so many things, such as price trends, momentum, money flows, cycles and waves, supply and demand changes, volume relationships, insider activity, monetary policy, and historical precedent. We have a broad field of study that has grown more inclusive with time and the computer age." And what Bob Farrell is really hinting at is that defining technical analysis really needs to start with a much broader stroke than what a lot of financial news media and professors in my MBA program would define technical analysis as. Obviously, we can go back to the Bible of technical analysis, Edwards and McGee. They talked about the study of the action of the market itself. It's a pretty broad-based definition. We've got a lot of work from Perry Kaufman in our CMT program curriculum. He talks about the systematic evaluation of price and volume and other market statistics. Now, we know it starts with a chart, and our marketing team did a great job just putting together this infographic. I worked with the board of directors to really help define what we see as the value of technical analysis. And so the CMT Association believes that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price. Now, that's across all asset classes, and we do that through a disciplined, systematic approach to market behavior and the law of supply and demand. Now, I know that's a lot of big words. The graphic on the right side of your screen is showing you that gap between value and price. And what we really embraced, working with a fellow named Aswath Damodaran. He's a professor at NYU Stern School of Business. This guy is the guru of fundamental analysis. He lives and breathes discounted cash flow statements, right? But we're at a technical analysis conference, and for all the MetaStock users out there, this might sound insane, but a lot of fundamental analysts talk about how the market is so often wrong, how prices are elevated way above or way below their estimate of intrinsic value. And so we know that when you go to an MBA program, when you study the fundamentals, you're going to look at accounting estimates, you're going to look at cash flows, the quality of those cash flows, the growth of cash flows for a company. You're understanding the company. That is the driver of how analysts might estimate intrinsic value for shares of that company. But we're talking about market price. And after all, it's only price that pays. We're not buying the whole company unless you're a private equity investor. We're talking about the drivers of market price, which are things like mood and sentiment, supply and demand relationships for shares at any given time. And when I first started at the CMT Association over a decade ago, Ralph Acampora came into the office and he said, "Tyler, you're ever talking to anybody about technical analysis, I'm going to need you to show them this chart." And I believe this was handed down to Ralph. He used to use IBM as the representative mega cap stock of the day when he taught at the New York Institute of Finance for over 40 years. We're going to talk about Apple. And I just want you to think about this picture. The top half is the company, and that has a PE ratio, that has competitors in the space. They have a management team that might be very efficient or very inefficient at allocating capital throughout the firm. They're going to have perhaps pay a dividend. They're definitely developing new products which are going to generate those future cash flows. But if we want the whole picture, we have to also look at the stock, which is separate from the company. This is Ralph's main point. The stock is not the same as the company. And so if we are technical analysts, we are looking at the stock, we're looking at the price and the volume at which it trades. We might look at open interest or other internal market statistics. We're going to look at supply and demand relationships for shares of that stock. And then, of course, we want to understand the psychology of market participants at any given time, which can affect the price of Apple stock regardless of what is happening with the intrinsic value. That's the most important thing I want. If any of you are taking notes, if you're going to take away anything from this, it is that the moods of market participants, that fear and greed that drive us as human beings, that is what influences price in the markets. And for a quick example, I want to share this video with you that the my good friends at Prudential Securities put together, or at least found from back in the day. Let's see if we can get that to play.
The gentleman in the elevator now is the candidate star. These folks who are entering, the man with the white shirt, the lady with the trench coat, and subsequently one other member of our staff will face the rear. And you'll see how this man in the trench coat tries to maintain his individuality. But little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. We'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups. Now, here's a fella with his hat on in the elevator. First, he makes a full turn to the rear, and Charlie closes the door. A moment later, we'll open the door. Everybody's changed positions. Let's see if we can use. I want to see if we can use group pressure for some good. In a moment, on Charlie's signal, everybody turns forward. Notice they take off their hats. Now, do you think we could reverse the procedure? Watch.
Now, as John Bollinger has referred to at CMT conferences for years, we continue to explore and expand upon those first principles of the market. By first principles, we're talking about human nature, right? We know that markets have been evolving, new technologies come into play, market structural changes with regulators stepping in, but the only constant is that human beings continue to behave with these cognitive biases, with these inherited traits that we just cannot avoid. Now, the herding principle, we talk about price momentum, we talk about market trends, we're always drawing trend lines. Now, economists like Amos and Tversky, who have studied cognitive psychology, they're giving these different terms. They're talking about heuristics, and the herding principle is just one of many. We could be here all day talking about the great work of some of those cognitive psychologists. But as technicians, we really are here to understand what that human behavior is doing in the marketplace. And when we talk about price momentum, or we talk about that herding principle, we're really just distilling the concept of supply and demand, right? At a fixed level of supply along that supply curve, an increase in demand is going to increase price as we move up that fixed supply curve. That's where we find the equilibrium, and that's where, frankly, all throughout the day, buyers and sellers of stocks and securities are meeting in the middle. That's where we establish price. So the price analysis is really distilling all of that human emotion, expectations on intrinsic value, interpretations of fundamental reports. We're cutting short a lot of that fundamental work of those analysts and focusing instead on what the market is telling us with price. Now, I just have a couple of quick illustrations. I do a lot of presentations for college and university students, as well as employers in the financial services industry about why they might want to pay attention to technical analysis, why they should be hiring CMT charter holders. And this year is just full of great case studies. AMC, depressed, sure, below its intrinsic value as we went through the coronavirus collapse, as things were in lockdown for public health concerns. But now it's trading, it traded up above $75. It's currently trading at about $40 a share. I'm going to go back to movie theaters. I love movies. but that's a $6 stock. And there's no, in no rational terms, could we justify an intrinsic value of AMC Entertainment Group at $75 a share. They're just not generating that kind of cash flow. So we know that it is not intrinsic value that is driving market price. We know that we're in unprecedented times in terms of social media's influence to rally traders and investors around individual stocks. But I just had to point out a couple more, like GameStop. I mean, that was a bad business model when it was invented years ago. It certainly has not evolved with the times, and it certainly does not justify the trading that it's been doing. And then I always bring up in any of these presentations, what do you do about a whole asset class which has no fundamental information, right? Digital assets, cryptocurrencies do not have fundamental drivers. You cannot estimate an intrinsic value to a Bitcoin. What you can assess is how much people are willing to pay for said cryptocurrency at any given time of day. And for that, we turn to the charts. All right, so let's talk a little bit about these tools that we cover. The course of study in the CMT program is very broad indeed. I'm just going to touch on 3 today, which I think are very foundational concepts that many of you might be familiar with, but I just wanted to at least outline sort of how we think about markets conceptually. We're going to talk about relative strength and how important it is to understand performance of a security relative to its benchmark or to a group of its peers. We'll talk a little bit about market breadth, which touches on the entire concept of market internals and all of the data that's out there to assess the market mood and the psychology of investors broadly. And we're going to talk about divergence. And we've had some incredible presenters so far at this MetaStock conference who've talked a lot about strategies for leaning into stocks at major reversal points of overbought or oversold levels. We're going to talk about that and where it confirms or diverges from what price is telling us. But let's start with relative strength. Martin Pring, who's featured throughout the CMT curriculum, says that it's a technical concept that measures the relationship between 2 securities, one security divided by the other. Relative strength can be used to better understand an intermarket relationship. Now, I would expand on what the good Dr. Pring has written here and just say that you could look at relative strength of a whole basket of securities. There are tools out there now that could show multiple securities against a central benchmark. And hopefully Jeff and team will be implementing some of those into MetaStock as well. But just for sake of argument, we've been reading analyst commentary for months, really throughout all of 2021 as we've had this market rotation into cyclical sectors. But if we're going to simplify things, let's just take the ETFs for the S&P 500's growth and value stocks, right? So growth on the top line, value on the bottom. And if we're just looking at those 2 charts, we can see that broadly they have gone up together and gone down together, right? This region here is the coronavirus collapse. We bottomed and they have both taken off. But if we really wanted to understand where we can fish where the fish are, so to speak, if we want to narrow the universe of securities that we're looking at, and in this case, equities, do we want to be tilted into growth or value stocks? Well, for that, we would look at a relative strength chart. This red line on the bottom divides growth equities by value equities. And obviously, when that line is moving down, right, this period here in the spring, February and March, and then more recently in September, we saw that rotation back into the cyclical sectors. And obviously, we could debate all afternoon about what the great minds have put into these ETFs and whether or not that is a true representation of the growth equities or the value stocks in the S&P 500. But that's for another day and a different argument. If we're just looking at the relative strength line, we can tell that growth has broadly outperformed value. And currently we are in that phase of outperformance for growth over value stocks. Now, that's a very surface level discussion of the concept of relative strength. But you've got folks like John Murphy, founding member of the CMT Association, who's written tomes about intermarket relationships. Guys like Marcos Katsanos, who have brought some statistical rigor to that, quantifying what the correlation coefficients are between different asset classes, what we can glean from the bond market that's going to tell us where we're at in terms of the cycle for equities, or as we've been reading and hearing about on financial news media so much lately, this inflation debate, what that's going to do not just to the US dollar, but also to the price of equities and the valuations. Now, relative strength is a core concept tested throughout all 3 levels of the CMT program. And I believe one of the big strengths of technical analysts is that we can organize tons of market data, comparative and absolute on individual securities. All right, let's talk a little bit about breadth. And Perry Kaufman has defined that as the measuring the imbalance between advancing and declining stocks. A net increase in the breadth index would be where more issues are declining, and that should generate concern that the upward move is poorly supported. We've had a lot of great speakers at CMT conferences, many of whom use sports analogies, and what we're talking about here is bench strength, right? You might have a star performer. Let's take a look at mega cap growth equities who have really buoyed throughout that coronavirus rally. After the low in April, we saw just a very few names, concentrated movements higher, but not broadly supported by the rest of the index. And so what technical analysts are looking for is, do you have strength of leadership across multiple sectors? Do you have broad participation in a market rally? Or is it just a few heavyweight mega cap stocks leading the charge? All right, is it a stock market or a market of stocks? And so just to illustrate the point, what we're talking about is the advanced decline line. That's what's shown here on the bottom. This is closing daily data, and we're looking at that against the IWM. So that's broadly small cap stocks, the Russell 2000, and we see the coronavirus collapse. We see that the advanced decline line turned over ahead of the price move, right? We saw that declining participation before the Russell tanked. Now we see increasing participation, a healthy return of the market throughout this rally period. Now, when we see stagnation in price and the advanced decline line really improving, we know that we've got a market that is in rotation. We are seeing leadership change hands, and that's been a really difficult market for a lot of traders to survive. But what we're looking for here in terms of market breadth is whether or not we've got broad-based participation. It is a healthier market when more stocks are participating in the upwards move. If you just see the price of an index reaching new peaks as fewer and fewer shares are participating, it's a cause for a sign of worry. Now we see, and this chart is a couple of weeks old, we see that advanced decline line beginning to pull back, perhaps suggesting some weakness in this rally. All right, let's move on and let's talk a little bit about our third topic, divergence analysis. Now, indicators, these are calculations made from price, volume, breadth, and others, are used to identify important market action and to help separate signal from noise. And that is one of the core concepts of the CMT program. We do not want to just add more data. More data is not informative. And in fact, as you're going through the program, you're going to find out about chart types and data construction that you hadn't ever considered. Perhaps for some of the youngsters on the call, point and figure charts, that doesn't even ring a bell. Or even thinking about range bars. Maybe we're not even concerned about time on our x-axis, right? We want to look at data that is informative. And so divergence analysis helps us know whether or not the indicator is confirming price action. And there are millions of indicators out there. We've seen a number of them this week that are really helpful, additive to looking at just price alone or just a single chart of the share or the security. But when we're looking at an indicator, we do not need to add panel after panel after panel or line after line after line on the chart. My good friend Alex Cole is going to be up here next at 3 o'clock talking about how you can help eliminate that kind of analysis paralysis that comes to a lot of technicians. I'm guilty of it. We've all been there. But when we're talking about divergence, we're talking about using a derivative indicator, a derivative of just the price chart, to see if there is confirmation or divergence from what price is telling us. So on the left side of your screen, you see we're making higher highs and higher lows as Bitcoin is rallying. But in our relative strength index, the RSI line below, we're seeing that momentum is not supporting that new rally in price. We see a divergence, meaning that price is continuing to make new highs, but it is making those new highs on lower and lower momentum, fewer participants. And if you think about throwing a baseball up in the air, it's going to leave your hand at the fastest pace that it can. And as it reaches its apex, it's slowing down before eventually rolling over and succumbing to gravity. Stocks move when they are trending like that as well. And I know Alex is going to talk about some more momentum indicators here in a minute. But when we see this bottoming, right, lower low, and we see an improvement in momentum on the RSI, we can see that there's a positive divergence, not a negative divergence, a positive divergence, telling us that perhaps that trend for Bitcoin will be able to resume once RSI regains its strength. The momentum of the buyers is overpowering that of sellers. And that's, again, coming back to that first principle. We are just discussing what the market participants are doing from a behavioral perspective. All right, staying with me. Thank you, everybody. We're at about 2:30. We're going to move to the final section, which is just to talk about the CMT program and about why participants in the CMT exams are so eager to earn that CMT charter. But before we get to the specifics of the CMT program, I want to talk to you about two more definitions. As I know MetaStock, and from many of the charter holders in the CMT community, MetaStock is an incredible tool for screening, for looking at statistical correlations, and for even programmatic trading, right? But I want to define quantitative analysis for you. This is right off the internet. Investopedia defines that as using complex mathematical and statistical modeling, measurement and research to help assign a numerical value to variables that replicate reality mathematically. That's a mouthful. What we have seen happen since the 1960s in the CMT Association is that all of these concepts of technical analysis, everything that was done pencil and paper on graph paper by all of the founding members, is simply put into a computer. And the quantitative methods which we can use to understand the rigor and validity of signals, of indicators, we can test the 30, 60, 90-day returns after a signal has happened. We can look back at historical data. We can walk that forward. We can simulate what it's going to look like to help assess the objective, the probabilistic or statistical weight of any given technical signal. That is objectifying technical analysis. There is much more science involved in the CMT program, many more quantitative methods. But what I would argue is that these are just an extension of a new way to express technical ideas that have been around since Charlie Dow over 100 years ago was writing in the Dow Jones, creating the Dow Jones averages and writing in the Wall Street Journal. Now, the other term that I hear from kids, particularly in colleges and universities, oh yeah, I want to do systematic work. I want to do an algo trading internship. I want to work with coding, right? They want to learn Python. They want to write in R or MATLAB. And algorithmic trading is also an extension of how we do things as technical analysts. It's a step-by-step procedure to solve logical and mathematical problems. And where I think algorithmic trading has probably overstepped its value is that it's great for order placement and management. It can be used for decision making, but you have to know how to design that system so that it is fishing where the fish are, so to speak. The decision making process that goes into writing up an algorithmic strategy is still defined by humans to trade against other humans. I know we all have a little bit of physics envy, but as Emmanuel Derman said, when you are a physicist, your rules help play against God. in the financial services industry, you're playing against God's creatures. So it's a little more complicated than Newtonian physics would imply. All right, let's get to the CMT program itself. I just touched on 3 concepts today: relative strength, divergence analysis, and breadth. Now, in the program, you're going to cover a ton of material around risk management, trading risk management, portfolio risk, understanding when to sell out of a security, looking at concepts like relative strength. Where is there a better opportunity to put capital to work inside your portfolio? We're going to look at a lot of quantitative systems. A lot of those quant methods help us express and employ technical concepts. We're going to look at all of that in the context of portfolio management rather than single security trading. So for all of you who are familiar with charting tools, you're looking at bar charts, candlestick charts, you are making trades throughout the day, that's incredibly helpful knowledge if you are interested in pursuing the CMT program. But we're going to take it a step further, and we're going to look at baskets of securities. We're going to look at running a full portfolio. And then, of course, we've talked a lot about the investor sentiment, the market moods. We're going to talk a lot in the CMT program about applied behavioral finance, not just at the macro level, understanding why prices trend and understanding that herding behavior, or understanding the anchoring bias and what we as technicians call levels of support and resistance. But we're also going to talk about how that applies to you as the trader and portfolio manager, to understand where you are going to fall victim to your own emotional biases and cognitive biases. All right, the CMT program, in real specific terms, is a 3-part exam. You can sit for those levels every June and every December, but you need to take all 3 in sequence. So you can't take more than 1 exam per cycle, and you do have to do them in order, passing all 3 levels. The CMT credential is awarded to those who demonstrate the mastery of a core body of knowledge in investment risk and portfolio management settings. And it's not one person, but within our organization, the Curriculum and Test Development Committee, a ton of volunteers, and our board of directors, as well as my colleague Stanley Dash, help define what that body of knowledge is, the weighting that is given to different subjects and topics within there, and then define the curriculum from which you will study to sit for those exams. So it is a very rigorous process by which we evaluate that body of knowledge. And we're actually about to embark on the next practice analysis, which means we are going out to employers in the financial services industry with really rigorous surveys to help understand what it is they're looking for when they hire their next junior person on the trading desk, a new research associate, a new portfolio manager. What are they looking for when they promote somebody to run an institutional portfolio or to help sell those funds? And so we're starting from what they are looking to hire, and that's what's going into the program to make sure that you're equipped for these roles in Wall Street. Next exams are December 2nd through the 12th, so just a few weeks away. Registration is now closed for the December 2021 exams, but you do have a chance to get started for June and 2022. We will open early registration in December, so next month, if you're thinking about getting yourself an early Christmas present, you can sign up for the CMT program, begin at level 1 in June. Again, we offer those on a rolling cycle every 6 months. So again, December of 2022, we'll have another exam administration. All right. Why would anyone give up their nights and weekends for potentially years to sit through all 3 levels of the CMT program, to study this rigorous body of knowledge, to pour through textbooks to get ready to pass these exams? Well, we've asked our members and new charter holders what they have received in terms of compensation, benefits, career opportunities. Again, our awesome marketing department put together a little infographic for you. So you can see on the right side of your screen, those who've received promotions, new positions, more responsibility. They've been improving their career opportunities by having that CMT charter. And what I want to draw your attention to is this right here, more responsibility. Almost 60% of our survey respondents in the year after receiving their CMT charter reported greater responsibility. What that translates to is that they have greater assets under management. Either their firm allocated more capital to the fund that or strategy that they were running, or clients have brought more assets into their firm because they had their CMT charter, which really tells us there is an inherent trust in the rigor of the program and the value of that credential throughout the industry for money managers who have a really well-defined sell discipline, who are very responsible risk managers, but who can also help capture alpha for their clients. So we've heard from a lot of veteran technical analysts, people who have been doing this for years, that at late stage in their career came to the CMT program. They said it was incredibly valuable to study things that they had never really considered as part of the technical discipline, or certainly just hadn't given a whole lot of thought to, let's say, the Elliott wave concept, or point and figure charting, or statistical methods. And bringing them through that guided body of knowledge has been really helpful. But of course, the hard facts are that it really improves career opportunities as well. I get asked by a lot of youngsters, okay, so if I get the CMT, I can be a trader, a research analyst. What do I do? Well, the pie chart here shows you that technical analysts exist throughout the whole ecosystem of the financial services industry. Many are publishing research analysts, for sure. Many are market strategists inside of big firms, or programmatic systems developers. They're coders who came and got their CMT charter to help them understand those foundational principles. We've got individual money managers, investment advisors, folks who work in the brokerage industry. So Jeff, to your question, the CMT program represents professionals throughout the financial services industry at every kind of organization and in every kind of job role. And we've made a lot of big changes for the CMT program in recent years. I want to just cover a few of them. First and foremost, we've simplified the membership process. So the credentialing aspect, sitting for the CMT exams, that's one part of what we do. We are also a professional association. I talked about those events and publications and podcasts. If you are not in the position to want to sit for those exams yet, but you just want to learn, you are also welcome to join the organization. And if you are interested in the charter, you don't have to be a member of the organization to get started. The CMT program is open to current or aspiring professionals wherever you are in your journey. I also wanted to mention remote proctoring. So the coronavirus, turns out, also affected the CMT Association. Imagine that. We typically deliver our exams through Prometric test centers all over the globe. And whether you're in Memphis or Milwaukee or Mumbai, it should be the exact same environment under which you sit for the exam. The integrity of those exam delivery methods is really important to us, as well as to our charter holders. And so for many years, we looked at different remote proctoring options. The technology was just not there to make sure we had a really secure exam environment until just this year. So our partners at Prometric have delivered through ProProctor a remote testing opportunity. You can sit for it in your home office or at your office. You don't have to go to a testing center to sit for the exams, though that option is still available to you. The other piece I want to talk about is the consolidated curriculum. I was flinging a textbook around here a minute ago. When I first got started at the CMT Association about a decade ago, you studied from a stack of textbooks, some of the best authors out there, John Murphy and Martin Pring, Edwards and Gee, and you had to go through and read selected chapters from each of these works. But it was a lot of redundancy. A lot of the authors were talking about similar subject matter, and at times even slightly contradictory, which makes studying for an exam very, very difficult. So we've worked with John Wiley & Sons. They are our publisher. We've consolidated that curriculum into a single textbook at each level. You have a defined curriculum that's really cut down the amount of time that it takes for our candidates to prepare for the exams, but it's also made the testing process much more straightforward for those of you who are ready to study. The good folks at Wiley wanted me to share that discount for you. If you're thinking about sitting for the exams, new curriculum will be out in the coming weeks, and you can take 30% off your purchase with that discount code CMTTW30. So the 2022 textbooks are coming out soon, and we encourage you to pick those up. Even if you're just new to technical analysis, best book I can recommend that has a broad course of study over a lot of subject matter. It's going to be that introduction to the CMT program, that level 1 textbook. All right. We talk with institutional money managers all over the world and with their employers about the value of the CMT program. And as I showed in Ralph's chart, the two sides of the same coin are both the company, the accounting estimates, the intrinsic value, as well as the market price and what we can understand as technical analysts. And so to bring that together, we do have a partnership with the CFA Institute. For any of you who are CFA charter holders in good standing, we actually have developed a glide path through their Stackable Credentials initiative in partnership with the CFA Institute for CFA charter holders to begin at level 2 of the CMT program. We did a very exhaustive curriculum mapping exercise and found that a lot of CFA charter holders have actually gone through a treatment of a number of these topics that are in the CMT program, and they're well prepared. It would be redundant for them to go through the level 1 curriculum again. So if you are a CFA charter holder, you can find out more about that at our website, cmtassociation.org, and look for that CMT level 1 waiver. You don't have to take it from me. Some of the best money managers, institutional research analysts, and client advisors out there who are dual charter holders have talked all about how the CMT has added value to their process and their discipline of money management and publication. You can check out those testimonials right on our website as well, and learn a thing or two about how their approach to financial markets might influence your own discipline in trading. This is a technical analysis conference, as I've been told, and so it's good to end with a chart. You want to be buying strength, and there's nothing more bullish than looking at the exam registrants for our CMT program that continues to move up and to the right. So you're getting in on a great trend right now as we're growing around the world in this 50-year-old startup. So as I mentioned, the next cycle for exam dates is going to be June of 2022. You can register beginning in early December. We'll have that open as soon as we conclude this current exam cycle. And make sure you get in early. Save hundreds of dollars off your registration by coming in at that early bird registration price here at the end of the year. You can enroll in the program, schedule your exams, and look forward to seeing you all as CMT charter holders. Jeff, I want to thank you again for inviting the CMT Association to participate in this conference. What an incredible week. I know you've got, hopefully a restful weekend ahead of you as you wrap up 37 hours of conference hosting. I have done many of the same through the CMT Association. Our global conferences sometimes begin at 2 o'clock in the morning for me. So I'm no stranger to that, but it is a labor of love. And it's great to just learn from so many wonderful experts. So you've got my contact information right up on the screen. By all means, we look forward to meeting many of you at CMT conferences and events coming up soon. And with that, I'll hand it back to you, Jeff, for a minute. If there are any questions I could help answer, happy to at this point. And if not, we can maybe bring on my friend Alex Cole and talk a little bit about go, no go charts as well.
Awesome. That sounds good. Great job, too, by the way.
Thanks.
I have some interesting questions, as you might guess. Albeck wants to know what your settings for RSI are.
Oh, what went into that RSI chart?
How many? I think he was looking at he wanted to know what the look back period was for the RSI.
It's a 13-period RSI.
Awesome. Okay. Let's see. Do you have any analytics or data in terms of age of people that have passed the CMT exam?
Absolutely. So it is skewing younger these days as we've launched our academic partner programs. There are more and more college and university students sitting for the exams. Average age of our charter holders, they're all going to be mid-career professionals between 35 and 55. That's going to be the heaviest element of our core membership. The other piece of demographics that I find really interesting is that we were founded in New York City, and it quickly expanded to Boston, institutional buy-side community. But it's really been in the last 10 years that we have expanded so quickly internationally. So we have an office in Mumbai now. I used to travel pre-coronavirus to Asia at least a couple times a year.
Times.
What's that?
Before times, right? in the before times.
That's right. Our children are going to refer to before coronavirus as the BC period, right?
Yeah.
But we have expanded really quickly internationally, also throughout Europe and now even through Latin America. And so what is a 60-40 split, 60% North American members, 40% rest of the world, is actually growing faster in the rest of the world than it is in North America. So about 70% of our new members each year are coming from outside of North America, outside of US and Canada. So we're seeing that globalization take place right now.
70%. That's huge. I bet, is it big in the Middle East? Because I know that, very big. Okay. I know that they love accreditation and that kind of stuff.
Yes. So both Dubai and Abu Dhabi for the Emirates, I think that it was a strategic plan by the Emiratis to create a real financial center. So we've partnered with some organizations over there, also in the software business, but have a very active chapter in Dubai. We host meetings at the DIFC, the International Financial Center, but we're quickly expanding in Bahrain and Qatar as well.
My first international trip ever out of the country was for work, and it was to Saudi Arabia. It was the coolest thing ever. I had a blast. Yeah,
you hadn't even
awesome.
been to Canada before you went to Saudi Arabia?
No, overseas. I've been to Canada and Mexico, but it was quite a trip.
Yeah, that's awesome.
Literally. Albuquerque wants to know if you know how many CMTs there are in total.
So total charter holders, just about 3,000. But as I was showing earlier, we have about 10,000 currently in the program, which means that they're all at various stages of the 3 levels of the exam. They don't all sit for an exam each cycle, but we're seeing that our members are going to triple in the next few years as the candidate pool continues to grow.
Awesome.
Yeah.
Okay. We have a little bit of extra time. Do you want to help me in a different thing?
Of course, I'd love to.
These prizes are not going to go away themselves, Tyler. I need some help. So
I would love to help you, Jeff, in any way that I can.
All right. Let's go ahead, and I'm going to go ahead and pull up my list here. We'll go with the name first. What I need you to do is pick any number between 0. Well, actually, let's go 1, because 0 isn't a number you should pick. 1 and 11,848.
Let's award those early birds, right? They get the worm. How about registrant 4? Let's pick number 4.
I like it. The registrant would be Helem L, and in Hong Kong.
Oh, so, fantastic!
And I'm gonna pat myself on the back. I did not accidentally read the last name. All right.
And it's also 3 o'clock in the morning there for Helen, so hopefully they find out about this prize tomorrow when they wake up.
Yeah, if you're there, say so. I might give you an extra prize for being up at 3 a.m. watching MetaStock events. But you might be watching the recording too. Let me go ahead. Where is my prize sheet? Let's go ahead and mark this one down. And should I tell them what they won?
Let's do it.
Okay. So what we're going to do here, I'm going to give away another John Seville course. So John Seville was on yesterday. I'm not sure if he's a CMT or not, but he does. His company name is Acorn Wealth Corporation, and he does a trading course. He's Australian, so he has a really cool accent. But he does. This includes a trading course, indicators for MetaStock that I personally wrote, one-on-one training, 3 months access to the Smart Money Trade Alerts. He says the retail value of that is $5,185. What will happen is I get a chance. I'm going to send you a little bit of an email to just verify that you are the prize winner and send you details on how to get that. I do want to say CMT has been great for sponsoring the events. I'm going to also say thank you to Stocks and Commodities, which I think is a great magazine. And I get one every day, or not every day, every month. And they've been a great sponsor. We absolutely still have Stocks and Commodities. Tyler's going to take my part of the job here, though. And he is going to introduce for us the next speaker. Are you ready to do that?
That sounds great.
Go for it. And we'll start him a little bit earlier if he's here. Alex, yeah, I hope you're ready to go just a few minutes early. We're running a little bit in front of the time instead of behind the time. So
well, that's how I like to trade too. I'm always early, which is not very good for my portfolio, Jeff.
Sure. Okay.
Let's see if I can pull up.
I'd rather get out of the stock early than late, I think.
That's
just,
right. That's exactly. All right, Alex, can you hear me? And is your webcam working? See if our good pal Alex has joined. So
he probably logged in and went, I'm going to grab some coffee real quick before I act with cock for an hour. He might be just coming back in.
He knows how long I can talk. It's the main problem. I've known Alex for about 10 years, and we first got together while he was working at another software company starting with a B in New York that we won't need to mention. But he spent about 16 years there developing tools for institutional professionals, training a lot of the youngsters that were hired into the data analytics group. So trying to explain some of the technical tools that were on their platform. And I got to know him as an exceptional educator, really great product manager. And through my role at the CMT Association, I get to see everybody's work. Technicians all over the globe, what's been working, what's not been working, frankly, where market regimes have shifted and thrown some strategies under the bus. And so as Alex and I have gotten to know each other over the last decade, it really came clear to us that with all the members of the CMT community, the ones who had the most rigorous or the most long-lasting work really kept it quite simple. And you look at the II rankings, institutional investor rankings of the top research analysts, that always comes down to the folks who can express their ideas and their process in really clean and elegant terms. And so Alex came to me in January of 2021 about a new chart type called Go-No-Go charts. And lucky for me, he presented an opportunity for us to work together on that as we bring around tools to not just institutional professionals, but individual and self-directed investors as well, to help them understand how they could use technical analysis in a more simplified way. I know in the last hour I talked a lot about Kahneman and Tversky and these cognitive biases. For any trader who's ever tried it, you'll find that you are your own worst enemy in most trading situations, where it's not about whether or not your system has an edge, but about your ability to follow through and obey that system. That's just so hard. So the simpler, the better in terms of your ability to make use of that. So Alex, by way of biography and background, obviously spent those 16 years in the institutional community doing product management and creating technical tools. He's also a member of the CMT Association. And then our partners over at John Wiley & Sons, when I was helping them find a subject matter expert that was going to be able to teach the preparatory classes that they offer for the CMT exams, I said, there is nobody I would recommend hire more highly than Alex Cole, because he's just such a great teacher. So he's also, you'll see his face over 60 hours of video training courses while you're preparing for the CMT exams. If you choose to pick up a prep course from Wiley, Alex is their lead instructor. And he's just a nice guy, which is really hard to come by. Smart and easy to get along with. Jeff, sounds like a unicorn to me.
I'd agree. Yeah, no, he's been pretty easy to work with. We've been kind of working with him quite a bit lately, as he's going to talk a little bit about. But yeah, I agree. He's a nice guy. It would be really awkward though if I disagreed right there. Just really awkward.
I sort of set you up to have to agree, right? Like,
right,
actually, Alex, I don't know.
I don't know. I don't like working with either of you guys.
All right. Well, I'm going to let you guys box this out. I'll get out of the way. Thanks, guys.
Awesome. Yeah, thanks, Jeff. And clearly, for anybody still on the line, you can tell that you have to be a musician to be on this conference. Alex, what do you got behind your right ear?
That's my Gibson SG,
Nice.
one of my favorites.
One of these days, in the post-coronavirus world, we'll get together and actually get to play.
Yeah, for sure.
Well, let's now that this is the last session of the last day of this incredible conference, everything that everybody has learned, let's undo all of that and just focus everyone's attention on the simple concept of market trends. Right, the simpler the better. Alex, do you want to tell us a little bit about John Henry and this favorite quote that we both have?
Yeah, I like to almost look at everything through this quote now. I just love the takeaways from it, and I love the whole idea of it. And what he said was, if you take emotion, and by the way, those of you who don't know John Henry, very successful hedge fund manager, also owner of Premier League soccer teams, and just a very successful trend following investor over time. He said, if you take emotion, the would be, could be, should be out of it, and look at what is, and then quantify it, you have a big advantage over most human beings. And that's really what we deal with in technical analysis. It's about investor psychology, understanding how people react and what people do given a certain set of information.
Mm-hmm. So for those of you who like to read, you perhaps have seen the book Moneyball, or you watched the Brad Pitt movie version of that book. But Michael Lewis detailed the sabermetrics pioneer, this guy named Bill James, who helped bring the Boston Red Sox from out of the curse of the Gambino, and what he was really doing was just trying to quantify in a statistical way, take all of the emotion out of player selection and just look at what their stats were. And so John Henry, growing up in Southern Illinois, starting to learn the commodities trading business from his family, he applied the same ideas to systematic trend following beginning in 1981. 40 years ago, this guy understood that if you could really objectify what was trending, you'd have the ability to outperform your peers who were probably blinded by their own emotions. So little endorsement for Moneyball, huge endorsement for John Henry, who's clearly taken this and applied it in a lot of different venues. Let's also talk about the expectancy formula. So when people talk about cognitive biases or the behavioral things that get in the way of successful money management, I think what they're really needing to lay into is the fact that it's more painful for most of us to lock in a loss, right? We suffer the prospect theory that Amos and Tversky wrote about. We suffer a greater fear of that pain of acknowledging that we were wrong or locking in the loss. The pain is greater than the joy that we would experience from letting a winner run. So we all are hardwired, right? The evolution of our brains have put us in a position to be really bad traders and investors. We let our losers run and we lock in our profits really way too early. So trend following investment is by nature a contrarian approach. We are battling against ourselves in everyday trading to try to let our winners run and to lock in those losses quickly, to cut our losers short so that they don't become outsized and blow up our account. So the expectancy formula, I'm here to share some good news with everybody, is that your edge, right, the amount of times that you are right versus wrong in your trade selection is not as important as to your profitability as your profit ratio. So I want everybody to raise your hand if you've had that high conviction trade, and don't worry, it's a virtual event. Nobody can see your hand. You stuck with it long after it started to work against you, right? And the loss just piled up and ballooned and ballooned. And what was a trade then became an investment, and then you're going to hold it for the long term because you're so convinced this is going to turn around eventually. We don't know what the market knows. Anybody who tells you they know where the market's heading tomorrow is full of it, and you can run the other direction. But what we're talking about with this expectancy formula is that we need to find ways to remove our emotions from the decision-making process so that we can exercise a profitable system. So to get mathematical for just a second, let's consider this chart on the right side of your screen and see how this can be expressed in mathematical terms. Down here on the x-axis, I'm going to grab a laser pointer here. Down here on the x-axis is the percentage of trades that were successful, right? If you're picking securities correctly 50 or even 60% of the time, congratulations, you are one of the best in the business. And then up here on the y-axis are the ratio of profits that come from those trades that work, right? How large are your profits for the trades that are working in your favor, and how small are the losses that you're taking? The secret is that you can be wrong quite often as long as your winners outpace your losing trades, right? So this curve here is where we find profitability. This is the break-even curve. And we could be right only 25% of the time. It means 3/4 of the trades that we put on are wrong. But as long as our winners are 3 times larger than our losers, we're breaking even. And the profitable systems are going to live right out here. So I can't emphasize enough that if you're going to be a trend following investor, you can take lots and lots and lots of small bets, and you can be wrong more often than not, as long as you let those winners run and you cut those losses short. So today, Alex is going to talk to us about go-no-go charts. They're going to help both in security selection and help you be a responsible risk manager so that you can really press your bets, lay into things when they're working in your favor, and you can cut those losers short. And this is how the largest funds in the world do this. So Alex, walk us through.
Yeah, and this was really eye-opening to me too. When I was first starting out at Bloomberg 18 years ago, I suppose.
A while.
Sounds crazy to say that, but I remember coming in fresh with my technical analysis studies and falling in love with the whole discipline. And I remember going to see somebody who was a very successful technician at a really large shop, and he just said to me, look, you know, little secret, I aim to be right 50% of the time. And I'm like, what do you mean? You know, I've just been studying everything, and you know, and that's where we come up against people all the time saying to us, but you know, I'm looking for that thing that's always right. You know, it doesn't have to exist. It doesn't exist, but it doesn't have to exist. And I remember this gentleman telling me, I aim to be right 50% of the time, and I would make 2 times my winners. I take profits after at least twice as much as I let my losers hurt me, and, you know, that's a recipe for success for me. And I think I looked a little crestfallen, and then he said to me, but don't worry, I think technical analysis allows me to be right more than 50% of the time.
Yeah.
But you know, it's just right at the beginning, and it was a really important lesson for me.
Absolutely. The best signals in the business are 55, 60% accurate. And that's just the nature of markets, right? They're not here to be your friend, for sure. So as Alex and I have gotten to know each other in the CMT community, we've also gotten to know and be mentored by some of the best. So this all comes from Dave Keller, who was president of the association when I first started. He was also the managing director of research at Fidelity Investments in Boston. So he ran the entire technical team. Prior to that, he had worked at some software company in New York where Alex got to meet him. But when he was up in Boston, he was learning to fly planes as well. And Dave would talk about how you spend all this time on the runway before the plane ever gets in the air, and your flight instructor makes you go through checklist after checklist after checklist. If you've ever read Checklist Manifesto about Doctors Beyond Borders, and the simplest things save lives. Same in aeronautics. So that when you get up and you're actually live practice, as Dave said, the instructor would just kill the engine, and all of a sudden you're 15,000 feet in the air in a little steel can, and it noses down, kind of lurches forward. He said the gut-wrenching terror that comes from an airplane that's just been shut off, that's going to eventually crash, is really hard to overcome. And all of those checklists help you to manage your emotions, because it's muscle memory at that point. You check that your airspeed is at 65 knots, so you can coast for a while. Is your fuel shutoff valve accidentally bumped in by your knee? Did you kick the key out, right? There could be some very simple solutions. Is your fuel mixture too rich that killed the engine? The point is, you go through that checklist so that you're not focused on the plane lurching down, the nose pointing down. You are just thinking about how to get that plane running again. Same thing in trading and investing. For those of us who were fully invested in February of 2020, that was a roller coaster moment where you started to see the entire apparatus roll over. Now, a technical checklist is going to help you be a really responsible risk manager, right? You might think about Dow theory, go through some multiple time frames. You might look at some trend lines. If we've broken those trend lines, moving averages, you name it. You can go through all of those tools to assess the situation and find out how to responsibly manage risk. Is this the start of something big to the downside, or is this simply an exhaustion moment where the markets are digesting recent gains? Now, that checklist can also lead to problems. And Ralph, as I mentioned, Ralph Akampura in the prior presentation, he also tells a story about his first few days at Prudential. He was their new market strategist, and they were going to parade him around to all of the client offices. And Ralph is such a lovable guy. First thing they wanted to do was introduce him to everybody at the trading desk. So he's walking through, and he comes by this kid's desk, and the young guy had 6 vertical monitors, and each one had a chart with 70 panels, and there's lines going everywhere. And Ralph leaned over and said, "Son, I've never seen technical analysis done like that. What are you looking for?" The little kid looked up at Ralph. He said, "Please, sir, don't tell my boss. I have no idea, but he thinks I'm really busy and really good at it. So I just keep these super busy charts up." And that is the analysis paralysis. That's what I was talking about, put a Stradivarius in my hands, I'm probably going to hurt the instrument and myself, right? But responsible use of these tools doesn't mean just adding more to your chart. It means separating signal from noise. And Alex, I know you got to see the same thing in action for all of those years as you're developing.
Yeah, and from so many different perspectives. From my perspective, having done all the studies and research as I went further and further into the discipline, it became something that I needed to concern myself with to not overcomplicate my own charts. But then from client perspective, depending on what your role is in the industry, you could be a sell-side research analyst and trying to explain a recommendation to the buy side. And you've got your process up on the screen, and you're sort of saying, okay, this is where I would recommend to buy. And it's just, you're really just having to hope that the buy side takes your word for it, because the chart is nothing that client can easily understand. Right. Then you've got, new people to the field. You've got, the mass of the general public now really taking their own investing into their own hands. And you, like you said, you get given a Ferrari and you have to drive it around town. It's too much power a lot of the time.
I can barely handle a Honda Civic. I mean, maybe I'm just a bad driver. We'll see. All right, Professor Alex, talk us through the ways that technicians actually identify trends, right? That's the fundamental concepts, is that we want to participate in market trends.
Yeah, so it's arguably the most important skill that we can arm ourselves with, right? That of trend identification. And what you're looking to do is find those, bigger than normal moves. You're trying to find, like you said, trend following in systems can be profitable with about 30% win rate. That's another thing I talk to people all the time, where a real trend following system can target about a 30% win rate and be successful, because when it catches the big trend, that more than, it's not 2 times the losses or 3 times the losses, it's 50 times the losses, right? That one big trend. So if you can catch those trends, if you can find those trends, if you can identify those in price action, then you can profit on the majority of the move. And we like to say that it's a simple idea, but it's not easy to execute. Right. But, anything that you do here, whatever your process is, and we'll step through a fairly logical systematic way to try to identify trend, just as an example of how somebody might do it. The first way, you could just look at the chart and say, do we have a series of higher highs and higher lows? Visually, is the chart moving in a discernible direction from, let's say, bottom left to top right? Okay, that's our first visual clue. Then you might throw on something that tries to automate that process for you, right? If you're trying to go through a massive universe, or if you're trying to look at a big watch list of stocks. And so you've got something like the Donchian channels, and I'm sure some people on the call are familiar with the story of the turtle traders. This was one of the Donchian channels was sort of their primary way to enter and exit trades. They had obviously a lot of risk management going on as well, but the story of Richard Dennis, who was a fantastic trader who thought he could create traders like they created turtles in a turtle farm he'd seen on his travels. This was what he primarily used to teach traders how to trade and make money. And the Donchian channels just looks back at a certain look back window and sort of asks the chart, are we making a new high for that time frame, or a new low? And if we are making a new high, it'll move that line up. And so that line will get moved up every time a price makes a new high. And over that same sort of look back period, if we make a new low, then the line underneath, that green line, will move as well. So that's sort of the first way you could identify higher highs and higher lows. But then you can get, obviously much more sophisticated, and people will throw on Bollinger Bands onto the chart to see if price is moving within those multiple standard deviations of its mean, or if it's likely to break out if the bands are narrow and start a new trend in a certain direction. You might throw something else on there, like a moving. I mean, it's hard to find a chart without a simple moving average on it. I remember at Bloomberg, we didn't even consider that technical analysis. Wasn't considered a core technical feature. And people would say to me all the time, I'm not a technical analyst. I don't look at that stuff. But did you see that price just bounced off its moving average? Like, okay, yeah, not a technician. So everybody will have a simple moving average on the chart, and from that you can look at price relative to it. And the simplest idea is just if price is above a moving average of its historical prices, then you're in a trending environment.
As Paul Tudor-John says, the metric for looking at everything is the 200-day moving average of closing prices. And I mean, these tools are ubiquitous across the industry, even for people who don't consider themselves technical analysts.
Yeah. And you can keep going. You can look at Dow theory, and you mentioned it briefly in the checklist, but you might be looking forward to get a sort of a second piece of information to see if volume confirms a price move that you've seen. And then you might throw on something that's a little bit more towards the momentum side of things and look at MACD, and is the MACD crossing its signal? And then you can arrive at a point, once you've put all this really sound analysis on your chart, you can arrive at a point where you feel fairly confident that a trend has been initiated, because you've got a confluence of events. You've got new high and Donchian channels. Your Bollinger Band price broke out to the upside of a tight Bollinger Band, perhaps. The moving average is, again, price crossed above that. Volume confirmed, and now MACD is above zero, or MACD has crossed its signal line. There's multiple ways to read that as well. And you can be fairly confident then that, yes, somewhere towards the left side of this chart, a new trend had begun.
That's right. That's exactly what a good use of technical tools might lead you to. But that's a busy looking chart, Alex. So what did you come up with? Well,
that's the thing, and that's not a complicated chart, really. I try to keep it fairly simple on the page, on the slide before, but you see some, and not for any crazy intention, like the story you told about the guy who actually didn't know what he was looking at. You got some really good charts out there, and if you really love this stuff and you get into the weeds, you can end up with 12, 13, 14, 15 things on the chart, both covering up price, multiple moving averages, Bollinger Bands, Donchian channels, you name it, Keltner bands, and then you can be having 4, 5, 6 panels underneath, all giving you information that you think is valuable. And then so what I wanted to do over the time was just to create something that blended as much of that valuable information, all the information that I use in my process, into something that was easy to see and easy to understand and easy to relate to other people as well.
Easy to explain, that keeps your focus on price. Price being the most important indicator that we have, everything else being derivative to confirm or deny whether or not the conditions of trend are there. So what we're looking at, go chart on the screen. This is still in development, being implemented by the team at MetaStock. Thank you so much to Jeff Gibby and to William and others who've had a hand in this. But in the bright blue bars, we're seeing the strongest bullish conditions, right? And what's interesting is that on this simple bar chart with the colors, you've got even more information than what we were looking at back here. Many more indicators blended into that whole technical picture to understand trend. So a blue bar is the strong bullish indication of the overall trend conditions that moves to a weaker bullish signal in the aqua bars. We've got some amber bars in here that often take place in a transitory period where you've got that knife fight happening between buyers and sellers. We like to call those go fish bars. For anybody who's read some Jesse Livermore, you might be familiar with the quote that there's a time to go long and a time to go short and a time to go fishing, which for trend following investors, it's very difficult to make money when the market can't make up its mind. So we want to see those rigorous and durable trends. Pink, weak bearish signal, and purple, the strongest bearish conditions for the overall trend environment. So when you blend all of that technical information into a simple color, you still keep your eyes focused on what price action is doing, which is the most important indicator out there. And we didn't say it best, but Mark Abraham certainly did. He said that ultimately it's the dollar-weighted collective opinion of all market participants that determines whether a stock will go up or down. This consensus is revealed by analyzing price. So again, the narrative doesn't matter. The storytelling doesn't matter. The talking heads on financial news media don't matter. Price is the only way that we get paid, and that's where people actually decide the value or that's what they're willing to pay for a share of that security. Alex, anything you want to say about the initial concept of understanding trend?
No, that's it's behind everything we do, and if you can have a way to just visualize that on your chart, it goes back to a bit that John Henry, you're a step ahead of everybody. Mm-hmm. And I just love this quote. This is one of, you always say price is can never be restated. It's not an estimate, and price pays, and that's how people, that's what we think as technicians. You can read all of the fundamental data, you can read all of the news, you can look at all the the Twitter, the number of tweets about a company, but it's price, and that's what we like to look at as technicians. And I think this quote just says it so succinctly, that it is the consensus of everybody in the market, and that final price, that's what you're looking at, and that is all the analysis that you need to get a sense of trend.
Yeah, brilliant. All right. So if we're simply considering the trend conditions, right? If we're a self-directed investor, we just want to participate in the upside in a trend, and we want to get out when that trend has corrected or even reversed. Let's look at a few examples of this, how it actually plays out. And for everybody who's on the line with us, feel free to throw it in the chat. What are you seeing right now on this daily chart of United States oil? It's a ETF fund, just looking at the U.S. oil production. What do you see on that chart? and yes, I see that comment about Ralph Akampora. Just like Jesse Livermore, there's time to go long, time to go short, time to go fishing. Ralph says, you got to speak clearly, unless you don't know what's going to happen, in which case you just mumble a little bit. No mumblers out there. What's the trend tell you here for U.S. oil? That's right. It is a strong no-go. We've got a purple bar, and I know that's probably a little small on your screens, but we have been hearing and reading all through the summer and fall about the buoyancy of oil prices, the inflation fears that were coming with commodities, and what we're seeing on the chart right now. Doesn't mean this is a permanent state, but right now, all of the trend conditions taken together as a whole are telling us this is strongly bearish. Prices will trend down from here based on the current information we have. That's where probabilities are telling us. All right, let's do another one. Let's look at US equities. Where's the trend for the S&P 500 on this daily chart? Anybody? That's right, a strong go. We've got blue bars. That trend is up and to the right. It's got the glide path of a bottle rocket from my eyes. And that's the trend that's so persistent, all right? We're looking at the S&P 500 that had this period of chop. We saw the trend come out of its go trend into a strong no-go. Reversed, we had this period of indecision as we were at levels of prior resistance, and then we broke through to the upside, resumed that go trend, all conditions pointing to the upside. All right, let's talk about our good friend, Charles H. Dow. So 100 years ago, founder of the Wall Street Journal, creator of the Dow Jones Average, was talking about technical analysis, 130 years ago, in terms of a multiple time frame approach. He was talking about how investors come into and get out of the markets. And he was looking at these 3 time frames while having quite a nautical lifestyle. He said that the primary trend is inviolable, right? This is heavily based on the macroeconomics and the fundamentals of the economy. Now, this is the most persistent, the strongest trend takes place over multiple years, and it is like the tides of the ocean, right? This is not people's fickle opinions about the fundamentals. These are the actual drivers of the macroeconomy, and that we measure that in multiple years, if not decades. These are the bullish or bearish regimes. This is how Charles Dow defined the primary trend. And he said the secondary trend moves above and below that primary trend, and that's weeks to months. And he described that as the waves of the ocean, which are really cyclical rallies or routes in that primary bull or bear market. So as we're looking at this chart, we've got a primary bull market trend, and we see cyclical rallies and tops and bottoms within that primary trend period. This is in reaction to the fundamental stories. Now, the minor trend, Charles Dow described as the ripples on the surface of the water. These are just surface stories, reactions to the news, people's mood or behavior at any given time for supply and demand of those shares. And so that shortest term trend is really the fluctuations of the market participants themselves, mostly noise in reaction to the news, which is not to say that you can't be highly profitable and effective in that short time frame. But the shorter the time frame gets, the more reliant you are on execution technology, the speed within which you can make your trades. And so we've seen some incredible hedge funds do great work with high frequency. Renaissance comes to mind, that have allocated billions of dollars on these very, very short-term strategies, understanding how those technical components can work on that very, very short time frame. For me, for you, for any of us who are not co-located with the exchange, that might be a tough time frame to trade. But we know that the averages discount everything, and that everything that anybody knows on Wall Street shows up in price. And so we can look to the charts for all of that information. So let's think about go-no-go charts on multiple time periods. Alex, what are you seeing on the weekly chart of US equities?
Yeah, and when we go through the CMT course and we talk about some of this stuff, you know, this triple time frame analysis is really sort of the bread and butter of, you know, I don't want to say sensible investing, but maybe more long term and less sort of hair pulling investing. And I think that's what a lot of, yes, coin that term. That's where a lot of work has been done in technical analysis, is to sort of understand that, you know, if your larger time frame is in a certain trend, then you go down in time frames to find better entries and better execution. And that is something that you can still take advantage of, even without high frequency technology at your disposal. And so a lot of the people that I will work with, especially in the institutional world, where they aren't trying to, you know, capitalize on a 3-minute move, you know, you're talking about a portfolio manager who has to be well positioned, based on his analysis of certain events, and then a trader who's trying to find better execution for him. You might well have a portfolio manager looking at a weekly chart to get an overall bias of the market trend. And in this case, we've thrown up a weekly chart of the S&P, and this is the trend we've been in since spring, summer of 2020. The market have been in a strong go trend. And you can see that little bit of weakness a couple of months ago, that was a no-go correction on the daily, are just weaker aqua bars on this weekly, and actually have provided a good time to participate or to enter into this larger time frame trend. And you see, maybe it's hard to pick that on the weekly. So that's perhaps when you would go down in time frame to the daily. And so you're looking at trying to take long positions because you're biased to the upside based on your larger time frame opinion. So now you're seeing that no-go correction. You're looking at the weekly to see if it holds its trend, but you're actually looking for entry points on the daily to sort of say, how can I get back in? Maybe you get out of the no-go to limit your max drawdown, right? You reduce your risk exposure, but then you want to get back into that trend. So that's something that technical analysis we haven't really talked about today, but can do for you as well. Not just hopefully maximize returns, but limit downside exposure and limit that risk of losing 50-60% of your capital. And so you might be looking at the daily, not even concerned about a no-go, but waiting then for an opportunity to get in. And if you're, say, a PM looking at that, you might then send this down to your trader because you're saying, hey, look, I'm thinking we're looking for entries, and he might then break this chart down to a 60-minute chart or something even smaller, and this is not lined up with the time frame. But at some point during that no-go correction, the trader would very likely be able to find an entry on a 60-minute that would give him an entry price that's towards the lower end of that no-go period for his portfolio manager. So you'd be getting a buy from a smaller time frame, during that correction against the overall uptrend. So that's sort of maybe a bit simplistic, but that's how people might use.
Yeah, a trader on the desk might get the buy order for 100,000 shares, somewhere at the end of the day on the 15th, and maybe they don't want to get in for, they have till the end of the week to purchase those shares. Maybe they want to buy at the lower end of the range to add some alpha to that PM's position, right? So they're looking at the hourly chart to give context to what a PM might see on a very long time frame. I've also been picking on financial news media for some time, but you get into a situation like this, you have several down days in a row, weeks of chop and sell-off, and they march out every last technician that they can get onto the show to say, all right, so where's support? When is this going to end? Is this a buy the dip moment, or is this the next big wave down? Is it inflation concerns? Is it the debt ceiling? Whatever narrative they want to assign to it. And technicians, being less emotional, focused just on the evidence right in front of them, would say, well, if I'm looking at the longer term perspective, right, we can see that the weekly chart has held its trend conditions. We're not seeing a sharp sell-off on the longer period, which might mean that until we see that evidence, this isn't still an opportunity to buy the dip. And then you have a responsible entry point, good risk management by looking at that shorter time frame. All right, Alex, let's move on to another topic, which is how you could use go-no-go trends across asset classes. We talked about the work of John Murphy in the last hour, as well as Marcus Katsanos, who built upon some of those intermarket observations, foundational concepts that John Murphy and others had found. And so if you're thinking about go-no-go trend and the color coding of those trend conditions, let's talk about how you could compare that across asset classes.
Yeah, and this is the kind of thing that we do. We do quite a bit of work with people that are not just asset classes, sectors, right? Whatever your universe is, how do you break that up and look at the relative trend performance, and how do we best allocate, how do we best position ourselves to take advantage of where the trends are? And I think the simplicity of just coloring the chart to see the trend allows you to throw a bunch of charts on a screen, or even a chart book, you know, print them out on the train on the way home. You know, maybe not on the train anymore. A lot of us are still at home, but
I got to commute to my.
Yeah,
I'm already home.
exactly. But just to scroll through the trends and just get a real quick sense. Okay, equities were in a go, treasuries are in a go, but we're seeing some weakness. Oil has just entered a no-go. Bitcoin has been strong. Gold is moving higher, and the dollar is in a go. Right, you know, right away now we know the trend across these asset classes. What does that mean if the dollar is still showing strength? What does that mean for commodities? We, you know, right away we're just looking at the colors or where the go no go trend is on these asset classes. We can do that market analysis. We can say, okay, the dollar is showing strength. What does that mean for commodities? Does that make sense that gold is in a strong go as well? If we're looking at oil prices, what does that tell us? Is that a little bit contradictory, or you know, and what does that mean for equities? Well, equities are still in a strong go, and we can just get a sense of the overall environment. And again, like I said, this could be a portfolio. Maybe you're somebody who's diversified across about 10 companies, 10 stocks, and you know, you take a quick scan of them and say, okay, these 7 are still in goes. This one's just entered a no-go. What do I do? You know, should I do something about that? And you can just get a really quick sense of what the technical trend is by just comparing across these charts.
Absolutely. And for sophisticated institutional money managers who are looking at a global allocation, they might see strong US dollar and the weakening of commodity sectors like the energy sector as perhaps some risky business for some of their emerging markets that are very, you know, heavily dependent on incomes from oil and natural gas, but also that strong US dollar is going to be a real headwind for emerging markets. So taken as a whole, we're getting a lot of information very simply from just a color-coded chart that's giving us the trend conditions that we can compare across asset classes. So Alex and I, we get to work together each week on producing some research for our clients, both a weekly newsletter, so a top-down perspective, beginning Monday morning, just to take a look across all asset classes, across those sector groups, so narrowing down that universe as to what is leading from a relative strength perspective and where those trends are most durable and long-lasting. Then we wrap up each week, you know, on Saturday morning, sending out launch conditions, that chart pack covering all global indices and asset classes. So you can just take a look at what has happened during the week to give yourself a perspective on those longer-term trends. We do those on daily charts each week, and then also on monthly charts when we get the conclusion of the month. All right, Alex. Now we're going to switch some gears. We've talked about the concepts. Let's give everybody a complete breakdown for all of the tools that you've created in the full Go No Go Charts suite of tools. All right, the complete solution, as it were, which we know is simple but not easy to execute. So let's help everybody avoid that analysis paralysis with the complete Go No Go Chart system.
Yeah, and you know, this doesn't have to take long because the concept is the same, right? So first of all, it was, let's find a way to identify trend. That's the go no go trend, and that's where everything starts. But then, as everybody probably on the call knows, you know, from there, you're most likely going to want to see momentum, and you're going to want to see the velocity of price change. You know, has price moved too fast in one direction, and what does that tell us? So I did the same thing, really approached the world of momentum indicators, which I really find a lot of value in. But I tried to do the same thing and take indicators, concepts, and periodicity inputs and sensitivity to blend everything that I was currently looking at. You know, I mentioned at the beginning, this all stems from the fact that I loved my charts, but they were a nightmare to read or understand. So everything that I look at from a momentum perspective is put into the one oscillator. And so now you've got the foundational concepts of momentum analysis blended together to give just the one panel. So like with this chart now, I have a technical overview of any security in terms of trend and momentum. And I also volume, you know, there's some debate about the usefulness of volume nowadays, given the dark pool trades and just the way that volume can be manipulated, but I still like to look at it. And so the volume information is in the changing color down there of the oscillator. Heavy volume, dark blue, lighter volume is the aqua. So if you're looking at that go break in the middle there, that new go trend being accompanied by heavy volume, as you can tell from the oscillator, you've got a lot of information there, and you've got a complete technical overview of the world in terms of trend and momentum. And then there's other icons on the chart that we want to highlight that will allow you to understand what's happening in terms of trend and momentum. And then there's also a final piece called the go no go squeeze that builds on the oscillator to incorporate volatility. But the goal was for me to get almost everything that I look at from a technical perspective, from trend identification, momentum analysis, volume and volatility, all into one chart without taking away from that main price panel. So because I also love the works of Edwards and McGee and drawing lines, finding important price levels. Even on this chart right here, that horizontal resistance is just trying to smack me in the face, right? And then we get that go flag, that change of color on a break of that resistance. And then we know it's on heavy volume. We know momentum is surging in the direction of the trend. And so I like to have the space on that chart to be able to see those levels and draw, the important annotations that we all like to look at, even, pattern analysis as well, very, very important. And hopefully still easy to do because you aren't doing anything other than coloring the price bar.
Right. Very, very well said. When we have a simple, clean chart, then those kinds of annotations, the significance of that break above a resistance line, accompanied by a strong resurgence of momentum to the positive, upside on heavy volume. Now we're talking about a complete technical checklist that gives us great confidence to really press our bets, right? When that many factors are aligned, then maybe you take a larger position or you scale into that position more quickly as all of those pieces line up. But let's talk about the concept of momentum real quick. Let's break this down just for the sake of educating everybody out there who's maybe using the indicators and doesn't even quite understand what those are telling them.
Yeah, to me, momentum is a fantastic piece of information, and it really just tells you how fast price is changing. So I like to say it measures the velocity of price change. So how strong is a price move? Is it unsustainably strong, and are we then likely to see a pullback towards sort of a more normalized average of price? And when I teach it, I talk about cars. I'm British. We grew up with the World Rally Championship and Formula One. So I'm always talking about it in terms of acceleration. And I like to sort of say, like, if you've got these are obviously American drag races, but if you're driving a car and you're sort of trying to, let's say you're pulling onto a highway from a slip road, you're going to increase your speed. You might go from 10 miles an hour to 20 miles an hour to 30 miles an hour. So you're increasing, your acceleration is 10 miles an hour every however many seconds. But as you get close to that highway speed, you're not going to keep going 10 miles an hour faster. It's going to be hard to go from 30 to 40 to 50 to 60, right? So as you get close to, in New Jersey, a lot of the highways are 50 miles an hour, which seems a bit pedestrian, but
posted 50 miles an hour, people actually drive 90, Alex.
as you get close to that 50, you're probably going to continue to get faster, but not at such a quick rate. So you're going to go from 40 to 45, 48, and then by the time you hit 50, you're pulling onto the highway. So your car was still increasing in speed, but it wasn't increasing in speed as quickly. And that's where you would be able to see momentum changing, right? So that this beginning of this chart is that real sort of straight line increase from 0 to 10 to 20 to 30. But then as it goes 40, 45, 48, you see that slowdown in momentum. And that's what we're looking for when we're looking at a momentum chart. And what's interesting, and I try to relate this whole car analogy, is that if you think about it, once you got on the highway, your next options are only either to keep going forever, right, or maybe pull onto the Autobahn in Germany where you can go as fast as possible, or you eventually pull off, so your car will get slower, right? So once you've hit that momentum top, then if you think about it in terms of a chart, you see momentum decreasing and momentum pulling back even as price is going higher. It can't do that forever in theory, and you may be pulling off the highway and taking an exit to slower roads. You know, that's how I like to sort of explain it when I talk about momentum.
That is the best analogy, I think, in terms of drag racing. The way I was taught, it was, you know, you throw a baseball in the air, it's fastest as it leaves your hands, and as it reaches that apex, it's moving slower and slower upwards until it actually gives back and comes back to gravity. So all of those momentum concepts, and there are many of them, and really we could spend all evening and most of next week paying tribute to the great minds who have created a lot of these derivative momentum indicators that are so useful for so many technicians. But we don't have time for all that. So right now, we're talking about blending multiple momentum concepts, just as you did with the go-no-go trend indicator, the color-coded price bars, to think instead about a single oscillator. Talk to us a little bit about the utility of the go-no-go oscillator.
Yeah, and so the traditional momentum analysis was really valuable to me, and I use it a lot. You know, the idea of looking for divergence really is that it's a concept that's everywhere in technical analysis, but especially with momentum, and that's very important. So you can still do that with the go-no-go oscillator. It's blended all of, you know, multiple tools into one, and the value of that hopefully will become apparent in a little bit, but you can still use this as a traditional oscillator. So when you're getting a higher high in price, but you're getting a lower high in momentum, very, very important and very telling often. And so you can easily see that on the chart here.
I talked a little bit about divergence analysis in the last hour. Same concept here, right? Go-no-go oscillator, periods of overbought or oversold extremes, but also simple to identify divergence analysis. Let's talk a little bit about the zero line and all of the research you did into using momentum oscillators within the context of trend.
Yeah, so this is one of my favorite parts of technicals, really, because there was you know, when you learn it originally, it's trend and it's momentum, and it's trending market and it's range bound market. And you know, an oscillator, a momentum oscillator, can help you identify peaks and troughs in a range-bound market. It's a mean reversion strategy, and you know, you're looking for overbought coming back into neutral, and then you're expecting price to pull back. But there's a lot of research done, brilliant stuff written by, you know, comes to mind Connie Brown and her book, and the idea of, can we use these really valuable tools that everybody looks like RSIs? You know, RSI is perhaps the most used after moving averages indicator, let's say, around. So everybody's looking at momentum. Can we use it to give us additional insight in a trending market? And the answer was yes. And she did a lot of work to show that in a solid uptrend, something like RSI, and again, it could be RSI, it could be stochastics, you know, whatever it is, they will trade in a range. So when price is in an uptrend, on every up move, an oscillator is quite likely to go overbought, and that makes sense because it's enthusiastic selling. It's enthusiastic buying, excessive buying that's driving price up. And of course, some people will take profit. There will be a cool off, but that cool off is unlikely to push the momentum indicator into its oversold territory. That would be a concern for the strength of the up move. So they found that these oscillators trade in ranges in trends. So if you're looking at something like the RSI in an uptrend, it trades generally between 80 and 40. It doesn't actually get oversold. But the problem with that is that that's a very subjective level, or it's a very, not necessarily subjective, but it's a very finicky level, and they're very choppy indicators. And is it 40? Is it 38? I mean, even Wells Wilder in the beginning talked about RSI above and below 50 as having some important insight to it. But where do we define those ranges? And it's also difficult on different asset classes. It's different for different securities. Some trade in a more volatile way. So you're always trying to shift those levels, and you're trying to find those levels on a chart. And if you think the level is 40 for support in an uptrend, and it comes down to 42, is that considered support? If it goes to 39, is that considered a break of support? It's very, very difficult to be sure. So what I wanted to do with creating this oscillator was find a way to give a completely objective level that could be used as support and resistance. And so when all of the inputs, the short, more sensitive inputs, the longer term inputs, the different oscillators that I like to look at, when all of the inputs fall into their neutral territory, then the go-no-go oscillator falls to the zero line if it's in an uptrend, or rises to the zero line if it's in a downtrend. So what you actually get then is an objective level that shouldn't be broken if the trend is healthy. So if the go trend is in place and healthy, which like in this chart, we've got blues and aqua, uninterrupted go trend, every correction that is identified as well by a little bit of weakness in the color where you see it go aqua, but every correction falls to zero because there's some cooling off, there's some profit taking, but it finds support at the zero line because it doesn't really make sense in theory for the momentum to go any aspect of momentum to go oversold. Excessive selling in an uptrend, it doesn't make as much sense. Excessive buying and then a cool off, excessive buying and then a cool off. So that zero line becomes very powerful when we look at the ability that you have then to stay in trend, Tyler, like you've said, that we talked about at the beginning, to have those outsized profits from the few trends that you really catch. And so that leads into this slide, which is talking about the icons. That's what we try to do here, is then I identify for you on the chart, so make it even easier to understand what is happening in that interaction between the oscillator and the go-no-go trend.
So that period of cooling off, right? For most investors, that question of, is this a chance to buy the dip, or is this the beginning of something new to come? We've got our trend indications, top panel, that price bar gives us the color coding of the overall trend conditions. We can look for confirmation or divergence within the go-no-go oscillator, and that objective zero line is going to tell us that we're seeing this trend cool off, right? The excessive buying is being digested. We're digesting some of that through a counter trend price correction. We've seen the momentum completely fall off, but it's held the zero line. So the objective level of support where we're just in neutral, we're just processing all these recent gains. Now we've got icons to tell us when the momentum is resurging in the direction of the trend. That's a low risk entry point for the continuation of that trend. Or if you already hold the stock, this is where you add to your position size. This is how you find those outsized winners that will help you off balance, cutting your losses short. So whenever that momentum resurges in the direction of the trend, these simple icons right under the price bar draw your eye to that point. It's also a great opportunity for screening tools to see go trends that are signaling re-entry points, a resurgence of momentum in the direction of what is already a durable trend, which as a style for a lot of trend following investors, that adds a lot of value to know when they can press their bets, when they can get outsized or concentrated positions in a single security. Let's talk about those counter trend corrections. Like any great oscillator, Alex, areas of overbought, as it was taught to me, overbought is not a bad thing. Right? That's an extreme momentum in the direction of a bullish trend. When it ends, that's when you want to get out of the way for those counter trend corrections. So,
and that just goes back to the fact that I do see a lot of value in the traditional use of momentum. So that highlights for you those overbought or oversold areas where the price is then, where the oscillator is then coming back into its neutral territory. So that'll highlight those peaks and troughs for you in the traditional sense of how you might look at an oscillator to do that. It reminds me of when I living through the Bear Stearns thing back in 2008, when I was teaching courses to new hires or whoever it might be, clients, but basic technical analysis course. And people say, well, Bear Stearns is it's oversold, right? So we should be buying it. Well, and so we for a while we would use that example because Bear Stearns went oversold. Yeah, sure, right?
Yeah,
but it's when it goes back into neutral that you would consider, and it obviously it never did. So yeah, like you said, overselling in a no-go trend, healthy no-go trend, overbought in an uptrend. And that's why, the traditional textbooks will say that, the sell signal on an RSI is when it goes back into neutral territory, obviously, because that excessive buying has for the moment stopped.
So these counter trend icons appear when momentum retreats from overbought or oversold. Right. As I was taught, oversold is like the beach ball that you hold under the water and then you let your hand go. And if it just stays there, there's something seriously wrong with your beach ball. You don't want to go buy more of those beach balls until they surface. All right, last but not least, let's talk about the go, no go squeeze. I know we've got about 5 minutes left in the trading week, the trading day, and this conference. So we'll hurry up and hit a couple of examples before we're done here for the afternoon.
So this was just the final piece where I also did want to bring in a sense of volatility. And everybody's probably talked about some sort of volatility squeeze, whether it's Keltner bands or Bollinger Band squeezes, but a lot of work done to identify when there is a squeeze in place. And the way that I was always taught, or the way that my colleagues and I thought about it, was a tube of toothpaste. If you keep the top on a tube of toothpaste and squeeze, nothing will happen, but then eventually the top will come off. And that's the idea, that you're looking for that compressed volatility when there's not a lot happening. And the idea is that can't continue forever. There will be a move in a direction. And usually when the volatility is being compressed, that ensuing move can be significant. So what we've done with the squeeze is we've tried to highlight the time that the oscillator spends riding the zero line. We call it riding the zero line. So we know that when the oscillator hits zero in a strong go trend, it should find support. If it doesn't bounce right away, then it rides the zero line, and all those momentum inputs are still in their neutral territory. And that allows us to identify those periods of reduced volatility. And then often when the break comes, either way, then that move can be significant. Obviously, if the go trend is in place, the break is slightly more expected to the upside. And so that's what we're trying to highlight here with that climbing grid, that orange climbing grid of the squeeze. That will climb and stay at its extreme while volatility continues to be reduced. And we see that oscillator riding the zero line.
Squeeze building up, time spent on the zero line, retesting the zero line, retesting the zero line, but then resurgence of momentum on heavy volume as we see this significant price move. Now, how do go-to-go charts work to the opposite side? For those who are interested in trading to the short side, there are mirror image tools built into go-no-go charts to the downside. Correct, Alex?
Yeah, it's the exact same idea. So the no-go is the downtrend, and the oscillator should break to the downside out of a squeeze, let's say, or it should find rejection at the zero line when the oscillator is below zero and the no-go is in place. And on the chart, the price panel, you'll see those red circles are those low-risk trend continuation icons. So we had green circles underneath price in an uptrend, red circles above price in a downtrend, and then those green arrows underneath, or triangles, are those counter trend corrections. So those are oversold points coming back into neutral territory. But the same exact thing, can be applied to the downside.
And we can see that concept of polarity that we all learned in the CMT program. That zero line is support when we're in an uptrend, comes down to zero and finds support as long as the uptrend is healthy, the go trend. If we're in a no-go trend, that zero line is an area of resistance, and we continue to see momentum back down into oversold territory. All right, let's wrap it all up. Let's bring it all together. The complete technical picture based on 3 questions. I love the way that you did this, Alex. Walk us through a few, what we're going to look for on these next few examples.
Yeah, and it was very comforting to me to know that I could go and talk to somebody, whether they were an oil trader or a long-only PM or somebody that covered the Asian Pacific markets, whatever it was. If I could look at a chart and answer 3 questions, then I could give them a complete technical overview of what was happening. And that's just, what's the trend? Where is the oscillator? And is there anything interesting happening around the zero line? And so if we move forward, we can just do a couple really quickly. This one is the financials sector ETF right now, on a weekly basis, because we've been talking about in our research how financials and energy, and for a while they were outperforming. And so on a weekly basis, we've seen it's in a strong go trend. we can see that it found support at the 0 line several times as it consolidated sideways. And now we're approaching 0 again. So if we answer those 3 questions, what are we looking at? Well, we're in a go trend, but it is the paler aqua color. So we'd consider that a weak go. The oscillator value is at 1. So it's still in positive territory. And then the third question, is there anything interesting around the 0 line? Well, I'm saying that it's approaching 0. We'll look to see if it can find support there as it has done before.
Mm-hmm.
If we dive down, sorry, go ahead.
No, I was just going to say that go trend for the financial sector beginning a full year ago, certainly on a relative basis, we've seen it outperform and underperform the index, but on an absolute basis, that trend has been very durable on this weekly basis.
Yeah. So then if you dive down to find a way to take advantage of that strong weekly trend, we were talking about Jeffries in our research several months ago. We saw that break to a go trend. We saw it retest the 0 line, even to the very left of that chart, that squeeze broken, followed by some low risk entries. That trend continued, was in place. You get those green trend continuation icons. And now towards the end of this move, this trade that somebody might have been in now for a few months, you can see that before we got this amber go fish bar, we broke below 0 on the oscillator. So if we run through those 3 questions real quick again, what's the trend? Well, right now we're in a go fish. So we're actually directionalist. So there's not enough trend conditions on either side for us to say it's a go or a no go. The oscillator is at -5. So that's actually oversold on the oscillator, but on light volume. Is there anything happening around the 0 line? Not really. But it's interesting to note that at this point, the oscillator, crashed below the 0 line after the squeeze tried to build several bars ago. So that could have been an indication for somebody that the trend conditions were unhealthy and that we might fall out of that trend, which we seem to have done on Jeffries.
Yep. And that's, again, in a strong go trend, for this max squeeze to then be broken to the downside is a pretty extreme warning sign for deterioration of the trend conditions. So these are real examples from the real research that that you and I get to put out each week. September 29th, so going back over a month and a half, saw that financial sector really outperforming, looking at some of the well-known names in the financial sector that that had also picked on that trend. But a rising tide lifts all ships. So even lesser known municipal banks, regional banks like the Bank of NT Butterfield and Sons might participate in this trend as well. So let's see how that played out. From
this is the great thing about being a technician, right? It really doesn't matter if you cover it, but maybe.
I think there's a little delay.
Yeah, maybe we make this the last one, but this was just one that went out on our daily. Yeah, I don't know if you can hear me properly, but on a specific example, like you said, coming out of that research about the financial markets, not the financial sector, small Bank of NT Butterfield put out a daily piece suggesting that we'd seen a new go, and this is where we are now. So how that trade played out, and we can see that right now we're still in a go, but at on aqua bars, so there's some weakness there. The oscillator is at 0 on this one. And so what do we want to see there? What's important about that 0 line is that momentum has now fallen to 0. The volume is light, and we will look to see if the oscillator finds support here as it should. If it does, we might expect price to rally and attack those prior highs. But that's sort of the walkthrough of our research and hopefully an understanding of how to use the whole chart.
It's fantastic. And I know there's a bit of a delay there on your video feed. I know we have a few other examples to go through, but we're already after 4 o'clock. So just in the interest of everybody getting on to their weekend, as my colleagues like to say, it's Milla time somewhere in the world. But we've seen a lot of these signals come out in the research, play out for a month or two, and then we have the exact same warning signs for responsible risk management using these go-no-go charts. We're looking through a few of the commodities examples. It was funny, I was talking to Alex earlier this week about how just now everybody who's in the game of fund management is releasing these inflation hedge products, and here's my top 5 for how we're gonna profit during a period of inflation. And here we have oil rolling over, and commodities rolling over, agricultural rolling over. So perhaps just in time to top tick the inflation signals, we've got a lot of folks out there perhaps just not looking at the weight of the evidence. And right now, I think what would be best for us, Alex, is just to end. We've talked a little bit about using the go charts and having a clean look at price to be able to do some of those traditional annotations. Just moving through these really quick, but let's end with a chart of Tesla for something just a little different for everybody to enjoy this weekend.
Yeah, and this is some coming out of the themes that we've been talking about in the more recently. We see tech coming back as an outperformer, and we see discretionary coming back as an outperformer, which is interesting given that we've had that
on a relative basis to the
on
index.
A relative basis, yes. I mean, we've got some pure trends, of course, still in some of the other ones, but on a relative basis, we've seen tech come back, we've seen discretionary come back. So we thought we'd finish with a chart of Tesla. This was one that back in June we flagged a go signal, and has really, I mean, it's just taken off since then. We've had a really significant correction, though, in the more recent few weeks. And so a very important time for Tesla. And if you do that 1, 2, 3, it's in a go trend, yes. The oscillator's at 0. And so we will look now to see, can it hold the 0 line? Or if it doesn't, perhaps if you've capitalized on that 600 to 1100 move, if it doesn't hold the 0 line and significantly breaks down below 0, then perhaps that will lead to color change in the trend chart above. So what's going to happen next with Tesla? We're going to look to see if that 0 line can hold as support.
Absolutely. Alex, thank you so much for building these incredible tools, B, inviting me to participate in Go charts, and then also for speaking at this week's conference. I know that the team at MetaStock has been hard at work bringing these tools, these charts into the MetaStock environment for users. I know the implementation is still underway. Where can people find it right now in terms of other platforms where they might want to use Go charts?
Yep. So TradingView, stock charts, wealth charts, and like you said, some of the charts in this presentation today were MetaStock charts. And so we're happily and we're fast approaching some sort of solution here on MetaStock as well, and working with Jeff and the team has been a great experience so far. So we're hoping to have something on MetaStock as well. But yes, stock charts, TradingView, wealth charts currently.
Brilliant. And more information, educational tools, examples of prior research, lots of videos at gonogocharts.com. For everybody who's interested. And Alex, really appreciate you spending time with me this afternoon. Jeff Gibby, why don't we take a couple of questions if you'd like? I know it's already 5 after, and we need to let you wrap up your 37 hours of conference hosting before too long.
I could go for another 37.
Attaboy.
That would be pretty. Gotta ask, this is not available in MetaStock. Why are they here? So I let her know in the chat. It's almost here. We're getting very close. I would say it's going to be 2021, most likely. So just give us a few weeks. We will make announcements when it's available for MetaStock. Ghana, thank you for using MetaStock too. So I don't see a lot of other questions. Monica says, very stunning conference. There was a question earlier that was pretty funny. Neil wanted to say, this was the best presentation of the 5 days. And so to clarify, I said, are you talking about this one, Neil, or the one that I did 3 sessions ago? And he's like, oh, I haven't watched yours yet. So he really much enjoyed this presentation. Other than that,
wonderful. Well,
I don't see a lot of other questions.
That's a great pleasure. And just for everybody, there's a little evidence. That is a MetaStock chart with go trend on it. We're almost there in terms of implementation, thanks to Jeff and William and the whole team. Just incredible programming team. And really, thank you.
You can tell
again.
it's a MetaStock chart because it has a smiley face.
It does.
In the corner. And we were into emojis before emojis were cool. All right, very cool, guys. Thank you very much. It's good to have you. We're just going to wrap up. We're going to close up. Thanks for coming in, guys. We'll see you again soon.
Thanks
again. Jeff. Talk to you then. Bye-bye.
Bye. Okay. All right. Let's go ahead. And I do want to. I do. That was great. I enjoyed those, guys. Let me go ahead and change the presenter to me. We'll share the screen one last time. And we'll say thank you to CMT for sponsoring the event. My email address, Neil, is jeffrey.gibby@metastock.com. And here I will post it for you. You're welcome to give me a call or an email. You can call me too if you want at metastock.com. Ken, I don't know that answer. So just go to gonoGoCharts.com, and I'm pretty sure they have it up there somewhere. Monica says, very awesome conference, stunning variety of innovations, ideas, and concept. I recalled some of it and learned a lot. I thank you for coming, Monica. I hope you enjoyed it. I thought it went really well. Very, very pleased. There was a lot of work that went into this, more than I kind of felt like I bit off more than I could chew. And I felt like it went really well. I want to thank everybody that participated, the speakers, the staff. I think our marketing guy put together a total of like 78 emails, so we could send out different people, partners, and stuff like that. Lowell asked a question: will all of the conference recordings be available on YouTube? Absolutely. They're actually, as soon as we're done, all 5 days are going to be available because we streamed all 5 days. All you have to do is go to youtube.com/metastock. You can start right over on day one and watch them all weekend if you want. We do ask you to like and subscribe. It does help. We appreciate it. It does help a lot. So, okay. Will we get an email with all the offers? We will send... actually, maybe you should email me. We will send kind of like a little bit of a follow-up with all the recordings on Monday. It's already scheduled to go out. But if you have specific questions about specific offers, let me know. So, okay. Thank you, Stocks and Commodities, for sponsoring the event. They did a great job. Thank you for CMT. It's good to hear from them. Great organization. We're very happy to be lined up with him. I do want to talk one more time about the Oscar Carboni class that we've got coming up tomorrow. So tomorrow we're going to sit down with a good friend of mine, Oscar Carboni. He's going to do a master class. You're invited to it. And what in the heck happened to these slides? I tell you what. Anyway, when I copied them over from yesterday, they got a little bit big. So let me go ahead and, not sure why that happened, but we're going to talk about how to do technicals, trendline formations. We're going to do all that kind of stuff. Normally it's $4.99. I knew this one would be messed up too because they both would be. But the normal price is $4.99. The conference special is $3.99. This starts at 10 a.m. Eastern time tomorrow. I'll be there with my bells on. I'll read my legal disclaimer, and I'll let Oscar teach for 3 hours. We'll take a little bit of a break in the middle. Oscar's going to do a great job. That's why I invited him. He really does a good job of kind of talking about kind of this classic technical trendline formations and flags and failure flags. $3.99, 800-882-3040, or www.metastock.com/saleschat. If you don't do anything else, have a good weekend. But what I would recommend that you do is actually try out the MetaStock software program if you haven't already. Again, it's run 28 years in a row, best software in its price category. I only can talk for about 35 hours. After that, just forget about it. Metastock.com/conf-promo, 800-882-3040, or metastock.com/saleschat. Thank you, everybody, for participating. I appreciate it. Thanks for coming. Have a great Thanksgiving next weekend. And if you're in the U.S., that is, and care about it. Otherwise, I hope to see you at the next event that we do. Stay healthy. Stay safe. See you next time.